our chairman to address you and again me and indeed the entire association. Welcome all of you, Mr. Chairman, sir.
Thank you very much, our CEO. Your Excellency, the Vice President of the Republic of Uganda, Honorable Edward Kiwanuka Sekandi, our Governor of the Bank of Uganda, Professor Tumusime Mutebire, the Principal Judge, the Honorable Members of Parliament we have amidst us this morning, our keynote speaker, who is the former Governor, Central Bank of Kenya, members of the diplomatic corps and development partners here present, all representatives of government ministries, departments and agencies, all the CEOs and private sector players represented here this morning, representatives from the academia and civil society, fellow bankers, financial sector players, all the distinguished guests, ladies and gentlemen, good morning. On behalf of Uganda Bankers Association, I would like to welcome all of you today to this occasion of the inaugural annual Bankers Conference here at Serena Hotel, Kampala. And I would like to sincerely thank you for leaving everything else to honor our invitation. Your being here in person confirms to us the importance you attach to the financial sector in general, the banking sector in particular. I specifically want to single out our key partners and sponsors for this conference: MasterCard, Eletics International, CompuScan, ABI Trust and others for joining hands with us to bring alive this conference. We thank you very much. Uganda Bankers Association is an umbrella organization for licensed commercial banks supervised by Bank of Uganda. UBA was established in 1981 with the key objective of promoting and representing the professional interests of its members, working closely with the regulator and other bank, financial institutions and organizations in promoting financial sector growth. Today, we are currently made up of 25 members, including 24 licensed commercial banks and a development bank, Uganda Development Bank. We have, however, recently amended our constitution to extend associate membership to all regulated and supervised financial institutions, which include credit institutions and microfinance deposit-taking institutions. These are the tier 2 and 3 financial institutions. Commercial banks currently have mobilized deposits amounting to about 16 trillion, which is about 17% of the GDP, and have extended private sector credit amounting to about 12 trillion Uganda shillings, again about 13% of GDP. At this juncture, I ask you to allow me to quickly introduce the executive members of UBA who have been steering business of the association on a day-to-day basis. I begin with the Vice Chairman, who is the MD of Barclays Bank, Mr. Rakesh. If you could stand up for recognition, thank you. Our Treasurer is the MD of Stanbic Bank, Mr. Patrick Heide. Thank you. And Honorary Auditor is the MD and CEO of Finance Trust Bank, the prayer warrior, Mrs. Anne Mulindwa. And the ED, again you saw at the very start, is Mr. Wilbrod Owol. In the year 2016, we commenced implementation of a 3-year medium-term strategy with several objectives, key among them being: 1, enhancing stakeholder engagement and collaboration, and then 2, facilitating research and innovation, and then 3, undertaking initiatives to manage the various challenges that the banking sector faces, including operating costs. And these are things like the shared agent banking platform and the asset reconstruction company that are currently under development. Our inaugural banking conference today is one of the key events in our activity calendar that will therefore shape our strategies going forward. The theme for this year's conference, The Future of Banking, does not require elaboration because banking is rapidly changing. Changing in the area of demographics, technology, regulation, risk, market entry by previously non-bank players, and several other geopolitical shifts, which are combined to drive change like never before, and the financial landscape has eventually changed. The right to access financial services is real, we recognize. Things like financial inclusion, financial literacy, and penetration are today important social impact indicators worldwide. The recent financial crisis and economic challenges in several countries is forcing banks and regulators alike to adapt and evolve in order to face the challenges ahead. Institutions therefore need to constantly formulate strategies so as to avoid the mistakes of the past and create business environment for the future. The objective of this conference, therefore, is to take stock and gain insights from global, regional, country-specific trends in the banking and financial services sector, to use these experiences to shape policy interventions, strategies, initiatives to position and align financial sector development to the national growth and development agenda. I would therefore at this juncture like to welcome our keynote speaker, who is going to share insights, and we look forward to having them. ABC, as it is codenamed, Annual Bankers Conference, is an initiative that will now become an annual UBA event, seeking to bring together various industry experts from international, regional, and national spheres involved in facilitating and delivering financial and banking services to discuss the dynamics that are increasingly shaping sustainability strategies in banking, finance, and the overall development ecosystem to draw consensus on financial sector priorities, areas for attention, and intervention required therein. Let me conclude by highlighting what else we do outside financial intermediation. Banks do recognize that the health of our businesses is inextricably linked to the long-term prosperity of the communities in which we operate and to overall sustained local and national economic development. As a key ingredient in our business strategies, corporate responsibility is central in our engagements. Over the years, commercial banks in Uganda have contributed tremendously to social and environmental interventions that benefit society while increasingly representing good investment opportunities for private capital. In 2015, for example, banks spent 7.1 billion Uganda shillings towards social responsibility activities. And in 2016, which was a tough year, as we mentioned earlier on, commercial banks allocated close to 6 billion Uganda shillings. And the key focus areas have included education, health and sanitation, financial literacy, and focusing on key sectors like agriculture, among others. Details of these interventions, again, you'll see them in the conference magazine that is before you. Banks combined are the largest group of taxpayers in the country, and similarly, we are the largest group contributor to pension funds as a sector. Our contributions in areas of employment and the employment value chain, both directly through our employees and indirectly through our service providers, like providers of premises where we operate, housing, IT, telecom, and other financial technology services provided to banks, security, marketing companies, and several other operations. This impact will even be much higher once we roll out agent banking, where through a structure of outsourced service providers, new business opportunities for thousands of agents spread across the country will lead to the introduction of new market products establishment of secure lending opportunities for banks to extend loans to agents, training opportunities, and engagement opportunities in operations, KYC, know your customer, AML, compliance monitoring, cash management, business analytics, and many others. I therefore wish to reaffirm to all our stakeholders that the banking industry in Uganda is not standing still in the face of the various developments around it. And we are optimistic that from this conference, a lot more insights will be generated to contribute towards the future that we want to see. We have a highly packed line of presentations, as you will see, and I welcome all of you to participate. And at this juncture, I want to wish you a very fruitful and engaging discussions, and I thank you once again for coming and for your attention during the day. Let me take this opportunity to invite our governor, the Governor of Bank of Uganda, to address this conference. Thank you very much.
Excellency, the Vice President of Uganda, the Honorable Edward Chiwaruka Sekandi, the keynote speaker, Professor Njuguna Ndungu, the Emeritus Governor of the Central Bank of Kenya, the ministers who might be present, MPs, of course I forgot the distinguished principal, sorry, the main judge who is here. I'm sorry, what Principal Judge? I'm sorry about that. Executives and senior members of banks who are present, senior management of the Institute of Banking and Financial Services, distinguished guests, ladies and gentlemen, good morning to you all. Let me begin by commending very much the Uganda Bankers Association for organizing this inaugural annual bank conference. I sincerely hope it will be very annual, and I hope that we shall continue supporting it as we have done today. We have a very busy schedule of sessions on a variety of important topics, which you can look forward to today. But let me make my remarks because of that. But in my brief remarks, I would like to outline what I think are some of the challenges for Ugandan banking industry in the years ahead. As will become clearer today, the challenges ahead are in some respects interrelated, as progress here will make it easier to make progress in addressing the challenges in other areas. A major challenge in the banking industry, one which is of the greatest importance for the rest of the economy, is in fact how to strengthen bank lending to the private sector. In Uganda, bank lending expanded rapidly in the first decade of this century. In real terms, the stock of credit expanded fourfold between 2001 and 2017. And this fourfold increase enabled many new borrowers to access credit. But since 2011, credit growth has slowed down, and over the last 2 years, there has been virtually no growth in real terms, that is, after adjusting for inflation. The main reasons for the stagnation of bank lending on the supply side of the credit market is the main challenge. The last 5 years, since the first half of 2012, loan demand has proxied the value of loan applications received by the banks has grown robustly by about 17% per annum in real terms. But the value of these loans actually approved by banks have grown much more slowly. Consequently, whereas in the first half of 2012, banks approved loans in the value amounting to 70% of the total loan applications that they received, that figure had fallen 70% in the first 4 months of 2017, from 70% to 51%. It is clear that against a background of rising non-performing loans and difficulties in realizing the value of loan collateral in property markets, banks have become much more wary about the creditworthiness of loan applicants, and as a result, have become more reluctant to extend credit to them. The ability of borrowers to service their loans, and therefore their creditworthiness, is not independent of the interest rates charged on these loans. The higher the lending rate of interest, the larger is the burden placed on the borrower to service his or her loans. And ceteris paribus, lower interest rates would therefore contribute to enhancing the capacities of borrowers to service their loans out of their business revenue, and thereby help to alleviate credit risk. Reducing interest rates in a financially sustainable manner is therefore the major challenge facing the banking industry. I emphasize reducing interest rates in a financially sustainable manner. Not just curbing interest rates, as politicians are used to shout. Unfortunately, high lending rates of interest are primarily the result of high cost structure of banking in Uganda. And lending rates will not fall in a sustainable manner until the banks have been able to bring down their operating costs. I must repeat this. Unfortunately, high lending rates of interest are primarily the result of the high cost structure of banking in Uganda, and therefore lending interest rates will not fall in a sustainable manner until banks have been able to bring down their operating costs. The average annual operating costs of banking in Uganda the annual operating costs of banks in Uganda as a percentage of the income earning assets is currently around 11%, which is very, very high by international standards. Large branch networks and the high cost of staff are major contributors to the high operating costs of banks. When interest costs of deposits and provisions for bad debt are added to operating costs, banks' annual cost as a percent of the income earning assets rises to almost 18%, which obviously constrains the extent to which average lending rates can fall. Hence, the third challenge facing the Ugandan banking industry is how to reduce the banking industry's high operating costs without compromising service delivery or customers' access to services. The structural factors which underlie the high banking lending rates point to the inevitable consequences of any attempt to force banks to reduce their lending rates by legislation, as has happened in Kenya. I hope we shall hear about this from our comrade professor who is coming from Kenya. If lending rates were capped by legislation at levels below the real cost of lending, taking into account the operating costs, as well as provisions at the cost of funds, banks would definitely make losses on their own portfolios. They would respond by curtailing their lending to those borrowers to whom lending involves the highest costs, in the form of high transaction costs for loan evaluation and monitoring, and or because of high risk premiums. The banks might also attempt to recover some of their losses by increasing the fees and charges levied on their customers. If lending rates were capped, the borrowers who would suffer in terms of losing access to credit would be the small and medium-term enterprises. This is because SMEs are both more risky. Excuse me. I'm being attacked by some funny disease. This is because SMEs are both more risky and involve higher transaction costs for the banks as a share of the amount that they borrow from prime borrowers. What they borrow than prime borrowers borrow. Given these costs, banks can only extend credit to SMEs in a commercially viable manner if they are free, if the banks are free, set lending rates at levels which can cover the expected cost of lending, including the default risk. Instead of SMEs, capping lending rates would encourage the banks to concentrate their reduced loan portfolios on their prime borrowers, which already benefit from the lowest lending rates in the economy. Thus, capping interest rates would be highly counterproductive in that it would damage the small and medium-scale enterprise sector by constraining its ability to obtain capital and finance for investment to expand the productive capacity. As the SME sector is crucial for the future growth of the Ugandan economy and the creation of employment, capping interest rates would constitute a dangerous act of economic damage. We have already had such experience of this problem in 1970s and 80s to teach us how damaging the control of interest rates can be. In those periods, the banking industry shrunk dramatically because many types of banking business, including the private sector, were not financially viable in Uganda. Uganda cannot therefore afford to repeat the mistakes of the past, mistakes which proved so ruinous to our economy. I hope there are MPs in this room. I cannot stress strongly enough that it will be possible, that it will only be possible to reduce bank lending in a financially sustainable manner if banks can lower their operating costs. Bringing down operating costs will almost certainly entail greater use of innovative technologies, including IT, to deliver banking services. A major shift towards digital or electronic banking is already underway worldwide, as we will be discussing in the session on the digital financial revolution later this morning. The adoption of mobile and online banking, together with smart ATMs, will help to reduce banking costs, although unfortunately that will also mean lower employment of human beings in the banking industry. As they adopt electronic banking technologies, key challenges for banks will be to ensure that these new technologies can deliver the same quality of services and access to services for their customers as the more traditional technologies, and that the risks entailed in electronic banking are fully understood and can be managed quite effectively. In particular, banks must ensure that their electronic systems can be safeguarded against cyber attacks, both protect the integrity of individual customers' accounts and present threats to the financial safety of the bank itself. The adoption of electronic banking has implications for bank regulation and bank supervision, which in Uganda has traditionally focused in commercial banks' management of credit risk. In the future, operational risks rising from electronic banking are more likely to become of greater significance to bank supervision as potential threats to the financial soundness of banks and their ability to command the confidence of their customers in their work. Bank regulators need to strengthen their capacities for monitoring the monitoring the security of banks and their IT systems. I hope that we can learn more about these things later today. To conclude, I believe that the future of the banking industry in Uganda is very bright. In terms of productivity, the adoption of international best practices and its use of modern technology, banking is one of the leading industries in Uganda. Banking also operates in a microeconomic and prudential regulatory environment which provides scope for investment and innovation, while at the same time safeguarding the interests of depositors and the safety and soundness of the financial system. And contrary to what you are seeing on the social media, I can emphasize that this principle lies behind Bank of Uganda's financial supervision. Consequently, I'm confident that banks will be able most successfully to meet the challenges that they face, and in doing so, continue to contribute to the development of the Ugandan economy. Finally, I would like to wish you all the best for the rest of this conference and particularly thank the Vice President for honoring us today. Thank you for listening to me. I am deeply sorry I forgot to do what was an important part of my standing up, namely to invite the Honorable His Excellency Vice President to come up and address us.
The Governor of Uganda, the Principal Judge, Honorable Members of Parliament of Uganda, the Chairman, Uganda Bankers Association, the keynote speaker, former Governor Bank of Kenya, all of you bankers, invited guests, ladies and gentlemen. I warmly welcome all of you and thank the Uganda Bankers Association for graciously inviting me to speak at the inaugural Annual Bankers Conference 2017. I congratulate the Minister of Finance, Planning, Economic Development, and the Governor Bank of Uganda, who preside over the finance sector, for their stewardship of a stable and a conducive environment that enables the finance and banking sector to operate smoothly. The significance of the finance and banking sector as the primary medium for transmission of monetary policy, as well as being the custodian and lender of money, cannot be underestimated. I'm therefore pleased to note that the banking system in Uganda, which dominates the financial sector, is fundamentally sound and resilient thanks to the sound macroeconomic management and regulatory oversight roles undertaken by the central bank. of this conference, quote, "The future of banking," closing quote, is even more exciting considering the numerous changes driven by the technology, globalization, and the demographics happening all over the world. The theme is relevant and most appropriate at a time when financial institutions must re-examine their operations in order to cope with the fast-paced changes and also align their services to the National Development Agenda under the second National Development Plan that is anchored on Vision 2040. Ladies and gentlemen, I would like to reaffirm the commitment of the government of Uganda in ensuring sound economic policies that will support the financial and banking sector to flourish. Government has, through regulation, legislation, and policies, put in place a framework for growth and deepening of financial sector. I therefore call for the vibrant participation, support, and collaboration from private sector players and our development partners to add their weight to this process of financial sector development. I also take this opportunity to appeal to financial sector players to ensure that their services reach the unbanked, especially the rural setting. I equally request the banking sector to find innovative ways of availing appropriate financing for private sector players with long-term investments and projects. You should also address yourselves to increasing the appetite for lending to the agricultural sector, which employs the majority of the Ugandan public. I would like to conclude by saluting Professor Njuguna S. Ndungu, former governor of the Central Bank of Guinea, for accepting to participate in this conference and gracing it as a keynote speaker. The works of Professor Ndungu are well summarized in the profile, and I'm confident you will share with us several useful insights. Again, commend Uganda Bankers Association and their constituent members and other stakeholders for organizing this conference, and wish you all fruitful deliberations. It is now my pleasure and honor to declare the annual Bankers Conference 2017 officially open. Thank you. God and my part.
once again to thank His Excellency the Vice President for his generous presence and for accepting to stay with us a bit longer. And at this juncture, may I invite Japheth Kato, the Chairman of Stanbic Bank, to introduce our keynote speaker. Sorry, Thias. I do apologize.
Thank you, MC. I think I would like to correct, I'm not the chairman of Stanbic. Your Excellency, the Vice President, the Governor of the Central Bank, Professor Emmanuel Mchebide, colleagues, distinguished guests, ladies and gentlemen, my name is Thias Katamba. I'm the Managing Director of Housing Finance Bank. And mine is a single job to do to introduce our keynote speaker today. I think, following on very well from the remarks of the Governor, if I could just make a statement that electronic banking presents new risks when past supervision has focused on credit risks. The future will be challenged with looking at electronic banking and its risks. Professor Njuguna almost single-handedly took the lead in opening the way for electronic banking to happen in this part of the world, and where East Africa is today, I think is very, very evident, leading in the global payment space, especially in mobile. Professor Njuguna S. Ndungu is an economist, university professor and researcher. He's the former governor of the Central Bank of Kenya, a position he occupied for 2 consecutive 4-year terms from March 2007 until March 2015. Currently, he is a member of the Brookings Africa Growth Initiative, Distinguished Advisory Group, and a member of the Advisory Committee of the Alliance for Financial Inclusion. His recent contributions to the public policy is in the area of transformative technology in Africa to create a better environment for game-changing innovations and entrepreneurship. Professor Ndungu became the first governor in Kenya to complete 2 terms since the law was put in place in 1982. Prior to this appointment, he was the director of training at the African Economic Research Consortium, a capacity building network in Africa in economic policy and analytical capacity. He has taught economics at the University of Nairobi, has worked with the International Development Research Center, IDRC, and at the Kenya Institute of Public Policy Research and Analysis, a government think tank. Professor Ndungu, as principal researcher, led the team to develop a macro model for Kenya in 2001, which has since been used as a training tool by most countries in Eastern and Southern Africa. He has been a member of various regulatory boards in the financial sector in Kenya. He has been a member of the National Economic and Social Council and Advisory Committee of the Government and Kenya's Vision 2030 Delivery Secretariat. He was the founding chair of the steering committee of the Alliance for Financial Inclusion, based in Bangkok, Thailand, from 2009 until September 2012. The Alliance for Financial Inclusion was formed in 2009 to promote financial inclusion in Africa, Asia, and Latin America. He was also chair of the African Mobile Phone Financial Services Policy Initiative, a network of AFI that promotes financial inclusion in Africa via the mobile phone financial services. He has been a member of the Committee of 10, C10, comprised of 5 African finance ministers and 5 central bank governors representing the 5 regions of Africa. This committee, formed during the global financial crisis, was mandated to look into ways of mitigating the crisis through appropriate policy response, communicating and coordinating Africa's response and required global reforms, especially in the world's financial architecture. Professor Njuguna is a researcher on trainer in various fields of economics. He has published in journals and chapters in volumes inflation, exchange rate, economic growth, and poverty reduction. He holds a PhD in economics from the Gothenburg University in Sweden, a bachelor's and master's in economics from the University of Nairobi, and is an associate professor of economics from the University of Nairobi. In recognition of his role in national economic development, His Excellency the President of the Republic of Kenya conferred the award First Class of Chief of the Order of the Burning Spear on Professor Ndungu in 2009. Ladies and gentlemen, please join me in welcoming Professor Ndungu to the conference.
Thank you very much, and good morning, everyone. Let me start by thanking His Excellency the Vice President of the Republic of Uganda for gracing this occasion. Let me also thank the Uganda Bank Association for inviting me, led by the Chairman and the Chief Executive of the Uganda Bank Association and all the members, executive members of the Uganda Bank Association. I also thank my comrade and colleague from the Bank of Uganda, Governor, Professor Emmanuel Mtebile, and his Deputy Governor, Louis Kasekende, whom we have come from far in this research and capacity building in Africa. And me also thank the executives of the banks of Uganda. I'm very happy to be back to Uganda, but today I'm not going to talk about M-Pesa. I'm going to talk about the subject matter of the future of banking in East African community. I'm very happy that I'm here. And let me make a few comments just before I go into my presentation. And then you'll realize that I have a presentation, not a speech. So it means that I'm still transitioning from central banking and into my previous area, where I perhaps show slides and wave my hands and try to drive points home. This is transition. Some people ask me what's happening since I retired, and I said that we don't retire, we actually change clients. So you can see where I am now. But the beauty of it is I've been invited by the Uganda Bank Association to talk about the future of banking for the East African community. And I was thinking about it and asking myself, am I really qualified to talk about banking? Then I asked myself, I'm not really going to talk about banking. I'm actually going to talk about the trends that we are likely to see. And I thought that coming from policy making, the most important thing for me is actually to talk about financial inclusion. Financial inclusion as a public policy. And because we really look at it in terms of this should be the central bank, should be the Bank of Uganda, should be the Minister of Finance, should be the government to promote financial inclusion. I just actually then came to the conclusion that once you succeed in financial inclusion, it affects the regulator, and it also affects the regulated. And it's so interesting, so that that kind of effect actually has its own endogeneity or endogenous drive. So let me start with public policy. Financial inclusion is public policy. Okay. Oh. I just wanted to make a few remarks just to introduce the matter, but I think this keeps on technology should not. You have lost it. Anyway, I'll continue while he's looking for it. Let me start with the regulator. Once you succeed in financial inclusion, which is public policy, and public policy here is actually a policy that is going to lead to poverty reduction. One of the things we have known and we have seen, and there is mounting evidence to show that, is that financial inclusion is actually supporting reduction in poverty sustainably, or poverty reduction sustainably, because it helps in terms of savings and savings culture that also introduces savings investment cycles that are quite enhancing. The second aspect is that it allows, for us to lay huge emphasis on the financial inclusion, because for the regulator, it helps in terms of regulating the financial markets. But more important, it creates demand to complete the financial infrastructure. So once you succeed in financial inclusion, the regulator has to complete the financial infrastructure. Here, we can come up with examples. We have seen all of a sudden we have deposit protection, very effective deposit protection insurance mechanisms. We have seen information capital being developed. And we have seen also institutions coming up to protect the market and also to guide the market, consumer protection, competition law. All those are aspects of completeness of the financial infrastructure. And for us, that is extremely positive, especially from the regulator point of view. And the third aspect of that, of the regulator, the third aspect is actually it improves monetary policy making. It's not long ago when we met here in Kampala as governors of central banks in East Africa, and we decided to come up and formulate a new framework for monetary policy. Because we are moving into, should I say, forward-looking aspects of monetary policy. Why? It is because of the success of financial inclusion. If financial inclusion is succeeding, then it means that monetary policy signals are being felt in the market more easily. I'm going to show you examples, especially coming from Kenya, that once financial inclusion succeeds, then you find that currency outside the banking system declines. Then ferocity also declines. And the money multiplier because financial innovation increases. So it means that you have to change the monetary policy framework, which is going to help you in terms of the appropriate signals. And that's why when my elder brother and friend, Governor Emmanuel, kept on talking about don't cap interest rate, he's actually saying don't limit transmission mechanism because it's going to take place in interest rates. I'm going to talk about that later. That is so interesting for the regulator. The other side of the regulated, that is the banks, is that it becomes even more interesting. It gives financial success, financial inclusion gives commercial banks capacity to intermediate. Most of the time, banks remain small because they are not attracting enough deposits to give them power and capacity to intermediate in the market. And we have seen that once you come up with efficient platforms to allow deposit and to reach out to the population, then you increase your capacity to intermediate. And I'm going to give examples from Kenya and also from other countries where possible. The second dimension of it is that it allows endogenous development in the banking system themselves. This means that they are able to roll out products, models, sustainable models, support all sectors of the economy. And this is a good example for me because I'm giving these broad examples so that once I start with my presentation, you can see where I'm coming from. Every public policy, the politicians will tell us, agriculture is the mainstay of the economy, but banks are not lending to agriculture. The next day, SMEs are important to this economy. They are going to provide employment and all that, not relating to SMEs. But once you succeed in financial inclusion, you do not have directives in terms of which sector to raid. You can actually come up with different products with different characteristics for particular sectors of the economy. And they are going to be sustainable because they are going to be provided on the platform of financial inclusion. And we have seen this here. We have so many examples that have come up. They are showing that it can work. You don't have to have a direct policy. You can only have the success of financial inclusion, and that efficient platform will help us to do that. And finally, and this is important, and the governor alluded to it, banks must find ways of reducing cost so that we reduce the unit cost of business. It can only be done if we discover financial inclusion and if we discover platforms in financial inclusion that are going to work. And this is where, when I look at the other aspects of the program, we are going to be talking about digital revolution. For me, I'm going to call it digital financial services platform. It has been shown that it is more efficient. It helps you reduce cost. It helps you reduce, or it helps the bank in terms of building this monitoring and screening infrastructure more easily. It helps the regulator even to monitor what is happening in the financial system. So essentially, since it has come of age, I can talk about it now. A few years ago, whenever I visited Uganda, I stopped mentioning M-Pesa because it was actually too hostile from the banks. When I mentioned M-Pesa, because they said, don't bring us that disruptive element. We are not going to allow telecoms to participate in the banking sector. I would actually say, no, they don't participate. It's a different matter, it's the backbone of transmission, but nobody would do that. But at least because I'm from the region, it was always a friendly encounter. But I've gone to other countries like Cameroon and Nigeria, and they become very brutal. No, we don't want to hear about that M-Pesa. It's a disruptive element. It is not a disruptive element. It's now what we are calling digital financial services platform. It's a technological platform that allows you to provide services cost effectively. And if that is the case, then the banks can improve their intermediation capacity, the banks can reach out, and also it allows the banks to develop platforms, products, and even models that are sustainable for any sector of the economy. And I'll give examples. That is a summary of what I'm going to talk about. And that's what I was mandated to do by the Uganda Bankers Association. What I'm going to do is provide examples along the lines that I've talked about. And it's already moved. Or is it me who has moved? How do you get it back? Technology. Okay. Let me talk about coverage because it's more important for me to actually deal with the coverage. I wanted, first of all, to talk about the future of banking. I've introduced the subject matter, but I'm going to talk about a few areas, a few issues that are very pertinent. The second thing is that I want to talk about what is the impact of ICT as we see it, the emerging digital financial services platform. And then I want to deal with emerging issues 1 and 2. One of them is the DFS and Kenya's M-Pesa, which I'll show the 4 endogenous stages that I call the frontier of digital financial services. And by the way, it's not only finance that digital revolution is affecting. I think I'm revising some works with the IMF. We've been talking about digitization affecting public finance, public policy, fiscal policy designs, and even revenue administration. And it clearly shows that actually once you succeed in the digitization process, you can actually apply across sectors. So the changes in fiscal reforms, tax designs, and even payments platforms, even revenue administration that avoids all the leakage of revenue is becoming very, very important. So essentially, we can talk about it here from the bankers and banking services point of view, but you know that it is really applicable across sectors and has been very, very important. And of course, finally, I was told to talk about my experiences of the central bank, and I was actually sharing about but I thought I would say a few things which are interesting and along the lines that we've talked. Anyway, having done that, we talk about the future of banking in the East African community. One of the remarks is that we have to really emphasize financial inclusion. Banks are the agents. We have tried. The banks were always there. But when we realized that the banks were not reaching some sectors of the economy, we even introduced microfinance. We even went further and even legalized SACCOs. But what was the motive? What was the objective? The objective was actually to succeed in financial inclusion. But we have seen it can work, and we have seen that things work very well. But we also have to recognize we are living in, for example, the Kenya and Uganda economies, and even the East African economies are almost similar. We have a rural-based economy. We have segmented markets, and segments of the market work from because of different characteristics. We have segmentation in the market. One of them is distance. The other one is actually income levels. So essentially, the poor are very sensitive to financial services, not only in terms of those services, but in terms of how they are delivered. You have to make sure that if you want poor, unfortunately, financial inclusion is still defined in terms of accessibility. The only indicator of accessibility is people opening bank accounts. And that is, of course, something that may change in future, but it's still most important. So, but you find that the poor are very sensitive to that. But also, the poor are also very, very important in terms of financial inclusion. Participate in that ecosystem very well once they find a way. So for us, it's very, very important in terms of what kind of services do we deliver and how do we deliver those services. And the third point I wanted to make is about financial inclusion, because I talked about the banks increasing intermediation. We do know that why banks have remained, and this is Governor Emmanuel talked about, banks have remained small, is because we have less participants in the banking sector. They're not coming in to save. So essentially, how do you advertise them? And one of them is actually trying to come up with an efficient platform to do that. And for me, that becomes very, very important. So I wanted just to lay out those points in terms of the future of the banking sector so that we can actually ask ourselves, then what do we need to do? What kind of mechanism, what kind of instruments do we need to employ so that we introduce or we bring in financial inclusion? But of course, this is also something that, from my point of view and my experience as the governor of the central bank, you also have to allow, from a regulatory point of view, you have to be innovative in terms of your regulatory capacity and regulatory capability. You have to drive the market if the market is unwilling to go into those areas that they believe are uncharted. You have to help in terms of reducing the risk in those areas, and that becomes very, very important. Let me talk about the role of financial inclusion. But this is I have to get my presentation. That one is very far. This is the subject matter of financial inclusion is still important for us. But even though we know about it, I thought I would emphasize. But the most important thing I wanted to come from the angle of inclusive growth. Everybody talks about we want inclusive growth. But how does inclusive growth work? In fact, the most important aspect of inclusive growth is actually is actually accessibility of markets. But financial markets are very, very important because they allow savers. If the regulator promises a safe haven for their savings, they allow savers or even to save and invest. And we have seen even data is coming up from FSD, financial sector deepening networks across Africa. We have FSD Uganda, FSD Kenya, and even we have FSD in all the countries. We have seen data coming from those services, like financial diaries, is that the poor would like to save, but we need to give them instruments of saving. We need to protect their savings. And they are very, very efficient savers, and they are very, very efficient in savings investment cycles. But of course, also on the other hand, banks will need those deposits to increase their capacity to intermediate. So essentially, we know that financial inclusion initiatives will provide this accessibility. They will be efficient in terms of how they perform their businesses in the market, and we have to come up with effective financial services platforms that help them. And that is why when we talk about DFS, the subject matter that we are going to introduce later, and is going to be a subject in this conference, it is going to be the digital financial services platform is going to be a very efficient platform that has provided a revolution, but more importantly, it has solved the problems that we have seen in the financial system for many years. The fiscal distance, the unit costs are so high. So how do you reduce the unit cost? It's because you increase participants on both sides, and of course, it is going to solve that problem, and importantly, it's going to reach the targeted market. Every bank has its own market niche, but how it reaches that market niche depends on the instruments that it's going to use, depends on the products it's going to roll out, and that is where it becomes very, very important. And so we do know at the end of the day, financial inclusion is going to lead to financial development. For many years in Kenya, once financial inclusion was succeeding, we managed to move very fast in terms of financial inclusion. We noticed that financial sector growth was actually pulling the economy with it. And that was very, very important. The moment financial sector was growing around 9%, the economy grew by about 7%. When it dipped just because of the crisis that we've had time and time again, so the economy, the overall economic growth also dipped. Essentially, we know that financial inclusion is going to lead to financial growth, and is going to lead to financial development, and that is going to pull the economy with it. For us, that is very important. But then, of course, those are important areas of knowledge, and I just emphasize them. One of them is that in countries in Africa where financial inclusion has succeeded, we have seen that it has created an endogenous demand to complete the financial infrastructure. And this is a point I've emphasized. And you're going to see a clause. All of a sudden, we didn't have, in most countries in Africa, we didn't have deposit insurance. We did not have information capital sharing. Banks always suffered because of this information asymmetry that we have talked about for many years. Customers in the bank are moral hazard. They hide information. The banks, because they are not so sure about the information that you are hiding, apply adverse selection. And it can produce a low equilibrium trap in terms of deposits or in terms of market participation. So essentially, completeness of financial infrastructure is very important. And of course, it increases, as I said before, the endogenous demand for regulatory reforms. We want reforms that are going to support each sector of the market. We want the financial sector to respond to financial inclusion space. And we have seen this working, and especially in East Africa. And commercial banks have invested very heavily in terms of serving their markets, monitoring and screening. And even they have become competitive in their area. They are going to be more enhanced by the digital financial services. So essentially, we've seen that. But one important aspect that I'm going to emphasize is that digital financial services, because of completeness in terms of monitoring and how easy it is to get information, it has allowed us actually to solve the collateral problem that we find in most economies. The collateral process is the most expensive. Why interest rates remain high is because of the collateral process. If we change the technology in use in most countries, then obviously we're going to help in terms of moving into the next level. Now, having established that, maybe the best thing is I talk about the emerging issues, and especially I want to just make 3 points that I can elaborate using examples. First, we have come to accept information technology. It's helping us to solve so many of the problems, and especially in financial markets. We have come to accept that digital financial services platform is important for financial services. It's important for reaching out the market niche that you have developed. It's important in terms of regulating the market that you're targeting. So you say, in a sense, it is going to provide an effective and efficient and even safe and transparent technological platform for banks to operate in. And when we have come up with transactions platform, those transactions are in real time. And that is very, very important for small savers. and the poor, that they don't have to take a trip to the bank for transactions or checking their balances. By the way, most of the poor will go to a bank to check their balances. And then it is after checking their balances that they consult financial needs they had. Just imagine if you give them a platform that they don't have to travel to the bank. I always emphasize that in Africa, a trip to the bank is very, very expensive, both in terms of time and even cost. The second point I'm making on this is that the financial services platform will supply an infinite possibility to roll out sustainable business models or financial products for banks and even for all sectors of the market. I will give examples. For example, M-Copper has come to this country. It started in Kenya. You can actually supply solar power using the mobile phone services platform. The other day, I was talking to the media in Kenya about 1 acre fund. It is working. And there are so many examples. So essentially, the moment it's there, then the fintechs with us can have products that are going to target specific markets with very, very important outcomes. And of course, as I said, the digital financial services program will bring more participants. It will bring unit costs down. So financial services will be affordable. And now, of course, it is going to lead to financial development, which for us is very, very important. And to show those examples, just to elaborate on those 3 points that I've made, I'll talk about first, we have seen retail payments and settlements. We always have the big, should I say, payment systems, RTGS, electronic funds transfer. Even in Kenya, between government and the central bank, we have the GPay system. Those ones were never in doubt, but we never had retail payments. We never had, if you wanted to transact, you have to go to the bank. I still recall one of the examples I always give. In 1991, I wanted to pay someone in Mombasa. And so what he did was to give me his account number and his bank. So I went to his bank in Nairobi and said that I want to transfer the money to a branch and person in Mombasa. And I deposited the money in his name. It took 3 weeks for the money to get there. I understand the inefficiency, and this was a multinational bank. If it was a domestic bank, I could have discounted it by a week. But now I could not understand. I still believed that was not proper. More recently, I used to teach at the University of Nairobi, and my branch was like 3 streets away, and I would pass several branches of the same bank, but if I entered there, they could not recognize me. So I have to go to my bank, and then there's a notebook they check, then they check, update my balances, then they check, and then decide, and then I decide how much to withdraw. You can imagine, it would take me half a day, half a morning to actually do that. Walk to the bank, and also. So essentially, we have seen all those have problems that are coming back with us. But if I wanted to transact, I have to go all the way. But then, because we cannot always manage those trips, we always transact cash. It was safe or effective that time. But it's only that you have to be physically present to present the cash. So essentially, that was where the need for retail payments came in. And that is where M-Pesa came in, became a hit. Because essentially, you didn't have to move from point A to point B. The second one is that it has enabled, it has become important that you can actually provide services at the doorstep. Now, show you data coming from survey. It is becoming very, very important. And if you have a retail payment system and the financial inclusion is enabled, then the combination of these two is a game-changing environment for African savers. And because there are so many recent works, let me give you examples of recent work by McKinsey report 2016. It has shown that digital financial services has the potential to provide access to financial services to about 1.6 billion people in emerging and developing economies. It will increase the volumes of loans extended to individuals and businesses by $2.1 trillion. You can imagine how banks can thrive or can flourish in that environment. And finally, it will allow government to save up to 110 billion per year by reducing leakage in spending and even tax revenues. It's something that I talked about, that I've been participating in terms of how digitization has helped banks. So there's massive evidence that is emerging, and I'm sure you have examples from Uganda which are showing that the digital revolution is producing fundamental changes, not only in terms of public policy, but also in terms of pushing the frontier of financial inclusion. And we have seen that, and let me talk about the emerging issues that I've seen, and especially digital financial services as a platform for financial service, as a platform for financial inclusion. And first is because accessibility is much easier, and second because commercial banks, microfinance, have been provided with a ready platform to manage micro accounts. Remember those days we had minimum balances, and I remember when in Kenya, the minimum balance from my bank, which will remain unnamed for many years, it was actually much higher than the per capita income. And you can imagine a lecture at the University of Nairobi. It's what we defined as, we were always defined as middle class. And middle class in our definition was that you are bouncing on what is it? The poverty line. So that most of the time so you can imagine if a bank is holding so much money, minimum balance, it became a very pervasive barrier to enter in the banking system because you can't stay there. I remember one time when I took leave and I asked my bank, what do I do? Because I don't want to close my account. And the manager told me that you can be sending some money so that it can be supporting the ledger fees. Because once the ledger fees encroaches the minimum balance, it becomes penalties, you can imagine. Then I asked, what kind of manager are you that you want me to be spending money to support ledger fees? And do I need this account? So today, if I ask that, if I ask the manager of a bank here, he would say that that guy was not very clever, because that was not a very good response. But anyway, that's where we have come from. And we can talk about that 10 years down the line. We can now talk about it because it cannot happen. The generation right now cannot even understand how it can happen. So essentially, you can see that the banks didn't have technology to manage small accounts. I call them micro accounts, all micro deposits. They didn't have that technology. But all of a sudden, DFS has given them the technology to manage those micro accounts, and that this has lowered the transactions cost. And for me, that is very, very important. And that's the point of making. A trip to the bank is very, very expensive in Africa. And we feel that it is in Africa. The other day I was talking to my friends from Papua New Guinea, and they say that if you want to go and see your manager, it may take you 3 days. Rural point in Papua New Guinea. So you can imagine it is not only in Africa. And finally, fourth, I want to make a point that SMEs and households have really been saved. You know, politicians and public policy makers, rightly and with very good intention, always come and tell us, please support SMEs. But we didn't have the technology to know who are the SMEs and how do we support them. Most of the time in Kenya, you find that you have a household sector that is taking most of the runs. Why? It's because supporting the SMEs that don't have corporate identity. So in a sense, the households are borrowing on behalf of SMEs. It is not because they're refusing to be formal. No, it's because it's too costly to be formal. And that is why we have to come up with better mechanisms to support them. It's, in a sense, if you support SMEs in terms of their transactions and accessibility to financial services, ease of transactions, then because SMEs and households are transactions heavy, you are really going to encourage them to come to the form of financial services. I talk about transactions because if the mobile phone platform has allowed us to come up with a retail transactions platform, it means that it's formal, you can monitor it. It is in the bank account. And it's very, very important. So the fourth one here is that we have seen platforms for virtual savings and virtual credit supply. And that is very, very important in terms of application. But the other thing is that these banks I had a big fight with the Kenyan bank. All of them, big banks. And M-Pesa was introduced because they thought M-Pesa was going to compete with their small depositors. And I told them, no, you are going to serve them 24 hours a day and 7 days a week. So you are going to earn ledger fees 24/7. And they couldn't believe it until I demonstrated, and then they understood. That was part of the banks, domestic banks, but the others, a different ball game, because the fight continued until one had to win, and the central bank won. Now, let me go to the second aspect of emerging issues. And one of them is that financial inclusion will facilitate the process of financial development and inclusive growth. All of us here would like to see growth, vibrancy. Economic activity is very important because it allows even banks to thrive. It provides banks with infinite opportunities for investments. And that is where the banks actually thrive, because if the economy is growing, if the economic activity is not vibrant, then of course there are no opportunities for investment. It is the opportunities for investment that allows banks to thrive. And once the economy has embraced digitization, it becomes easier to focus on the structure of markets and look at different markets in terms of what they need. And financial inclusion for households, SMEs, and even all sectors of the economy is going to work. And I've given some 6 about what DFS has demonstrated for Kenya, but I don't have to go through them. But the most important thing that I've always emphasized is that we have, when I was governor of the central bank, I noticed that strong banks emerged. And they started serving in the East African community. We had over 300 branches of Kenyan banks in the East African region. But they were not coming in as, most of them were not coming in as new banks. They were buying equity into existing banks in the East African region. So they were strengthening banks in the local countries, in the host countries. And for me, that was very, very important. When you have strong banks, they can weather shocks. When you have strong banks, they are going to serve their market niche more effectively. For me, that is very, very important. And because I was defending Kenya in the FATF, Financial Action Task Force, when we were almost we were in the gray list, we were almost in the bad corners. When I went to defend Kenya in FATF, I argued that it is the digital financial services that is allowing us to improve our monitoring system. So it's going to improve our AML CFT regime. And this is something that I do believe works, is working very well. So essentially, so many advantages. So individual banks, this model can be adapted and has been replicated in several countries. And individual banks need to invest. And that is where we miss the point, that banks have to invest on that platform. And that platform, once you invest in that platform, then it is versatile enough to give you control and even capacity to grow in the market. And because I started by saying that I don't like talking about M-Pesa because I was facing a very hostile environment. Now it is that M-Pesa was actually an instrument of financial inclusion. In fact, in some circuits, I actually say that this is the tail that wagged the dog. And why do I say that? There are 4 stages to it. In fact, the first stage is where big fights came in, because that's where the retail platform, transfer of money. And that's why everybody was saying, why are you allowing telecoms to come into the market? Telecoms were never in the market. Telecoms reformed the transmission backbone. What has happened in Africa? We have come, the government has invested very heavily in fiber optic cables. So essentially, it has given us massive capacity to pull down or to benefit from fiber optics. So telecoms have massive capacity. So telling the telecom to come up and partner with to develop money transfer system is a small aspect of capacity. They have massive capacity. So the first stage was money transfer. And this stage is where we fought so hard. This is the stage where we support the small savers. You don't have to have a bank account. You only needed a phone number. And that allows you to participate in the financial system. Somebody told me that we are allowing the telecoms. I said, no. What did we do before that? When I wanted to send money, my mother was in the rural areas. When I wanted to send money to her, there was no other way except take one of my domestic workers, give her some money for bus. She got into the bus with an envelope, which I tell her, this is money, go and take it to my mother. She take the whole thing. Then come back in the evening, I've delivered, they are going to buy the things you wanted. What has happened? Same structure. It's only what has changed is that the domestic work has been replaced by my mobile phone. And the bus has been replaced by the telco, isn't it? The bus is so efficient. The turnaround time is 5 seconds. That's what we wanted. So the telecoms are not listening. The telecom is carrying that bus to my mother, but it doesn't know what it is carrying. It cannot even open. So the telecoms are not participating. They are just a backbone of transmission. And that is the difference we try to emphasize. Because that stage has been passed, we can go to the second stage where the telcos, where the banks started investing heavily to use the same platform for transactions to develop virtual savings account. If you have a phone number, you can still move money from the mobile SIM card to a savings account in the bank without visiting the bank. And that is the virtual savings account. The third stage, which I liked most, and this one we were really pushed very hard. The second and third stage we were pushed very hard. In fact, Bill Gates himself even put in some money to support this process, because he used to tell me that it's not changing people's lives, because just transferring the money you have, not saving. Savings will help you change your life. So the third stage was very important because they used the transactions data and the savings data to generate credit scores so that they can use it to price short-term credit. And today, short-term credit is very, very interesting. It works so well. In the meeting, a group of people came and told me that they were listening to the governor of the Central Bank of Kenya trying to describe how payments are working. And they get concerned, they can even monitor money laundering. But then they got concerned that at a particular time in the night, in 2 locations, there is massive movement of funds, borrowing and banking. And then I asked which period, which locations, and they explained to me, and I told them that is where vegetables markets clear. Because they deliver them around 2 in the morning, and the market is clearing around 5, you don't have to call the police to investigate money laundering. It is just simple traders are clearing. Come with your lorry road of vegetables. Somebody is waiting to buy wholesale. We're going to buy to sell. They can't carry money around that time, so using the mobile phone. So that's why I talked about sustainable business models. They can be rolled out. And fourth stage is very, very important. We have seen cross-border payments. We have seen Western Union combined with Safaricom so that if you send remittances from the US, you don't have to go to the bank and queue. It comes straight to your mobile phone. We have seen Tigo Pesa between Tanzania and Rwanda working very well. It has allowed the central banks in East Africa to come up with the East African payment system. All of a sudden, that's the fourth stage. So we have moved from M-Pesa, which was known as a disruptor, to an endogenous frontier of financial inclusion. And for me, it is very, very important. What we have seen is that regulatory capacity, the reforms in regulation, and even capacity has been very important catalyst to this evolution. Banks in East Africa, regulators in East Africa have really worked so hard. So those are the issues that I wanted to bring first to you. But because sometimes we can talk, as living to my professional life, I still provide evidence. And one of the I want to show is that look at the bank accounts, how they have increased. For me, it is interesting. I started as the central bank in 2007. The accounts were about 4.3 or 4.12 for the micro accounts and 0.69 for other accounts. As you can see now we are over 45 million accounts by the time I left the central bank. Deposit accounts. You can go into assets in the banking sector, you can go into loans, and they're all working in the same direction. Very interesting. Then the next one is, what is the totality of financial inclusion in Kenya? Is the success story, and we have data, survey data. Thanks FSD has come, I'm sure FSD Uganda and my sister Jack will continue this good job. By the way, you know, when we were teaching, including Louis and Governor Mtegire, we had problems with data. I looked at one survey data and asked PhD students, you can write your PhD in a very short time because massive data, but also very interesting ideas coming up. In fact, that's why I'm talking with the Uganda Bankers Association, and I'm sure there are representation from other bankers associations like from Kenya. They have research departments to help this in terms of driving policy, but also the students that are coming up from our universities have massive data. So essentially, you can see that I can summarize data for 4 years, and I'm sure there is data in Uganda, but the Kenyan case was very good in terms of looking at 2006 and where we are 10 years after. Massive developments. And even comparing with where Kenya is in relation to the region, and Uganda is not very far. So essentially, we have been moving in the same direction in terms of financial inclusion, even at the regional comparison. But what I like most is actually looking at financial services at the doorstep. And here, survey data that I have, 2013, compares different countries. But the most important thing is percentage of the population that is living within 5 kilometers of financial services. And you can see 76% in Kenya. Uganda is about 2%. The next indicator is about the number of financial access points that you have per 1,000. So the number of financial access points, Kenya is about 65,300, Uganda about 21,000. And you can see we can increase this. And this has been increased because of 2 dimensions. One, the agents of mobile digital financial services, and 2, the microfinance, and 3, the agencies of agency banking. And the third one is actually financial access points per 1,000 people, 100,000 people. And you can see 161 in Kenya, 61.9, and 63 for Uganda. So this is an aspect that we can actually shape up. So improving or bringing services to the doorstep. And because I have my colleagues from the Bank of Uganda, it's always good to show how does monetary policy work. Is monetary policy improved? And one of them is declining velocity and rising money multiplier. And this is interesting because we had a big fight with my friends from the IMF, because we always had that this the framework that we used then was that you assume that ferocity is constant and the money multiplier is constant, so it means that you can target base money, and you know that the relationship between base money and broad money is constant, so it means that you can influence base money, that in that way you are going to influence broad money. But then, all of a sudden, I came up with the conclusion that it is obsolete. It's not working because of that picture. I lost a few friends, but now we have become my friends again. No problem, because this is empirically true. So you see how things are working. But why is velocity declining? Because we are changing the behavior of holding cash. Cash is not. It is. You know, the currency in circulation is changing. What is changing is cash outside the banking system. People are not using cash. They actually bring the cash back to the banking system. But the next one is even more interesting. Currency outside the banking system is declining, but it's also important to show what is happening to financial debt. So in a sense, when we say that monetary policy environment is improving in financial inclusion, we have indicators that show that direction. Anyway, I think we can debate all these things the whole day. Let me come to my, perhaps the one slide I was shy about, and it was about experiences as a banker, as a central banker. And you can imagine, it's very difficult to make a central banker out of an academia, somebody coming from academia. My friends still tell me today that I don't behave like a central banker. I still believe that I'm teaching. I'm sorry if I'm doing the same. So, but the point is this: I needed to convince everyone. That's why Kenya Bankers Association was always my close friends. But everybody thought it's because I want to find out what they are doing behind my back. No, I wasn't. We were actually had genuine issues that we can pick up together and come up with a solution. What are the successes? I thought the best thing is to look at the successes and the challenges. And from there we can pick up a few points. One of them is monetary policy design, as I've talked about. And Uganda led the way. We met here at Munyonyo to come up with new designs. And Governor Mutembe and Luik, they led the way. Of course, we had IMF backing the whole process. And it was very important that the East African community and central banks of the East African community are coming up with the same framework of monetary policy, which is forward-looking. And the most important thing is actually to anchor inflation expectations. Now, of course, financial inclusion, financial development, and even its vibrancy. The third one is that come up with buffers. The central bank can only come up with forex buffers to protect the market in time of shocks. And that was quite successful. At one time we had 7 months of import cover. And the East African community set up 6 months. I think the Kenyan one is 4 months. You can see that every bank, every central bank in the East African community had a very nice, buoyant foreign exchange buffer. In the Kenyan case, we went up to 7 months of import cover. But the development of strong institutions of the regulator was very important. I built a lot of capacity because of the nature of my background. I had to train so many people to come in. Even actually, we have a section of forecasting. And I think we have had quite a good support from other international bodies. But the strong institution of the regulator is very, very important. Strong banks, strong microfinance institutions. Of course, microfinance in Kenya are called microfinance banks. They went behind my back, the politicians, and such banks. Then I told them, the moment you call yourself banks, then you have to go into all the regulations of a bank. Cash ratio, liquidity requirement. Then they wanted to clear checks. Then I told them, we have check clearing system, which is we have to come up with a very expensive infrastructure. Then they started realizing the mistake they had done. But you see, they wanted to be called banks. So you find microfinance banks in Kenya instead of microfinance, deposit-taking microfinance. And completing the financial infrastructure is very, very important across these economies. Everywhere you turn is to have consumer protection. How much, suppose a bank collapses, how fast can you pay the depositors? This kind of indicators are there in developed countries, but they are also here with us because we have done those many things. Consumer literacy, financial literacy is very, very important. And of course, supporting government's growth and development agenda. And of course, I was introduced and said, oh, I finished 2 terms. Why is it a big deal? Of course, you know, it's a big deal in Kenya. Not because we are that by nature, but it's because, of course, there are so many problems. What happens is that, not that you're great, it's because you're doing a good job. So, we have completed 2 terms since 1982. Somehow, something happened. And I talked about that. One of the things I also forgot here, and it's the slide, is the long-term finance. Board market. I remember in 2001 when I was consulted about what we do with the board market. How can we develop the board market? First thing is we have to lengthen the maturity profiles of debt instruments. And when I joined the central bank, the first thing was we can use the board market to actually come up with infrastructure bonds with specific characteristics that they can finance government's public investment. And that allowed government institutions or trustees with healthy balance sheets to actually come up with their own infrastructure bonds. And that is why I got an award from the president of Chief of the Burning Spear because of spearheading infrastructure bonds. Actually, in the African Development Bank, the title was Innovative Domestic Resource Mobilization. And it became important even for African Development Bank. But what about the challenges? Supply-side driven inflation, we're familiar with it. And the central bank has only had demand-side tools. And obviously, you can purge the economy into recession if a serious shock is hitting you, you use the demand-side tools. And of course, why we have those shocks? Because we don't have adequate buffers. The rest of the government doesn't help the central bank in terms of coming up with adequate buffers. The Horn of Africa suffers from drought every 4 years. And when you have drought, it means that there will be food shortage, and it also means because we are dependent on hydroelectricity, it means that energy prices will rise. So a combination of high food prices, high energy prices, it's inflation, it is devastating, and you can see how things work. So essentially, we always called on ministries of agriculture, ministries of energy to come up with a buffer. Dominance of government in economies. I don't know, we never seem to understand this. But banks will come to me to tell me that there is a liquidity problem, we have a liquidity crisis. But essentially, if our governments don't pay suppliers and contractors for 2 weeks, or government doesn't spend for 2 weeks, you're going to have a liquidity crisis in the banking sector. And the medium-sized to small banks are the worst hit. If it continues more than 2 weeks, you ignite a recession. Those people who ask questions about Kenya, I always ask them, did you look at this and see what happened? It's the dominance of governments, and government, the economy is driven very much by government. And it's the peculiar nature. We never realized that was such important. And then the interest debate is always driven by a feeling that the bankers are brains. They are actually robbing you to declare profits. So the politicians think the best thing is to control the banks by capping interest because they are robbing you. Those are threats, but they are not real. I used to tell politicians in Kenya that if my bank declare a loss, it is telling me to move away from that bank, telling me to bolt very fast. So essentially, by very nature, banks will make this. Why? Because they are ready most of the time to the government. So let's not condemn them for declaring profits. Let's go back and look at our market structure and see how we can shape it up. And, I talked about threats of interest capping, the interest rate capping. I want to talk about it, but I thought I would talk about it differently. But these are threats. They are always there. And it happened. Those threats came during Kenya. And we are saying we need to come up with reasons why not to look at or to deal with or to take that route. But let me finish. Fiscal dominance in our economies, fiscal policies, they drive interest rates. And they rob the central banks, the instrument that monetary policy use. Or the monetary policy utilizes as an instrument. The final one is de-risking. And there is international and domestic de-risking. I thought this subject was very, very interesting and important. Because essentially, it is the one that can introduce interest rate capping differently. Let me talk about de-risking. So I said, instead of adding there, let me talk about de-risking. So that at least once we open up the debate, we can actually talk about what is really happening. The first time this term was used is when multinational banks were going from some particular markets and even cancelling correspondent banking. But the bottom line is that what we really may need to ask is de-risking. What is it? Is it defining resilience, or is it redefining risk in terms of risk management in Africa? The full information is not yet well established. But we do know that its full impact is not well evaluated. What we do know is that the immediate impact was on remittances, the cost of remittances, and even declining volume. And countries that depend very much on remittances, like Somalia, really suffered. But we do know that some of the multinational banks are also slow in our domestic economies. They are also slow to adopt domestic financial inclusion solutions. And others have fought them very viciously. And especially those banks that don't want to deal with retail banking, they don't see the benefit of that. But actually, we would like to show that they are positive. These domestic financial inclusion solutions are actually positive for everyone. But what we need to do is that what we would like to support is that we should provide confidence in terms of coming up with frontier regulatory issues using technology. And that is going to be very important because we will observe what the standard setting bodies are giving us. And that's why everybody talks about Basel, Basel 1, Basel 2, Basel 3. Everyone talks about the guidance by FATF. Essentially, if you come up with frontier regulatory considerations and where standard setting bodies, guidelines are being used, then we are going to include everyone. Multinational banks here because they are also relying on their parent in terms of defining what kind of products they should participate in. what kind of risk profile they should look at. It's not that they do not want to participate. It's only that they have reason to other aspects. But what about domestic de-risking? It's very dangerous in the financial market, because essentially this is where we have interest capping, and the banks are robbed of that ability to price risk. We argued, especially the late Sir Andrew Crockett argued during the global financial crisis in 2008 that there is a temptation because of the global financial crisis to actually introduce more regulation. But he argued that we don't need more regulation, we need better regulation. And this is what we should fight for, better regulation. And by the way, capping interest rates is not a regulation. It's actually registering control. We have suffered for many years in terms of financial repression. And Governor Mutebile pointed out that financial repression never built banks, never built the financial system. So we cannot go back to it. Then banks have built very strong monitoring screening infrastructure. They screen existing participants in the market and potential. Now, all that infrastructure goes to waste. Because what happens? So if there is interest capping, and I think Kenyan bankers who are here to answer that question, then you don't have to go looking for customers. Just buy government securities. End of the day, period. We are killing intermediation. Then all of that infrastructure that we invested will go to waste. It's good that the politicians have seen that in Kenya, and they are defining, I quote the president term, if capping interests had unintended consequences. So we can open up that, but maybe after some time we will try to understand what are the unintended consequences. We thought we are going to support SMEs. We thought we are going to support perhaps the agricultural sector. The point from this presentation I've done since I started is that if we have a better functioning financial system, it's going to provide solutions, that platform, which are sustainable. We don't want to come up with an SME fund and after 3 years it dies. We don't want to come up with agricultural credit guarantee system, which after 3 years it dies. It's not sustainable. We need a sustainable system. And the financial system and the private sector devise sustainable models for specific sectors, because they are going to define the specific characteristics of that sector, including the risk profile of that sector. And of course, this brutal here is that when you interest rate, you are going to condemn the economy into a low credit equilibrium trap. And because most of our economies are driven by private investments, or investments in general, but private investments are very, very important, we are going to condemn the economy into a low growth trap. Yesterday, I was talking to my colleagues from Bank of Uganda, and I argued that I need to fight with the IMF because our private sector credit growth was around 35.7, and the agreement was try to stay up around 33-34%, and the massive fight. I always say that they cannot overheat because we have massive capacity. But they say, no, we have agreed targets. Go back to the targets. So we will try very hard to go back to the targets, but the economic activity was so vibrant, so could not. Then yesterday, I think the data I had showed that private sector credit growth in Kenya has declined 3%. And then somebody last night from Bankers Association informed me, no, it has gone even further down to 2.1%. It means we are achieving the negative effects of interest rate capping. Monetary policy is probably the instrument it uses, that is the of interest, to seek monetary policy. And it means you cannot even have monetary policy. Today I sent to the governor an article, and I also sent to Rui an article that was produced in our papers showing that monetary policy in Kenya is becoming meaningless because it doesn't matter what you say or what you do, because essentially nobody is looking at the interest structure because it's capped. Finally, because I've talked for a long time and this is not my nature, and maybe because I've noticed that banking associations in East Africa, Kenya Bankers Association, Uganda Bankers Association, they are all coming up with very strong departments of research. I wanted just to show you the recent studies coming out from this area, in this area that on digital financial services. So essentially, they will help you in terms of arguing with the regulator and also trying to devise products. One of the most celebrated studies is by Kenyan Suri Tanit from MIT. It has shown that it has raised poverty, people from poverty below the poverty line 2%. But also, other studies that have shown that regulators themselves must encourage transformative technology. And also, how we cash in on that. Those studies are important, not only to shape the objective functions of individual commercial banks, but also good to have debate, dialogue with the regulator and the public sector in general. But I have liked it because so many people have come up with different dimensions to interpret the change that is taking place in developments. But more importantly, we can use it as the future of banking and to shape the future of banking in the African community. Thank you very much for listening to me, and sorry for having talks for so long.
I'd like to thank Professor and invite Jafet Kato to pass a vote of thanks for this address.
First of all, I would like to thank the organizers of this conference for giving me the honor of thanking the keynote speaker, and I'm really honored, and I'm going to do this very quickly. However, I cannot go without mentioning when the professor talked about sending money through people. I have had experience because I did that one time. I used to give people money to take, and it is my money that was always confiscated by customs. And on the bus, it is my money that was always stolen. But the other side of the picture, we used to have this excuse, Grandma, I cannot send you money until you see somebody trustworthy to bring it. We can no longer do that now because there is the trustworthy system. Distinguished ladies and gentlemen, all protocol observed, I want to believe that you share with me the conviction that there could not have been a more appropriate keynote speaker for this inaugural Bankers Conference than Professor Ndungu. He has shared with us the real issues confronted by us today, as well as insights on how to tackle them going forward. I'm going to say moving forward, I have bias towards Standard Bank. Bringing his rich experience and exposure to our disposal. The delivery was excellent, the knowledge was deep, the research was deep. Further research work for you to do has been put on the screen, and we're very, very grateful for that. Professor Ndungu, your years of research, your depth of understanding of finance and economics and banking sector, and your ability to present the subject in such an interesting way produced one of the most memorable days in our association's history. Your enthusiasm is contagious, and we hope to use your keynote address to define our future. Please accept our sincere appreciation for the outstanding presentation you have made to our first ever annual Bankers Conference, and request the audience to join me in saluting Professor Njuguna Ndungu. There is nothing free. These are bankers. Professor Ndungu, please consider adding Uganda Bankers Association to your annual speaking tour. You are always welcome at our conference. Asante sana, and thank you once again for your contribution. And I've got something small to you now. I don't know whether you still have to declare what what you receive, but I think it is within declarable limits, and please let me have the honor of presenting it to you. Where do we do it? Just on top? Okay. Up here? Okay, thank you.
Thank you very much. Ladies and gentlemen, there is a change to our program. What will happen right now will be upstanding for the anthems. His Excellency the Vice President will leave us, and he'll be accompanied by the Executive Committee of the Bankers Association. We'll stay in the room and start the first panel. What we've like to thank the hotel for organizing to bring the coffee to us. So when you feel like having a coffee, they're all up right behind you. That will allow us continue and finish on schedule at 1:30. So kindly be upstanding for the anthem of the East African Community and the national anthem of Uganda.
Twaomba unilinde Jumuiya Afrika Mashariki, tuwezeshe kuishi kwa amani, tutimize na malengo yetu. Jumuiya yetu sote tulilinde, tuajibike, tuimarike, umoja wetu ni nguzo yetu, jumuiya yetu.
settle the balance on the credit card and things like that. And through all of that information, the bank is building knowledge around this customer and therefore can tailor solutions for you. You can also learn that maybe you are in the business of finding a new home, and as you're driving around new estates coming up, the internet in your car can send messages to your bank, and then your bank can make a real-time offer to you. And when we speak about these things today, they sound like dreams, but these things will quickly come to us, and banks will take a leading role in educating and informing the customer about these things and working towards changing customer behavior.
That is interesting. Actually, anybody heard about Jumia Travel? It's an African product. Used it once to make a reservation for a hotel in Nairobi. And every time I visit or try to search for a hotel, Jumia Travel will come up as my #1 search engine optimization tool. And they now tell me there is a deal in Jinja because they've seen me search around Jinja, or there is a deal hotel in Kigali because they have seen the keyword Kigali. So what you're talking about is actually already happening. It's how do we integrate that to get to understand me as a user on the digital platform. Which brings me to Yoran from Gilat. Yeah. How do you pronounce it?
Gilat.
I don't want to be prosecuted for calling it different. Yeah. Telecom is changing the way we interface. You had the professor mention, the keynote speaker mentioned, that M-Pesa was seen as a competitor. We had conversations here when MTN Mobile Money started, and the conversation with even some of these financial institutions was that, what are we going to see happen? And they thought that was not going to impact on them. But what we are seeing is you're now becoming co-wives to this client.
Again?
You're partners with a bank. Yeah. They used to see us competitors. You're now partnering with them. And so for me, you're two people that are like co-wives. I'm not very sure who to believe, who is telling the truth and who is not telling the truth. How is this relationship going to evolve? Specifically, the telecom and banking. Are you going to remain just a channel, or you're going to become an active participant?
I believe in the end of the day, the banks will be the leaders. Most of the money is there, and this is the future, and I think that you can see it in other countries in the Western world. The money is in the banking. The telecom took a part of helping for a mediating time, for a period of time that until the banks will get to the numbers and to the right platforms to do the things. So the telecoms will be always the one to serve. We see ourselves as the one to connect, to be the tool to connect the customers, to be able to reach to anyone, any place, anywhere, and the most important, to make it safe. Because one of the challenges of the telecoms to help the banks to make it safe. And in these days, it's very challenging. The safety is not there, and the cyber security is very important in all these things. We can see that the responsibility needs to be in two parts. One of them needs to be responsibility of the banks to make sure that they are safe, but it's very important also to the telecom to take part of that and to make sure that the connectivity is safe. So it's two things, and we must act together as two wives.
Okay, that is interesting. In other words, you're going to augment each other because they have the money, you have the infrastructure, they need the infrastructure, you also need the money, and coexistence has to happen. Honorable Vincent Bagire, you've been on the other side legislating and whipping those that are not falling in line. You're now this other side where you're implementing, well, you're part of the ecosystem, if I could put it that way. The challenge of regulating this space that is growing and turning around very fast. What is your take on that?
Well, thank you very much, Michael. Well, I mean, first of all, let me say that the future is going to be characterized by disruptive technologies. And as far as technology is concerned, it happens and then regulation comes next, unfortunately. And that's the reality. If you look at mobile money, indeed it came. We were not very prepared, and the regulation followed. But having said that, I think, like the professor said earlier, the most important thing is to concentrate on the financial inclusion. Safety is important, but as I said earlier, with technology, you can't say, let us regulate, put regulations. You don't know what's going to happen next. A few months ago, my relatives had Safe Border, and that was their mode of operation. Then Uber came. Now, they sit in the comfort of the sitting room and order a cab. So you couldn't have said, let us prepare and regulate or legislate around technologies such as Uber. But in saying that, I think the most critical thing for banks is the security, the cyber security. And this is in very many aspects. One of the major aspects is that you have a lot of big data. It is hosted, for some of you, in places whose legislation you have no control of. So you're not sure whether the data centers where you're keeping your data, the regulations do not allow that it is interfered with. I think those are things that we need to talk about as a country and find solutions to such scenarios. And then, of course, from us, the government, what is critical is to integrate all the systems. You have people coming for loans, they have land titles, then you go into a process of verification. I think that's a role that government should play to ensure that the Ministry of Lands automates and gets these titles or properties online, so that makes life easy for you. In addition to that, government by and large has done a commendable job in terms of getting services online, but the systems are in silos and they're not speaking to each other, and therefore do not work very well for a sector such as yours. For instance, if I'm a perennial defaulter, but I have the documents, the bank will give me a loan, but I have a history of defaulting all over the place, and it is known by the bank where I have been. Now I'm coming as a new individual, but there is no mechanism to share information. So I think the aspect of system integration is very critical, even for banks in different aspects.
Yeah, I see Mike trying to say, I thought we had sorted that one out a long time ago with CompuScan and the Credit Reference Bureau. Do you want to provide briefly on what exactly is happening in this space? Because not everybody here is a banker.
And maybe to that point, and Honourable, thank you for your observations. I'd like to pick up on what you're saying, because I think there's two distinct parts in what you're saying.
Mike,
to the microphone. Yeah. I think there's two distinct parts in what I'm hearing that are of critical relevance to the banking sector at large. So one part is the history of how a person repays their debt. And that is what we've been doing for the last 10 years, is collecting all of that information for the banking sector so that we can help with profiling how a person looks when they move into a bank. But I do think is that what the Honourable's touching on is some critical additional information which is in the country at large, like property information. It could be like, there's a host of it. It could be licenses, it could be certificates, it could be share certificates, it could be information which the banks rely on at the time of making a credit decision, which helps to provide levels of comfort, which helps to confirm information about pledges of security, which need verification, and that's really what the essence of it is that I don't need to hold it. I need to call a government database for the banking sector, so that on my credit report it shows and says is that, yes, there's the credit history and profile of how they've paid previous loans, and they are a mortgage holder, and they've got so many titles, and they own so many vehicles, etc., which can all be accessed through government databases. It's publicly available knowledge, and we're hoping that the direction that's being taken with NITA-U to put all of these databases together ultimately is going to give us the environment to call to create something bigger, better. What is it all about? It's about the future of banking, technology, digital solutions for the banks in the room.
So what you're saying is, if we're going to leverage the value of technology, it's going to require us having all hands on the deck working together, as opposed to silos emerging from different directions.
And it's happening now. There's another conference coming up with UBA, with NITA, where the stakeholders are all pulled together, the bureaus are there, the registries are there, everyone's talking about it. So it's all happening.
Okay, so I have about 15 minutes to bring this to a close. Paul, I have an 11-year-old son, and as he was growing up, you know this business of technology, and they want to play games, but they want to upgrade. So every time he went and said, "Dad, I want to upgrade," my quick reaction was, "It's in dollars, it's expensive." So he kept on saying, every time I said it is in dollars, and he would say, "Yeah, I know it is expensive." He would complete for me. And then along the way he discovers there is what they call Forex. So he can convert to Uganda shillings. So every time he saw the dollar sign, he would go straight to the phone and search what is the Forex. And he would multiply and come and tell me that it is only 20,000. And I told him, "Yeah, you're seeing 20,000, but my bank has a different rate." He says, "Can we call the bank?" My question to you, are we ready for this new user? You talked about it here in your presentation. What kind of attitude we, the people that currently take decisions on behalf of this generation, what kind of attitude, what mindset do we need to have, because they are hitting us? I know parents who have seen accounts run and they don't know until they discover the son has been buying apps, upgrading apps, and then they say, "But Michael, you things you're bringing to us." I said, "I don't bring anything. I'm only a user like you." What do we need to do?
Yeah, I think the pressure starts right from the house. You just mentioned, and I think the economy is moving towards cashless, for example. And what does that mean? Generally, it actually means that you who is 18, for example, in Kenya, you have to be 18 to be able to open an account, and above, you're only playing maybe around 50% of the population. But your son, when he says, "I want to go and buy ice cream there," or "I want to buy, a hat," you either accompany him so that you remain digital and cashless, or you find ways of cashing out that and giving him cash so he can go and buy that place. Because where he goes at the age of 13 to 10, because they all have phones at 10 to 18, he cannot use a digital channel. So the question always asked, and I've participated in these forums many times, this person or this teenage, he's having a phone, and that phone was not stolen. Means that he must have gone registered the SIM card, or he was actually sponsored to do that. It's a very big generation gap between 10 and 18, which could be almost 50% of the population, or possibly 40% of the population, and that means about 10 million people that are being excluded from digital banking or digital to remain in cash. Yet they're the ones going to school, they're the ones spending more than you actually do.
Yeah.
So we need to address this, and I will answer just by saying that you actually finance them in order to comply to the regulation. You finance through the mobile wallet, so you actually have two mobile wallets. Yeah, you give him a phone, you create some wallet, you give him, some money, $10, and that's what he's doing for upgrading and so on and so on. So it's a gap that cannot be ignored anytime you talk about banking the unbanked, future the social media generation, because you believe 90% of what they're doing with that thing is social media. True. And there will be so much pressure if they are not given that. And that, obviously, which I've brought in, is going to cashless. Cashless cannot be achieved by any economy where you leave 50% of the people to remain in cash.
That is interesting. I remember when I added another layer from security perspective of that the transaction cannot be confirmed without my password. They were somewhere on a wireless, and then they called and said, "Dad, what is your password?" I said, "Yeah, that's the reason it's called a password. I have to be with you before you upgrade." And then when they said, "My dad is complicated." Shem, I come to you around skills for the employees in the bank, digital skills. You have been part of this sector, you understand. What are the requirements? What are the expectations at the very bare minimum from a digital competence of your employees, and specifically security? The reason I'm raising this is there was a headline, I think not too long ago, where about 64 billion had been through hacking, had gone, and of those 24 agencies, it was through email hacking, which means there's an individual. My question to you, to what extent can we pay attention, or should we, regarding digital competence? And then I'll come to the audience and take about 3 or 4 questions.
Interestingly, to survive in the digital world, from an employee perspective, we need not be IT experts. What's more required in the digital bank of the future is relationship management. People who like to deal with people. We believe that through artificial intelligence, security, IT security and system security will improve as the techies build systems that can learn and unlearn and intuitively improve the security around the system itself. But even more importantly, especially for Uganda, the future of banking is going to beat a path, first through USSD, then to apps, and then to partnerships. But we know that USSD is structurally less secure. I received a statistic from somebody that we have about 4 to 5 million smartphones in the country, but only about half of them are used as smartphones.
Ah, okay.
Okay.
Some of them are status symbols.
Yes.
Yeah.
We still use a lot of the feature-like features on those phones. But probably as the price of data reduces and as understanding of the functionalities of those phones grows, that too will begin to improve the industry. There's also one other interesting thing that probably banks will begin to pick on. I think it is either the FSDU or Microsave that released a report that about 57% of all of the credit in this country is done outside the banks, in the small shops, and hardware stores are beginning to dominate a lot of the credit activity. So when somebody, go to the shop and ask the shopkeeper to lend me 1 kilo of sugar, that is still credit, which is not happening in the formal financial services sector. Banks will begin to pick up on that as, and the good Mike is here, when credit reference bureaus begin to enroll more participants outside the financial services industry, like shops, like hardware stores, etc., all of those subscribing to credit reference bureaus. And then such data can begin to be aggregated, and then banks and other fintechs will begin to participate. But banks traditionally are not strong at these things. And that is why you find that fintechs have been playing a leading role in all of these innovations. I think that in the future, banks are going to partner more with fintechs or even buy them up to try and bring those innovations and hence the security in-house.
I think you raise pertinent. Banks traditionally, when the fintechs start eating into your space, that's when you wake up to the reality that these guys are not here for jokes. So I'm going to take 2 questions from here, 2 questions from here, and then bring this to a wrap. if I could put it that way. So I see a gentleman at the back with a question. So can I take 2 questions from here? Going once, going, okay. So I see Fabian and the gentleman at the back. So this is done. No, 2 questions from here. We'll have lunch and you can, otherwise I don't want to be thrown out. Next time I want to come back as a moderator.
Mike?
Mike? You're
Mike?
asking me, Mike, or you're asking them for the
No, Mike, it's me.
Yes.
I would like to, until they will ask the question, I would like to add something on your original question about training and about the skills of the employees in the banks.
Yes.
As you said, it's so simple to hack a bank today through an email. You know, banks invest a lot of money in very sophisticated systems. They put huge firewall, a lot of softwares, but in the end of the day, the individuals, the employees are not trained well in the right simulations. And this is what the banks lacks today.
Sure.
You know, an employee can have his laptop, he takes it home, he open a simple email from Google, that in his Gmail, and suddenly a hacker is inside of the bank when he comes the next day. So the employees must have a training that simulate the right scenarios. Today the banks are doing by the, let's say, a regulation. They do a pen test once a year. They're checking the system, but they don't train the employees to check that simple Word document that they receive. Is it a virus? Is it a Trojan horse? Is something there? So there need to be a major change in the thinking and the training of the employees to look on these scenarios of phishing campaign, spoofing, and to give them the knowledge and know-how. Cyber, it's a lot of awareness. And if the employees are not aware, all the money that invested, all this huge system, huge server rooms, huge data centers, all this protection will not help. They must be trained to simulate the right scenarios, the same scenarios that the hackers are using. A simple Gmail with a very simple document, and suddenly the bank is hacked. Another thing, so much information is in the net. If we talk about LinkedIn, Facebook, all this one, we can tell easily the hacker that sits in Indonesia, he knows who is the financial manager of the bank, who is the risk manager of the bank, he knows everything. He can send a simple email to that guy, to his private email, offering him a job. During that thing, offering him a job, he already hacks the computer. When the guy sits in his computer, with his computer in the office, he already is a channel to the network. When he's a channel to the network, we know the passwords, we know everything, the bank is stuck. So we need to make a major change in training. The people must be trained well. The bank need to make audit tests and gap analysis, not based on the basic instructions of Bank of Uganda. It must be updated. A real simulation must be done, gap analysis, and train the people. Once the people are trained, you're reducing significantly the attacks.
I think you raise a pertinent issue, and I was reading a report that said what they discovered was that about 80% of the hacking that is happening is, even in the most secure from an infrastructure perspective, is through individuals. And so they're saying invest in the people, not infrastructure, significantly.
Exactly.
Because, So, but let me take the 2 questions from this side, and then I'll have. So please go ahead with your question. Keep it short.
Thank you so much. My name is Ivai Bifesto. I work with Microsoft. I'm part of the directors, Microsoft Uganda, and we specialize in fintech. And for these 5 years, for the past 5 years, we have been specializing in the blockchain, research of the blockchain technology and distributed ledger systems. And this is the technology that underlies digital currencies.
The question?
The question is here. What are the banks doing to learn more about the blockchain and distributed ledger technology? Because this is a very disruptive technology that East African banks have not yet paid so much attention to. Yet the global banks like Citibank are already creating up their own blockchain patterns.
Okay, thank
so
you.
the question is, what are the East African banks doing, and the central banks, are they doing anything in this regard?
Okay, I guess Shem, you shed some light if there's anything that is happening around blockchain. Fabian?
Thank you very much, and thank you very much to the panelists. We are talking about digitalization, evolution of technology, which is very, very fast. And banks, on several occasions, have been accused of not being fast enough to innovate, taking advantage of technology. Of course, at some stage, people thought that telecoms would become banks. But banks have come up to say, excuse me, they've come up to say that banks are using other people's money. The experimentation needs to be regulated. You can't just experiment with people's money. Risk management is the key as far as banking is concerned. I wanted to hear from any one of you, what would be your advice with regard to the speed with which banks have to move or to be able to do innovations? Should they continue to be followers? Should they wait for you, the fintechs and the telecoms, doing the innovations, or should they, move ahead, taking into account the fact that they are using other people's money and the level of experimentation needs to be limited? Thank you.
Wilbrod, consider increasing the subscription so that you have a research fund for innovation for the bankers. Just an idea. 2 questions from here. If there are none, okay, I see a gentleman over here. I need okay. Mr. Eric Alhanga. So please go ahead, and then I'll have 2.
All right. My name is Joel Muhumza, Financial Sector Deepening Uganda. Financial Times recently said that the biggest threat to financial institutions and banks are not fintechs, but legacy costs. So similar to the question that Fabian raised, with the legacy that has been built over the years, that allows banking to be where it is. Yeah. And now we're talking about changing. Yeah. This is a big giant that has to move around. Where do you start? How is it that this is going to actually happen? What do you think needs to happen today for these changes to take place? And what are the costs going to be?
Okay. So I'll have Mr. Eric Arohanga. And then I'll have one question specifically for a lady. Okay, there's a lady over Honorable Sechto.
Okay, my name is Eric Arohanga. I'm asking the question from the lawyer's point of view. Okay. As a lawyer who serves banks. Our clients who are bankers, and also our clients who are not bankers, manufacturers, the Nile breweries of this world, they're worried when they hear this type of seminar going on, that we are not very sure about yourselves as bankers and the risk assessment analysis in a situation of the future. We are very worried because in the end, maybe our customers, our clients who are not bankers, might decide to keep their money themselves instead of bringing it to the bank. Because is it possible that these banks might be eaten? They may be eaten until banks don't exist anymore. Because, in the past, remember that we used to go to Bank of Uganda to line up to get foreign exchange. I haven't gone there for a long time. I don't even know how Bank of Uganda offices now look like because we don't go there. Now, we hear agency banking is coming, and most of these halls might remain empty. People might decide to go and transact outside the banks, and also the halls remain empty. So this emptiness, is it likely to continue to the extent that the money might be kept in the cloud?
Interesting.
And then there was no banking anymore.
Okay. I guess the cloud is here. I don't know who mentioned, I think the Honorable Vincent said some cloud somewhere. So you could be guess that's the reason you're able to access your money even when you travel, depending on the card. Yeah. So let me have the final question, and so the panel will respond and give your closing remarks as well. Honorable.
Yeah, thank you. I'm Victoria Sectorico from the Uganda Agribusiness Alliance. I'm glad my favorite banker is here and he knows my habits. I still go to the bank. I don't do mobile money. Why? Because I do not trust the system yet. Now, I'm yet to learn this system which has been around for some time. The telecommunications gentleman has just been telling you all how you should train your staff and train them and make sure they are sure. Now, for as long as the banks continue speaking a language we, the unbanked, don't speak, that gap is going to be there. What is the plan for me, my mother, and my daughters who are farmers? I thank you.
Interesting. Gentlemen, these are exam questions that you can actually write a master's thesis, and the speaker did mention to that earlier on. So I will start from Shem, briefly respond to any of the questions, and make sure all the questions are the panel, make sure you respond to the questions, but also give your closing remarks, and I have about 5 minutes for this, or 6 or so minutes to get this done. Shem.
Thank you. Festo raised an interesting concept around blockchain and cryptocurrencies. And indeed, the industry in general is still trying to understand the concept and how well it will be, or it is applicable to what we do in banking. At Stanbic Bank, specifically, we've identified a few areas where we can use this blockchain technology, especially around KYC, around issues of collateral management and foreign trade, because the way blockchain works is that it is quite secure, and that public ledger is updated by so many people, so very hard to alter. But interestingly, in some geographies, this blockchain technology has been banned by regulators, maybe because they are still unsure of what this thing really is. So, but I think there is a future for that here. And then the other interesting one I want to respond to from Mr. Eric Karuhanga, I think the demise of banks has been prophesized every so often. But banks are going to be with us for a very long time. Only that banks will metamorphosize or will change into and be a lot more part of what we do, a lot more part of our lives. So banking will cease to be something we do, we go to do, but something that happens along with us in our day-to-day lives.
Okay.
So will money migrate to the cloud, etc.? Certainly not. But more and more, you will not realize the presence of your bank in what you do, but it will simply become part of you.
Thank you, Shem. Vincent.
Yeah, thank you very much. I think Shem was I don't know whether he was being polite or being a coward. But I know for a fact that Bank of Uganda, I think early in the year, ran an advert disassociating itself from cryptocurrencies. They said it is not regulated and therefore it will not be practiced. I remember that advert very clearly. But I think Shem, being a banker, is fearing the repercussions. But having said that, I think, again, on the issue of banks closing or banks, their relevance decreasing, I don't see that happening, because the money comes from the bank into the cloud and back to the bank. So there is that cycle that is consistent that I think and feel will always be there. And the issue is, I think we need to look at it from what IT does. It eases services. It's not to replace the bank, but to ease the service, to make your service easier for you to be able to travel from here with your Visa card, transact in Johannesburg, transact in Milan, and so on and so forth. And in doing that, you would be operating in the cloud, but talking to your bank. So I don't see the relevance for the bank reducing in any way. I think those are the ones that I can respond to.
Thank you, Vincent. You're right.
For me, I will go for the security and the way how to protect our money, or the customer's money, and in the end of the day, the investor's money. There need to be a change in the way of thinking. What was good for last year or years ago, it's not good enough for today. The banks need to prepare themselves to think like hackers, to think like the people that are hacking them. Yes, yeah. It's to change the method of thinking. And the responsibility is also on the telecom, because the banks will do their best, but the telecom need to protect also the banks. If the telecom is advanced and it thinks security, it will prevent the attacks from coming to Uganda. Mm-hmm. The attacks can be stopped in Europe. They don't must come up to Uganda. So if the telecoms will adopt new strategy, and the same the banks, and will prevent the attacks coming to Uganda, and the people will be trained well, and also they will be also auditing in the right way, making right simulation and real simulation, things will be much more safe for the customers.
Thank you. And I think you're very crystal clear on that in terms of the security aspect, which is really fundamental. Mike.
Thank you. I think if I can talk a little bit to Fabian's question, which is around the speed at which banks are or should be embracing change in technology, the risks with it and the innovation side, and how far do you actually go? I think you said on other people's money. But I think it's not so much about that. It's about, yes, innovation is relevant, but Uganda's not unique as a country. Banking is not unique as a market. And there's a lot of case study elsewhere in the world. And I think is that there are some very, very good learnings. If I talk generically, not just about my industry, the credit bureau, but I think everywhere in banking there are some very good learnings to go and look and learn and understand and say what has happened. Mm-hmm. And then to do simulations, and then to say that what can we do, what can we prove, what can we test, what can we do as human-centered design to go and focus groups with customers to understand, and then bring it out to market on a pilot basis and then on a large scale. But it's not as fast as what one would like. From a vendor point of view to the banking sector, I want the banks to adopt, embrace, and go live tomorrow. But the reality is there are risks, there are controls, there are procedures that have to be put in place. Yeah. So to your point, Fabian, is that yes, you need to go through that process. I take the example of when we brought credit scoring out. It was a 2-year project for one bank to go live. Now it will go faster. But that was the first rollout of that project in the country.
Okay.
Things do take a little bit of time, but the technology's out there and proven.
Great, great. Paul.
Yeah. I'll answer Fabian as well as the lady. Two things, obviously, and which also comes into the legacy, is the rollout of, so Fabian, the chairman, just mentioned that it's not their money. You know, they're holding money belonging to the customers and therefore cannot afford to take risks. The partnership like we have done now, it's enjoined on the hip. And that means that technology companies or fintechs are able to invest or co-invest on a long-term arrangement such that the pain is less. Mm-hmm. And this can only happen if we both believe on a certain goal, like we are planning to do on financial inclusion in this market. So by simply identifying, like what we do, and I'll give that example of a bank, cooperative bank. We partnered 4 years for a 6 years contract to roll out, digital channels. Within 18 months, they had hit 5.7 million accounts, far from about 2.1 million accounts for 50 years. But 18 months, they achieved that. And this was the first head-on product that was competing with M-Pesa, but from a bank-led wallet. So it is possible that you can partner and achieve these numbers and able to offer much more than a telco would do, because we're able to do about 1.5 billion Kenya shillings on microloans, which are applied digitally and approved digitally without a human angle. I think that's the first thing to mention. Second one is addressing the lady. Ma'am, about 2 months ago I was invited in Kigali to address a financial inclusion conference. But I was given a very complex question which I was supposed to address. How do you enable banking to the difficult to bank. What that means is now you're talking of mom, she has the phone. Another one has a challenged culture. Another one is the case I've given in Rwanda where they are so far that there is no electricity. So agency banking, unless you bring in the solar panels, will not work. Another one with the generation XYZ that we're just giving an example, that they are so instantaneous and demanding response, but they will not come to queue in either applying for the account or come to get banking services. So each one of these requires service a different approach. And I've said that including culture, including ability, I would say, education levels, including, you have to pass in Ethiopia, another case, where there are 5 languages, and I think most of you may have seen whatever was happening in athletics, maybe 50% or 70% cannot speak English. So they are so enclosed, and but we provide a solution to our Ash Bank that operates in 7 languages so that it can simplify and be able to fit into everybody. And the last question is, my feeling is banking is going to the cloud. It is true. Today you may not know where the servers of your bank are, and it doesn't matter, but the true trend of banking or of technology is on the cloud. And that saves the infrastructure that have been set up, it saves your parameters. Tomorrow's devices or the laptops or PCs, you're not going to have to buy Microsoft licenses. You enjoy them as pay as you go. And those are the realities of the matter.
Okay. Chris, there's one issue we're supposed to talk about, the legacy. When people go to their server room and see everything they have been building for the last couple of years, and you're saying, I no longer need this server room, I am heading to the clouds. How do we go about that as you bring this to a close?
Well, I think it speaks to perhaps the example that I was giving earlier, which is, does a bank actually need to invest in that in infrastructure, or as significantly? Core banking certainly is a need. So perhaps in addressing that and speaking to Fabian and Dolores as well, is investment is certainly required, but the bank or the banker's role fundamentally remains unchanged, and which is to do 3 things, essentially. First is to attract deposits. Second is to provide lending, loans, service these loans, and then actually levy interest and fees for that. Everything else, be it MasterCard, be it Eclectics, and so on and so forth, are value-added services that enable for clients to be serviced. So if we look at the cost of infrastructure, and we spoke about it with Professor earlier on, today everyone that is in this room is probably banked. And that is because the cost of servicing us allows financial institutions such as Centenary Bank to provide us such services, ATMs, point of sales, cards, and so on and so forth. So to be able to service the lady's mother and to be able to service her daughter, inevitably we will have to go digital. Digital for your mother who will be in remote areas and does not have immediate access to an ATM or a point of sale, and digital for your daughter and for your son who does not want to actually enter a banking facility. So I think this is certainly where we are headed. We certainly will be enablers within that path. And in that, we have to create those strategic partnerships, as I mentioned earlier on. In Kenya, Professor would know about that. We did a partnership with the government of Kenya with Huduma by providing them with the digital rails. In Rwanda, we completed an MOU with Rwanda Development Board. And they told us specifically to focus on 3 key areas that are very key: education, healthcare, and pension. We have, I mentioned, the MasterCard Labs of Financial Inclusion, and again, focusing on these 3 markets, Tanzania, Kenya, and Uganda, we are solving for agriculture. We are all dependent on agriculture. And what we've created is simply a marketplace. So again, banking will exist, will never cease to exist. It has simply evolved.
Ladies and gentlemen, this has been exciting, and having 6 members of the panel to have a conversation in an hour or less is not a simple task. Key takeaway for me is that it's going to require us to have a slightly different mindset. We need to reskill and retool both the consumer, but also the person that is serving this consumer, whether it is in the cloud or physical. and the other one is you're going to require to have slightly different tools. But most importantly is the attitude of the leadership, that if this is going to make sense, leadership needs to be at the front of this. They need to be champions. I also hear the aspect of co-creation. So how do we become co-creators as opposed to, so that you are actively involved? You talked about the human-centered design, that I go to Honorable's place and see her mother, see how they operate. I mean, I'm reminded, that story has always remained with me, how the radio got onto the phone. It was out of a study in India where they asked them, if you were to buy a technology in a rural setting, what technology would you buy? And overwhelmingly in that community, they say the radio. And so to Nokia, the challenge was, how do I get a radio onto the phone? Because it is only when that this device will make sense. So for a large, if you remember here, remember the time when they were promoting mobile phones with FM? You remember? And then we moved from FM to now with Facebook. And now you can receive. So how do we deliver the same in a different context? Ladies and gentlemen, a round of applause to the panel for a job well done. And thank you very much for allowing us to interact with you in this space. Henry, over to you. Thank you. Gentlemen, you can take your seat. Thank you very much. And I'd like to thank the audience for the good energy that you have. I hope that you've enjoyed some wonderful coffee and tea. I'd like to invite Joseph Ogwao. Joseph is going to lead the next panel. Joseph is a lawyer with LegalMark Advocates, and he's going to lead us on the addressing the gaps and shortages of long-term finance.
Thanks. Thank you, Henry. Actually, I'm better known as Joshua, but I'll accept the name Joseph. I think my parents made the same mistake, so I just stuck with the name. I will ask my panelists to come over and take their seats. Honorable Maria Chiwanuka, who needs no introduction. Honorable Maria Chiwanuka was formerly the Minister of Finance, Economic Planning in Uganda, effectively managed our economy for a while, and is also accomplished in the private sector. I'll also ask Mr. Jared Osoro. Jared Osoro is an economist of several years standing. He's currently the Director of Research and Policy at the Kenya Bankers Association, previously worked with the EADB, and has published lots of papers. I'll also ask Mr. Richard Byarugaba. Is Richard in? Yeah. Richard, again, really needs no introductions. Both banker and investment manager, currently the CEO of NSSF. We're fortunate that because of the governance he has put around it, we need not, we can sleep carefully knowing that no one is going to disappear with the pot of cash that he sits over. I'll also ask Mr. Dr. Martin Cheune of the Uganda Manufacturers Association. Is Martin in? Martin? Dr. Martin Cheune sits on the on the board of the Uganda Manufacturers Association, the Economic Subcommittee. He's currently also the Finance and Economic Advisor of Roofings and has had a lot of experience in industry generally, worked in Mogas, worked both nationally and internationally, and will give us a perspective of industry and the experiences in accessing long-term financing. I'll also ask Mr. Matthias Katamba. The fact that Matthias was the one who introduced the Honorable Professor demonstrates the fact that he's, again, needs no introductions. A man of banking. He's currently the MD of Housing Finance Bank. Prior to that, he set up his own PE firm that focused on providing technical advice and capital to microfinance institutions, and he sits on several boards as well. I think we will start with a brief presentation from Jared, which will focus on the gaps that are currently being faced in accessing of long-term financing in Uganda. Jared, you have 10 minutes, and I'll watch you like a hawk.
Thank you, Joshua. I think it will be a record to talk about long-term finance in 10 minutes.
Probably before Jared starts his presentation, I wonder if Paul is in. Paul Buiso, CEO of USE. Yeah, thank you, Paul. Sorry, I hadn't seen you. Paul is the CEO of USE and was previously the general manager of Diane Blair. He will also be on the panel. Thanks, Paul.
So, Josh, thank you very much for the introduction. I think long-term finance is very interesting and complex too, because you can imagine talking about long-term finance in a banking conference brings the expectation that long-term finance is necessarily provided for by banks exclusively. But that's not necessarily the case, because the spectrum of long-term finance is much broader than what banks are actually able to do. And I think my role here is really to try to paint a picture around who are the core players in the past providing long-term finance, and how does that lead to one looking at what the gaps are and how possibly those gaps can be addressed. Now, I mentioned long-term finance being very interesting. If you follow the news, the business news regionally, there was a headline in the Kenyan newspapers on Monday that Kenya Airways, which everybody knows, is going to be substantially owned by banks. That is interesting because those banks didn't want to own equity in the Kenya Airways. They basically lent short-term money to Kenya Airways to buy sandwiches and pay salaries. But now they are forced to take a longer-term position in the Kenya Airways. That tells you how sometimes interesting long-term finance can be. But more interestingly is that there are more players in that space than we envision. And that is why I think one has to appreciate the linkages insofar as the players in long-term finance are concerned, for you to identify the gaps that they exist. So what I'll do is that I'll basically paint the spectrum of what the long-term finance is, look at what those linkages are, identify, because with linkages comes trade-offs, what those trade-offs are, and then make some core observations regarding the role of institutions generally and the financial system in provision of long-term funding. So let's start with the various segments that constitute long-term funding. And I think one of them is what you can call the official resources that come to governments to be able to invest in infrastructure, because infrastructure by nature requires long-term funding. And then, of course, there's expectation that the banks can provide long-term resources, even within the constrained nature of their balance sheet in terms of the tenor. But also, there is private equity, which is really critical insofar as providing long-term funding, as well as the capital markets as a conduit for mobilizing resources that are of a long-term nature, so that can be used subsequently for purposes of funding investments. The reason why long-term funding is critical is because it's difficult to fund investments using short-term resources. And therefore, when you do short-term funding, channeling it to investments, there's a big risk, because the tenor mismatch alone can cause volatility in the business that benefit from long-term lending. So I think that tells you that when you're looking for a solution for long-term funding, you need to be comprehensive insofar as the avenues of provision of such funds are concerned. So you need to look at The resources of the government can be able to channel to investments, private equity, the capital markets, and the financial system itself in terms of the banking industry providing such resources. Now, let's start with the government. I think many of the investments that governments do, and these are typically to finance infrastructure, arise from not just the taxes but also the borrowings. And those borrowings have traditionally been from the usual multilateral lenders that give resources of a consistent nature. But increasingly, because governments are also keen in diversifying their sources of funding, they have been going to commercial lenders. You hear the Eurobond market is now very popular amongst banks, amongst governments. At the same time, we are seeing a number of banks now very keen to lend to governments at the local front on a longer term scale, because governments are also trying to play a role insofar as catalyzing the development of the long-term resource mobilization concern. So governments actually are a core player insofar as mobilizing resources for long-term lending, and that usually comes with one thing in mind. You cannot continue borrowing perpetually. There's a constraint, and I think many of the countries that are falling into the challenges of debt and sustainability have come to the point of realizing that you cannot borrow perpetually to finance your long-term investment. That they avoid being caught in that vicious cycle of being debt unsustainable, you're debt forgiven, and then you become sustainable again, and then you go into heavy commercial borrowing. So whereas that's one avenue, I think one has to have it in mind that, there's a constraint of the limit to which you can continue borrowing for purpose of financing your infrastructure on a longer-term basis as a government, without necessarily risking falling into this vicious cycle of moving from unsustainable position, seeking forgiveness, being sustainable, and then going into heavy commercial borrowing for purpose of investment. The second is really in the context of the banks and what role banks can play insofar as long-term lending is concerned. If you look at the typical structure of the balance sheet of a bank, a substantial portion of the liabilities are basically deposits, and many of these deposits are fairly short-term in nature. And from a prudence perspective, much of the lending in terms of the assets now has to match that kind of tenor. And that's why, as I mentioned, usually there's a limitation to the extent to which banks can be able to give credit on a longer-term basis. And that tells you that for banks to give longer-term credit, there needs to be an innovation and a sense of partnership with other agencies so that those resources are easily availed for purposes of enabling investments. And I think the biggest risk in banks giving long-term resources, short-term resources towards investments, is that the borrowers that pick those resources for investment end up carrying the risk of refinancing or rolling over those resources once they come due. And that's one thing that you have to appreciate, therefore, that even whereas there's scope for banks to offer long-term lending, that scope is also constrained. The third aspect is really with regard to what you can call the relationship that exists between banks and capital markets. And before I reach there, I think if you start looking at the Ugandan picture, you can actually see that by the very fact of the balance sheet structure, you're seeing a tendency of the lending leaning more towards short-term. And interestingly, the lending also leaning more towards consumption. If you look at the chart that is in front of you, you are seeing actually consumption taking a big chunk of resources compared to even manufacturing, which is really an area where resources need to be channeled to. So in terms of the proportionality of the lending that the Ugandan banking system, for instance, provides, you see agriculture taking the least, then you're seeing manufacturing, and then from there you start seeing personal loans, and then loans to construction and trade also taking a bigger proportion of the lending. And what's even more interesting is that the proportion of the lending that happens from the local financial system that is foreign currency denominated is increasing, while that in local currency is coming down. And that points to one thing, and that is that increasingly the local, the capacity of the economy to mobilize adequate resources to finance its own investments and consumption does not match the availability of those, and therefore there's a reliance on external savings for purposes of financing domestic consumption and investment. And that's why you're seeing the domestic credit as a proportion of the total lending coming down, whereas the foreign currency component is also increasing. So that's also a constraint, because there's a limit beyond which you can rely on external resources for purpose of funding domestic investments. Now, let's look at the capital markets, and this is really an area where there's a usual feeling that, they have a bigger role to play insofar as supporting long-term lending is concerned. The traditional view has been that, if you have a system such as Uganda's and typically many African countries that are bank-led, the view has been that, the thriving of the banking industry is at the expense of what happens in the capital markets. But increasingly, we are seeing evidence of the effect that, when a banking industry thrives, it can actually lead into the co-evolution of a capital market. Because in the Kenyan case, for instance, we have a situation where banks actually have, in a way, enabled the development of the capital markets, because closer to 50% of the players in the capital markets are banks, insofar as the investment banking component. But more so, we have a number of banks that are listed in the stock exchange, and therefore being able to mobilize resources of a longer-term nature by virtue of the fact that they are looking at the capital markets as an avenue. So there is scope to banks now complementing each other with the capital markets with a view to seeing how they can elongate the availability of resources that are supposed to be used for investments. Of course, there's private equity, and which is really growing globally. But I think when you look at the proportionality of the resources that are being channeled towards investment in our kind of market, private equity has scope, but it does not come in significantly. And I think the issue is really to think critically about how we can now harness the available private equity resources for supporting our investment locally. And then, of course, there's foreign direct investment, which is also very important. But I think when you're looking at foreign direct investment, you need to go beyond the quantum of foreign direct investment that we attract as an economy or even as a region. Because much of some of this foreign investment is basically resource hunting. And sometimes there are levels of foreign investment that come and not necessarily catalyze production, but instead engender a scenario where there is consumption, and that consumption is outward leading. You can imagine cases where the biggest investors, for instance, in the real estate, are in construction of shopping malls, which shopping malls are important, yes, but I think they're relying on imports that are going to require that the resources that are being used for consumption and necessarily moving out because of the type of investment. So when you look at foreign direct investment as a basis for attracting long-term funding, you need to look at beyond the quantum and look at the quality. Now, let me just paint a small picture regarding the ability of the linkages that arise out of the three areas that are painted. Now, if you look at the current account position of an economy, and you see that current account being on the negative, it simply tells you one story, that economy is relying more on external resources for purposes of investment. So if you want to narrow that, and I think the central bankers will look at the current account from a stability point of view, but if you look at the other side, you'll start seeing that there's some imports that actually enhance the capacity of the economy to produce. So the way you look at the current account, the opposite side of a current account is really the extent to which gross domestic savings are less than the investment requirements. And therefore, when you see an economy having a huge external balance, you need to go deep inside and see whether that's really enhancing consumption or is enhancing production, and how that links to the broader spectrum of foreign resources that are coming into an economy for purposes of investing and promoting long-term funding. Now, there comes challenges usually, typically when you start looking at some of these linkages. And I think one challenge that I need to talk about is the extent to which the governments are enablers insofar as catalyzing the domestic capital markets are concerned. The one thing that is clear is that the longer the governments lengthen the maturity, and Professor Ndungu alluded to it, the more they enable the private sector issuers in the capital market to be able to bring in resources that are of a longer term nature. So we can argue that the governments can step back and let the market, capital markets, basically be private sector oriented. And I think the infrastructure bond that Professor Ndugu talked about is one typical example of how elongating the profile of issues in the market can actually lead into market development. And we've seen this in the context of many players now increasingly looking at the capital market as an avenue of raising resources, and therefore bringing in other long-term resource providers such as the insurance and the pensions fund to bring into some of those resources towards supporting the longer-term resource mobilization for the economy. I think I'll leave it at that so that we can have more time for engagement. But the fact is there is scope for enhancing our capacity for longer-term resource mobilization for investment. But that has to be seen in the context of the linkages that exist between the various providers of those long-term resources, and not necessarily being looked at from the lens that it has to be provided by just one component of the financial spectrum. Thank you very much.
Jared, thank you so much for giving us that spectrum of the financial sector generally and how financing is sourced. Jared always had a way of breaking up very complex economic data and making it extremely simple for you to understand. And then you get quite angry if you didn't understand it. But thanks, Jared. Let's probably just focusing on the issue of the challenge that industry is having. Martin, you're a man of industry. I think let's start with you. Let's bring this home. We have 25 banks operating now, which are fairly solid thanks to the supervision of the central bank and the big stick that Justin holds to ensure discipline. And yet you're still having challenges accessing financing. Let's just make it as practical as possible. What are these challenges you're having? Is it the interest rates? Is it the length of time? Very, very briefly.
Thank you very much. I'll just put it briefly that as industry, as manufacturers, our problems are centered around 3 issues. One of them is the patient capital. Having patient capital that can wait until at least the project is visible to pay up. You find that most of the long-term facilities around average between 5 to 8 or even 10 years for private sector. But at least if it can be longer than that, that could be helpful. We could see some kind of intervention if it comes to trying to have what we call complementary models, whereby we've heard about the capital markets, banks listing, for example, and also getting this kind of long-term capital and be able to lend it. Or we see when we're buying machinery, for example, you find that the suppliers can provide what we call machinery financing. If the banks at least can try to engage some of these suppliers, or even the countries where they're coming from, to see how that kind of financing can come locally, it could be helpful to some extent. The second problem is around the risk profiling of companies, which interprets into the price or the cost of the financing itself. Manufacturing in nature has its challenges. Some of them are macro in nature, some of them are micro in nature. The macro challenges are surrounded by what we could call the cost of conversion, whereby you have expenses like electricity cost, freight costs, again, and also access to other markets, the costs that you incur in this kind of aspects. We need at least to see that there is an engagement with the financial institutions to understand this kind of risk profiling of the companies or of the manufacturers, and again try to be able to go with us along the way. I could give an example of the campaign we've had about local content previously. Now, industries are operating at about 55% capacity utilization, and these industries are being financed by the banks themselves. If the industries cannot be able to send their products to the market for the infrastructure projects, then the ability to pay becomes real, or the inability to pay becomes a real problem. So we would like to see that our partners in banking and also other financial solutions part of us when we're trying to kind of advocate for some of these challenges that we're facing.
Thanks, but maybe we'll stop there because of time. I think you've given quite enough.
Thank you.
But we'll pick up on the issue of patient capital. You want patient money to finance your needs. And I think Matt will come in here. Matthias, some research conducted about 2 years ago indicated that of the bank debt currently in the economy, about 80% of it is funded by deposits, which, as we know, are short-term. And this has raised a bit of a paranoia among the banks. When you look at the standard bank agreement, which is supposedly a long-term finance agreement, it will provide for, let's say, a 5-year, 7-year facility, okay? Then it will provide that the bank will have the right to review annually and can opt to withdraw the facility. Then it will also provide, remember it's a 7-year or 5-year facility, then it will also provide that the bank can withdraw on demand at any point in time, terminate on demand. Now, that seems more like a veiled or rolling overdraft facility being disguised as a long-term debt. What are you as financial institutions doing to provide the kind of appropriate financing that industry like Martin's current employers actually need? What's being done at the moment by FIs?
That's quite a loaded question, the kind that would require a professor to answer. But I think banks provide no guarantees, just like life itself. And as you imagine, you will make an assessment to extend a credit facility when the circumstances are what they are at that time. But I think there's always room that circumstances will change, both on the side of your client and on the side of the market in which you operate. So with volatility of currencies and all sorts of things, I think it would be quite a tall order to accept certain guarantees right up front. They would certainly have to be priced. And as you heard from the governor this morning, I mean, costs are already high, operating costs for banks, for a combination of reasons. Since we are talking digital today, we also have to talk about the transition costs that nobody I've heard talking about yet. Somebody, I think from FSD or somebody, alluded to the fact that you already hold heavy infrastructure that we need to transition away from, and nobody's talking about it. So within that space, quite a lot would be changing. But I think from bank to bank, client to client, most of these things are tailored between the bank and the client at that time. It's always the aspiration of the bank to offer the best for their customer, based on their circumstances.
Okay. So basically, the issue of the mismatch between what you're using to fund your loans and the actual length of time that industry needs remains a challenge.
It does. There's one inextricable fact just cleared out very well by the previous presenter in that 10-minute presentation, that in an economy like ours, where it is a fact, because either culture or length of time we've been at this development game, we have a lower volume of savings than the requirement that we need. So we have to borrow from out of the country. When you do, the 80% that you've mentioned that we have here, we have to try and find a way to match that with the requirements of our customers. Within those short-term type deposits, there's a long-term nature in that. For example, I'll give you an example. If you have a farmer in Kayunga who sells a goat today and brings money, takes a taxi, because they still do, and comes and banks it in a bank, let's say on Loom Street or something like that, and goes back to Kayunga and does not withdraw or do anything with that money until they sell another goat. And you have another trader downtown who sells goods today, banks, and withdraws in the afternoon. There is a way they balance each other out. So for a level of stability, you'll have some part of that short-term funding that is long-term in nature. And I think the survival of banks for the last several years would explain that, because not everybody is borrowing offshore. So it's a combination of things. We will meet some of what the long-term nature that the businesses need. And in some aspects, you'd have to find certain partnerships, either get a line directly for an end user who could be your client, as long as you can match the two.
Thanks, Matt. As you finished, you talked about getting lines directly. So I would assume this is external financing. And this really lends credence to what Jared was saying regarding the increase of foreign debt in the country. Probably, Honorable Maria, this is possibly where you could come in, given your experience as a finance minister. There was a time back in the 1990s where the government did quite an interesting intervention in the markets. Government took through the central bank, allowed for long-term debt to be borrowed. It underwrote the full currency risk, on-lent this to commercial banks, so that they would then, without having to face any currency risk, on-lend to industry for capital development purposes. That seems to have completely dried up. Could it be that the government withdrew this intervention a bit too early? Because it had quite an impact on private sector development. Is this something that possibly, as the current senior presidential advisor on finance, is this one of the things that the government could be looking at ensuring that long-term, well-priced credit is still available?
Thank you for that intervention, and to all the previous speakers. I'm going to be very cheeky, because I think I'm the one person here who's not a banker, and I'm not an economist, so I'm now going to tell you how to run your banking. Someone said, there was a slip of the tongue earlier, when one of the panelists talked about not the future of banking, but banking of the future. And I think that was a really relevant slip, because what we need to talk about is banking of the future. And that banks need to become rather different animals, especially in a country like, in an emerging country like Uganda, that is an open market economy. By being open market, the government again steps back from business and allows the private sector to handle the business. Right now, we have a completely open market as far as currency is concerned. You can take out whatever you like, you can bring in whatever you like. So for the government to then underwrite the currency risk would need some kind of adjustment of the degree of openness. I remember a conversation I had with Casita when they wanted the government to fix the rate at which URA was charging them customs on imports. And I said, okay, fine. If URA is fixed, if we fix an exchange rate for them to charge you on your import duties, can we fix your prices at which you sell to the consumers? They said no. So I think that's why the government cannot sort of half intervene it. Either intervenes totally or leaves the private sector to get on with it. The second point I'd like to, and also, by the way, I'd like you to point out any of those Apex success stories that are still existing today. I'd really like to hear about them. The second point I'd like to say is that the banks, as has been coming out in the previous presentations, the banks need to lean more into the economy, into the real economy. Because from my humble observation so far, banks have tended to depend on transactions, individual transactions, profit margins for their profits, rather than doing more like the next door in Kenya, going for the volume approach. Looking too much at the risk and not looking at how do we get economies of scale into our lending and into our general participation into the economy. I'll give you one instance. When I was living in the US, there was a big drop in interest rates. I forget what caused it. But overnight, interest rates came down from 15, 14% to 6, 7, 8%. And at that time, I was expecting my baby. But the mortgage officer said, no problem, I'll bring the papers to you. So they came to where I was, and I signed the papers. That is an example of how the banks were actually tapping into people's needs. Because the banks, again, I'd like to emphasize is, as I was saying to Fabian earlier, you have the license to deal in money, not the telcos. The telcos need to be your channels. You need to move money through the telcos, not the telcos to take your money and move it for you. Another point which I know you're going to ask me about is how the government borrowings and the government so-called crowding out of the private sector. I think if we look at the rate of commercial credit given to the private sector and banks' take-up of government paper, they're both going up. So I think it's not so much that the government is crowding out bank credit, it goes back, I think, into the capital markets.
Honorable Mayor, if we could just hang on to that point a bit. Over the past 2015-2016, as was pointed out by the governor during his speech, bank lending went down significantly, and banks invested heavily in bonds. Government was also looking at ensuring that it got enough to meet its deficits for budget support. So interest rates inevitably went up. It becomes a bit difficult to, and obviously Matt, if Matthias has the option of investing in treasury bills, which are essentially supposed to be risk-free at 15%, because it hit as high as 15% at some point, or investing in, I won't name any company here, because there's always a risk beyond the government. It becomes a bit difficult to persuade him, or for him to persuade his board that he should invest in industry rather than government. So it becomes, that is an issue which possibly you could enlighten us further in, because it's a bit difficult to appreciate the argument that the government wouldn't crowd out the private sector. Please.
Again, I think it goes back to leaning into the real economy and asking ourselves, the borrowings, let's say not of government, what are the people borrowing for? What were the banks lending for before that drop in lending, if there was a drop? They were lending for trade finance, they were lending for salary loans, they were lending for other consumer loans. They were not lending for investment. So what happened is that when effective demand went down, the consumer loans went down. And when we talk about government paper, I was trying to get the details before I came, but everyone in the Bank of Uganda was here already, so I couldn't ask anyone. I think if we break down the composition of who holds the government debt, you'd be very surprised. Because I think the biggest holder is my neighbor here, the neighborhood bully, NSSF. NSSF is not a bank. The banks, when you look at what those banks that have gone on to the capital market, the Stanbics, the DFCUs, I think Baroda, their shares have been oversubscribed. So there is money to be raised for long-term lending. That is not just looking at the commercial banks. I'd like to challenge every bank here that is not yet on the capital market to say to them, why aren't you on the capital market? There is one source of money. Why don't we look at the value chain of our supposed borrowers? Rather than saying your loan cannot work, or your proposal cannot work. Why don't we look at those sectors that are productive? Agribusiness, mining, tourism, manufacturing of local inputs. I think that's where you'd find a space for banks to lend at an effective rate.
Thanks, Maria. Maybe since you've called out your neighbor there, possibly we could get to him. Richard, you're sitting on a large pot of patient, very patient capital. Over the years, your investments have been limited to a bit of real estate, and as Honorable Maria has called you out, you've been investing massively in government paper. And yet, industry, which is really going to drive this economy, is not benefiting from that patient capital. The current UBRA Act gives you quite a bit of mandate. It allows you essentially to go into equity investments. At least it doesn't prohibit it. And as a lawyer, I'll always tell you that what doesn't prohibit in the financial sector allows. Why aren't you doing this?
Thanks, Joshua. First of all, I think that this conference is a bankers' conference. It shouldn't be talking about long-term finance, because long-term finance doesn't belong to commercial banks. The numbers that the presenter, I can't remember your name, Jared, presented, and I'd like you to go back to that slide, just where you show the private lending to the private sector. Shows you that commercial banks, although Matthias said that they actually do provide a gap between, can find money in their resources to basically provide for long-term financing, their balance sheets aren't made for that. Their balance sheets are made for short-term financing. And therefore, long-term financing cannot come out of commercial banking, because they'll be running a huge mismatch and therefore a huge risk if their depositors were to come for their money. So I think that this is the wrong place to talk about long-term financing. I think you commercial banks should be talking about something else, because this is not your space. But since you've asked me the question, let me tell you what our space is. We currently have a balance sheet of almost 8 trillion shillings. Of that, 70% is in fixed income. A lot of that fixed income goes to bonds. In fact, all our investments are more than 5 years, because 70% of my members are less than 30 years, and therefore they're going to be investing with the NSSF for more than 30 years, because they'll get their money at 55 or 60. So that means I don't need to invest for the short term, because they won't require their money. That's why we've got to invest in the long term. So yes, we invest in fixed income, but mostly in bonds, which is why Maria mentioned that we are the largest lender to government. In fact, it's about 40% if you look at the numbers. And that's because there isn't another alternative. The other alternative is obviously what you've mentioned, is in equities. We currently have a portfolio of almost 20% of our portfolio in equities. And what is this mostly in? It is in public equities. We have a small share in private equity, which is where you specifically allude to. But guess what? The biggest challenge for us is we can't find the deals to do in private equity, and largely because these companies will not come to the stock exchange, which is what Maria was mentioning.
Richard,
so
thanks.
companies such as roofings, who should be on the stock exchange, aren't there to be able to raise money on the stock exchange.
Richard, you've raised a very valid point, and I think this is where we'll go to Paul. Paul, the activity...
So can I finish my story?
We'll come back to that. We'll come back to your story, but you've raised some valid issues, which we'll we'll first deal with. Paul, Richard is essentially saying that he would want to invest in equities. He doesn't have a proper vehicle or cannot at least find good equities to invest in. And yet that's your space. Maria also mentioned an issue of banks focusing too much on transactional-based banking rather than looking at portfolios. Given that you are essentially the marketplace, shouldn't it be you partnering with banks like Matthias's bank, looking at his portfolio, persuading him to issue bonds off that portfolio, whether covered or not, or securitize that portfolio? Shouldn't you also be partnering with Richard by packaging this portfolio so that he has something to invest in? Because Richard essentially is saying he used to go to Maria to get bonds because you simply weren't giving him business. What do you have to say about that?
I'm glad you asked that question. Thank you, Joshua. Yes, our market is there to structure deals and provide long-term financing, and Richard or NSSF is a major player in the market. I think currently NSSF holds over 70% of the liquid stock, or what was listed on the stock exchange to date, because of lack of products. So why aren't we able to convince banks to come to the market to raise long-term financing? Well, there have been a couple of, I think, structural, systemic problems along the way. First of all, businesses have not clearly understood the form of what I would call the way to structure their long-term capital. There's short-term capital where the banks play, and that is usually 1 to 5 years. And then we have the long-term, 10, 15, 20 years. Now, we do have the investors. The difference between capital markets and the banks is that the banks go through, raise deposits and lend to people who need money, businesses. The capital markets, on the other hand, go directly to the investor, the saver, and to provide them a return, but also to give the businesses that have potential. The keynote speaker mentioned it. One of the things that is required is businesses that are looking long-term. Can you structure if you want an equipment that is 15, 10 years, manufacturing business, do you need to take out a short-term loan? Probably yes, to finance your 1, 2 years, but can you restructure this? The banks have been looking at the capital markets as a competitor, whereas we're actually an alternative source of funding. Whereas the banks should be able to lend money for 5 years, as the business grows, they should be able to, and those are their corporate and investment banking divisions, be able to refinance these businesses for the long term. Unfortunately, we've seen a lot of structured deals between banks trying to provide paper for 7, 10 years to large players. And I think a couple of speakers have alluded to that, which mismatches. We've seen a couple of businesses go out of, be liquidated and wind up. I'll not mention names, but we are all aware of them. But many of these were because of financing costs with the banks. And we have approached many of these businesses. However, one of the challenges we've faced is that businesses come to the capital markets when they are going down, not when they are growing, which is a big challenge we face. Businesses should come when they are growing because the investor is a long-term investor. He's looking for a return for their retirement. So if you do come into the market at the time when you have challenges, corporate governance and regulation will not let you come through and be able to raise money. And we have had a couple of potential applications that have to keep going back to refinance and adjust their corporate governance and regulations and the way they structure their businesses.
But now, on the issue of corporate governance, could it be that the kind of requirements that you have set for business in Uganda is not sensitive to how business operates in Uganda? Are you setting a standard that is unrealistic for Ugandan business? Are you not going down to actually understand these businesses and ensuring that your regulatory regime as USE is appropriate also to their purpose and their needs without necessarily exposing you to too much risk or the investor to too much risk?
I wouldn't think so. We follow best international practices and standards. And the challenge I think we faced is a lot of investors don't want to let go. They have built these companies. They're usually first generation or second generation. And when they look at the regulations and opening up their books to the public, that creates a challenge. There are issues around taxations, two sets of books, and many other regulatory issues. But I wouldn't think so. We have two markets on the stock exchange. We've got the growth enterprise market segment that actually hardly has any regulatory rules. In other words, even a startup can come and raise money depending on the risk profile, and different professional investors would be willing to invest. Then we have the main market segment, where NSSF plays a big role in investing and many international wealth funds. So I wouldn't think regulation is a challenge. Businesses need to adapt to best corporate practices to ensure that the investor, because this money is long-term and it's for savers and investors, it needs to be protected. Just like the banks are highly regulated by the central bank, we have to put in place checks and balances to protect the investors.
Thanks, Paul. Wilbert hasn't been looking at me too well, so I'll just throw this to the audience. We're pressed for time, and this is very unfortunate because this is such an interesting topic, and I still owe Richard a little more time. But let's get 3 questions. Wilbert, can I take 3 questions? So 3 questions from the floor, and then we'll go back to the panelists. Yes? Please state your name, organization, and then the question very briefly. Microphone.
Thank you, moderator. My name is Augustus Nwagaba. I'm a teacher, farmer, and naturally a cultivator of potatoes in Kabale because of failure of the financial sector to assist some of us. I am the one who did the financial sector deepening project for 2013. I'm also in charge of designing the East African community for all the 6 partner states. Now, my main concern is that I've just been here calculating the pecking order for the cost of borrowing. Use any pecking order for the cost of borrowing, use any procedure that will lead you to banks, 25 of you now, 25 I think, for where you can get money cheaply. And Chairman, where you guys you can get money cheaply is still listing your businesses on the stock exchange. This is where you'll get this money as cheaply as possible. But you have somehow refused to do that. Now, I've been with Fabian, in a discussion with Fabian, Governor, and Rui was here for a very long time. And my problem with our chairman, Fabian, has been, as Fabian, you know, my problem is, what is the cost of borrowing? And all you people in these banks, you know, you do not borrow to lend. You all know it. If you are running a bank here and you borrow to lend, put up your hand. There is no bank here, get it from me, which borrows because it wants to lend. It tell you, it's not there. You use our money, which our deposits. These deposits are very expensive for you. Very, very expensive for you. We would have thought that you would get money, which is cheap, and be able to use it. My mother comes, I come, you give me the money, which is cheap. Techiri yo, it is not there.
Okay,
now,
Mr.
Chairman, I've just been reading the Bank of Uganda Financial Stability Report of 2015. For us, where we come from, we use evidence. I'm a professor, you have to use evidence. The evidence is, I'm going to read the figures and then sit down. I'm just going to read the figures and sit down. The Financial Stability Report of Bank of Uganda, what does it say? Of 2015 is that, moderator, the interest charged, and I'm using 2015 figures, there's been 26 on average percent. I go to the bank, get the loan, how much do I pay? 26% Fabian. What is the cost? This interest income with the bank gets, what is the cost that they're going to pay me for lending my money? is, just listen, is 2.89% of the 26%. Now, what I wanted from Professor, my colleague, Professor Njuguna Ndugu, is that can we unpack? And you gave a very wonderful presentation there, but what you didn't tell us, can you unpack? What is the difference between this interest income and the cost of that money? For 26% minus 2.89% is a very big
Okay, Professor Nwagaba, thanks.
So
I think that's
what I want now to ask
very
is,
important.
Very, very simple.
Hey, you haven't yet asked. I thought you're asked to unpack.
The question now our presenters is,
okay, the second question.
Particularly my colleague Maria is, for us, we find it very difficult to come and borrow from commercial banks. And Richard has ably explained, it is very difficult to borrow from these commercial banks for some of us to do things which we are doing. Can we find a way in which these banks can be financed to really have the economy growing? The economy is not growing, the economy is stagnating. What is really this
Professor Nwagaba, thanks.
Yes.
Really,
so where can we get this cheap money other than really having?
We will make you a panelist at the next session.
Thank you, sir.
This is very but thanks for those questions. Probably we'll pass them on to the panelists, but let's first have all three questions. We'll go to Professor Njuguna.
Thank you very much. I'm not going to answer him now because we'll pick that up because there are so many studies that I've done on that have been developed on generating cost of finance. But I just wanted to come back to, I remember in the year 2000, the World Bank came up with a nice project on pension reforms. And we argued that time that it's going to deepen financial markets in Africa. Now, why I like the pension reforms is because I present something on board market and long-term finance. And one of the things is that, I'm not disagreeing with you, but I want to complement what you're really saying. Banks can read long-term, as long as the board market allows secondary trading, so that you solve the mismatch. And that is what we really need to encourage. Yeah. But of course, in some countries, these pension reforms went further. I remember in Kenya, the antagonism was between the retirement benefits trying to regulate NSSF, which was like, I've been here before you, and this kind of thing. But of course, in the end, it was really complementarity. But let's now investigate further, even how to bring down the cost of borrowing, because long-term finance is going to be helped. But banks cannot participate unless there is a solution to the mismatch of short-term deposits and providing long-term loans. And we have found in Kenya, for example, it works because you have secondary trading of the board market so that you can actually raise funds and you can synchronize in terms of that risk.
Thank you, Professor. Just one more question. The gentleman over there.
Okay, thank you so much. My name is Godfrey Joga Sebukulu. I work for a company called Craft Silicon Limited, and we operate on the edge of innovation in the digital financial space. And I want to react to Richard's comment that, you know, banks keep off, and this is our space. I think technology is redefining many of these things. And the big disappointment with some of the actors now is that we want to migrate with the baggage into the new dispensation, and that's how bankers think. When we say that we are going to migrate all the cash from the streets into the banking sector, it is real and it's here. And we are having street banking where you can pay for the fare of a boda using mobile money, okay? So which means the funds are going to be stable, velocity is going, and the tenure is going to also increase. And it's going to be like the sun. The sun comes out every day. We are told it's a ball of burning gases, but we assume it's going to be there for 100 years. And yet, strictly, if you go by that definition, ball of burning gases, maybe it's running out tomorrow. Okay, but we assume in the next 50, 100 years, the sun is going to be there. And that's the same logic that is going to apply to funds with these banks. Banks are going to sit with a lot of money, and we have successfully manage to externalize the cost, the transaction cost to the end user. So I think, Richard, you need to review, because now if I'm a tomato vendor on the market, I cannot invest in NSSF. Partly will save the law, but also systems. And to end my conclusion, we as Craft Silicon offered the central bank to develop an API for trading government securities. So the small guys can also do that thing. And the response was, no, please wait, we are not ready. Okay? And these are the kind of situations we are facing.
Thanks.
Thank you very much.
Thanks for that contribution. I think we'll first go to Matthias. You got the brunt of the questioning. Can we unpack that interest rate? Is it possible that the banks are just passing on inefficiencies to their customers? I mean, an assessment that was done last year put the level of bad debt in the sector to about 1 trillion. Now, obviously, that comes with a lot of management costs. So aren't you passing on the cost of this management, the cost of the inefficiency in appraisal, et cetera, to the customer? Please unpack the interest rate.
Thank you very much. I will come to the interest rate. But I just wanted to set the record a little bit straight on something there about long-term lending, and also address Professor Nwagawa on do we borrow to lend? Put up your hand if you borrow to lend. Yes, we do. For instance, my bank is active in the bond market. We've issued a bond before. And we borrow from a lot of sources. And as you heard Jared in the presentation he made earlier, we have to, because the level of domestic savings is not sufficient to do some of the things we do. For instance, we lend 20-year facilities and have done this since 1967. So we've been doing it, and we borrowed to do it. I wanted to talk a little bit about, and going for what the professor mentioned, a little bit, the bond markets. If you were to issue a bond today, what would the pricing come to? The 15-year bond has been at around 16.3% for quite a while, about 16. So if you did get money, say, at that rate, at what rate are you going to put it out at? So one of the things we are looking at is innovation, because you can't do the same thing and expect a different result. So we're looking at the possibilities of building the case for a mortgage liquidity facility here in Uganda, and we've started the conversation. We're trying to get the World Bank on board, get the Minister of Finance, all looking at this, the Minister of Lands, etc., to see that if we have that, we can have an intermediary between, in our case, as a primary mortgage lender, and the bond markets, and where we can have institutional investors, etc., play in an entity like that, which would have better negotiating capacity and better rating and all that, to be able to bring the cost down ultimately. This is a long-term solution to providing long-term finance. Now, in terms of the costs and why rates are what they are, and I know the chairman has engaged you on that particular aspect, there's a lot that comes in between that difference. The bad debts, for instance, which are many times the circumstance of many things, not necessarily the banks, how the discipline, etc., and what people have eventually utilized that money for. That's a major cost. That is the kind of cost that, as you know, can almost be limitless to almost to the existence of the institution. But there are many other things, the operating costs, and of course there's a premium, right, that you have to put on the lending. There's a credit risk. You have had the new risk, which we have to look at as well, which is the risk of monitoring all that through technology. So there's a combination of things, but it's really, really not. That is the tiniest part of the base.
Thank you, Matt. I think we'll then go to Maria, and Maria, I'll also ask you, after answering one of the questions that was put forth, to also give your closing remarks because of time. The gentleman who asked the last question talked about the possibility of government selling bonds directly to ordinary individuals who may be willing to take a coupon of just about 10%, rather than the 15, 16% that commercial banks ask for when they bid. Is this a plausible way of government continuing to fund budget deficits while ensuring that there is lower pricing in the sector, and therefore motivating commercial banks to lend at a lower interest rate?
The government is the government. Its job is to collect taxes and reallocate them. They're not productive. I think what we should be looking at here is how to increase and improve the mechanisms in the capital market, which includes banks, which includes private equity firms, which includes the Capital Markets Authority. For instance, what government could do is to hurry along the pension reforms, which would enable more mechanisms for mobilizing long-term financing to become active. Because the market is there. You see quality issues, stock issues are oversubscribed. There are other provident or pension funds that, apart from NSSF, over and above NSSF, people are willing to pay extra. But the financial sector must help in this. The telecoms must help in this. We can now use fintech, you call it fintech, to bring down the costs of transactions. How could that be used to bring down the costs of bond issues? 2 months ago, a phenomenon took place whereby in order to keep your telephone, your mobile phone connection or your SIM card connection, you had to register for the national ID. Overnight, Uganda is now got a database of consumers. All these people went and registered for the national ID because they wanted to stay connected. That can be used by the banks. That can be used to bring down the costs of credit references and loan appraisal investigations. We can use, again, technology to de-risk some projects in, let's say, agriculture. How do you do soil analysis, weather prediction, or low-cost irrigation? These are the things that the banks and the non-bank financial houses need to look at along the value chain to see how can we encourage people, how can we help them become good business people. And in closing, I'd just like to say that the banks, along with the non-bank institutions, need to beat the drum. It's not for government. Government can maybe, migrate its payments, some of its payments to the mobile platform like the governor from Kenya was telling me about at the table earlier. The government can help with regulations and reforms to improve costs of doing business and the ease of doing business. But at the end of the day, it's down to the financial houses and down to the productive entities.
Thank you, Maria. I think, Jared, you must say something, particularly regarding the issue of the pension reforms and the way we can draw pensions into the bond market. But before you say that, is there an issue that we're all ignoring? The issue of basically the structure of the economy as it is now. I mean, we've had current account deficits over the past couple of years. They are continuing to grow. That is putting pressure on our currency on a continual basis. Inevitably, it's going to keep the central bank intervening, sending up interest rates. Is that something that also needs to be addressed? If you could speak to that, and also regarding how we can draw pensions into the bond market. Yeah.
I think I'll speak to that, the issue of the current account last, but I think a couple of thoughts. If you really have to address the issue of long-term funding, you run a risk if you start segmenting the financial system. You have to look at it holistically. And I think if you look at the banking market in very developed markets, the menu of the financing of the banking, of the banking industry is, of course, there's equity from shareholders, there are deposits, but they don't necessarily constitute the largest portion of the funding source for banks. There are long-term bonds that those markets issue. There's what you can call the unsecured bonds as well as asset-backed securities. And that's why, you know, if you shy from going that route, then you will have your total credit as an economy, as a proportion of GDP, lying below 15% as it is in Uganda. In an economy such as Kenya, it's not that high, but it's about 40%. In South Africa, it's closer to 150% because they have managed to deepen their financial system in a manner that is holistic as opposed to a manner that's segmented. That's just one component. The other is regarding, and this arose in one of the questions here, technology. In Kenya right now, the government is trying to promote the issues of a bond using mobile, what they call Emakiba. And those are very low denominated bonds. And the cost of issuance is going to come down because of using the technology to issue some of these developments. What I'm saying here is that government borrowing should not be looked at it suspiciously because of the argument of crowding out. The government borrowing actually has a market developmental dimension. Crowding out needs to be seen in perspective because you can crowd out using what they call a quantity channel, meaning taking money that can otherwise go to the private sector, or through the price channel, meaning if you influence the price at which money is lent eventually. But I think that has to be interrogated deeply so long as it doesn't verge on debt unsustainability. The government can still go into the market and borrow. Now, regarding pensions, I think there's quite a bit of scope in terms of enabling those long-term resources coming to funding the economy. And I think it requires deeper reforms in terms of enabling the pension funds be able to participate more meaningfully in the capital markets. And I think there's quite a bit of work that has been done in this space, and it can go on. I think one segment that we've not talked about is really the role of development financial institutions in that space, because they have a role to play, even if it's complementary. We have the international DFIs, we have the regional DFIs, as well as local DFIs. They should not be seen as the only solution, but I think they have a complementary role to play insofar as enabling longer-term resources to be channeled to investment is concerned. I think the only challenge we have is that, for instance, in Kenya, we have a number of DFIs. We actually have 5 DFIs. There's one for agriculture, there's one for tourism, there's one for industry, there's one for commerce, there's one for small businesses. And all of them are struggling. They can't sustain themselves. I think we have to start thinking about the structure of the DFIs that we have and how that can complement the other aspects of the market. And that's what I talked about, looking at it comprehensively. And in India, for instance, the Reserve Bank of India just published a discussion paper on establishing wholesale banks. Banks that are there basically to channel wholesale resources to other lenders so that they can be able to channel resources to the real economy. It's a discussion, but I think the core point there is that sometimes you have to weigh the balance between, if you have a problem, do you create an institution or do you have a policy framework? And I think that's a bigger debate.
Thanks, Jared. That's very well put. Richard, I promised you additional time.
Yes, because I hadn't finished my presentation, and you just can't call me and not give me enough time to tell you my view. If you look at Twitter now, at the moment they're asking me why, where would the money come from? Okay, so I first need to explain how the money structure is based here. And I've got the numbers to show that. If you divide the buckets that fund this market, the 3 buckets, you got the short term, largely financed by commercial banks, and short term, I mean money that's available to borrow between 0 and 3 years. You've got the medium term, which is money available to borrow between 3 years and maybe 10 years. And then you've got the long term, which is money that's available over 10 years. So if you go to the first bucket, that's largely funded, that's only funded by commercial banks, because ostensibly they do fund the short-term end of this. And that's why the Ugandan market is a little bit skewed, but I'll explain that a little bit later. So the medium term is largely funded by, it should be Uganda Development Bank. In fact, I know it's the only one that's local, apart from the other money that, say, comes from Apex that Honorable Maria mentioned. But that's largely funded out of Uganda Development Bank. And then you've got the long term, which is largely funded out of pension funds and insurance companies. Now, let me tell you how much is in these buckets as far as Uganda is concerned. Commercial banks, total balance sheet, if you look at the numbers, I haven't seen the updated numbers as at the end of last year, but I would say it's around 15 trillion shillings. So that's what is funding the short term. The medium term is, as I said, largely funded by Uganda Development Bank. That's around 500 billion shillings, all right? And I'm being very generous because, you know, the balance sheet of Uganda Development Bank is actually not anywhere near there. And then the long term, which is, as I said, largely funded by the pension sector, plus what comes out of the insurance, is around 10 trillion shillings. So a total of maybe 26, 25 trillion shillings is basically what's available for borrowing. But who uses these funds, all right? You've got the trade finance, and if you had put up that slide, you'd have seen that a lot of this money actually goes to consumption. It goes to trade finance, which is basically your traders, and it goes to a little bit of working capital. So that's what the commercial banks are doing. But they're doing very little of that because there is a big brother called Uganda government, which, because they aren't sufficient funds in the medium term and in the long term, they are encroaching on that space. So they're coming and actually raising bonds, long-term bonds, out of commercial banks. And commercial banks are very happy to actually finance that. So you find that the challenge is that if you look at the ratios between your long-term financing and your short-term and medium-term financing, it's a ratio of 60 to 40. In other words, there's only 40% long-term financing to an economy which requires a lot of infrastructure investment, capital markets, and mortgage financing, and also capital expenditure, especially for the companies. So, and those tend to be large sort of tickets. So there isn't sufficient funds within the long term to be able to fund the long-term requirements, which is why these companies, these institutions, government are all coming into the short end of the market, and that's why interest rates are high. So if you are able to deal with the issue of pension reform, right, and that's where I would like to end, as the Professor Njuguna has highlighted, pension reform, look at how much NSSF has been able to do with 1.5 million, 1.7 million members of this country, right? Supposing we were able to tap into the 15 million Ugandans who need to save for their pension, we would have a much, much larger pot to be able to resolve all the problems in this country.
Thank you, Richard. And thank you to the panelists. I must apologize because we simply haven't had sufficient time to do justice to this topic. But let's congratulate the panelists for the time that they have spent with us. Thank you very much. Henry, back to you.
Thank you. We can leave?
Yeah.
Thank you.
I like the buckets.
Absolutely.
Thank you very much. But I want to thank all of you for the wonderful patience. Lunch is ready. It's upstairs in the Katonga Hall. We're going, unfortunately, to limit the time we spend at lunch so that we can come back and discuss agriculture. We shall have, it is 2:30 now. We'll be asking you to come down from lunch at exactly 3 o'clock. We have a number of service points, so we should be able to go through lunch pretty quickly, and let's come and enjoy an afternoon of agriculture finance discussions. Thank you very much. Kindly make your way briskly to Katonga Hall on the top floor and have a nice lunch.
Begins This is all I'll ever ask of you. Tell me your dreams so they can be mine too. Let me be there to help them come true. Tell me your fears when you feel afraid. Come to my arms, let me rock them away. That's all I'll ever ask. That's all I'll ever ask. That's all I'll ever ask of you.
Good afternoon, ladies and gentlemen. I've got most of the panel are here, so if we could settle down quickly, we can get going. I know it's a lot later than we had planned, but information never gets stale. Ladies and gentlemen, we're going to start the afternoon session.
Our products are basically at finance, which is relevant today, financial services development, lines of credit, including a small clean technology facility, and credit guarantees, as well as general fund management. So I think this is important for us all today, that in financial services development, we are looking at outreach. How can we further digital financial services? Because therein, we believe, is a solution to many unbanked who are in the agriculture sector. And with some of you, we've already partnered and continue to partner. Support improvement of financial skills. This is an ongoing process. I think the gentleman from Gillard told us how some specific risk management skills need to be inherent and part of our processes. We are investing in so much technology to protect ourselves, but skilling is a continuous process. Then product development, liquidity, and risk management, of course. So in lines of credit, I think that speaks for itself. We want to see the on-lending across the entire value chain. So it could be in forms of production, processing, or even clean technology facilities. In the credit guarantees, and that's an example of one of the plants that was actually guaranteed for one of the development institutions to be able to actually complete it. It was quite a sizable deal, but its completion has meant that there is a pool for over 16,000 grain farmers who now have clear credit terms from this particular provider and have improved the quality of the grain that they supply him. So from a fact sheet point of view, we have currently around 25 financial institution partnerships, and that is the amount of money we've leveraged in partnership with you, about 780 billion since 2010 when we started, and a little smaller amounts of agri-insurance beneficiaries, which just started along the way. In there is also 70 branches and branchless mechanisms. We look at the additionality. The blue columns is actually the growth in the agriculture financing sector as reported by central bank. This leaves out a lot of the smaller entities actually that finance production, but it gives us a good estimate because largely the volumes are here. And the line is our own contribution in terms of percentage. We are pleased to note that it is decreasing while the financial institutions are really growing much faster because we think they are really going over the curve and really doing more with agriculture, which is our interest. In terms of the value chain approach, this is always better to have a pointer, but let me give it a shot. The conducive environment, especially our own, may not always be conducive. We want to see the roads, we want to see the irrigation, we want to see the warehouses, we want to see the extension services, but well, we saw the budget, it's 3.8%. But we're not going to sit here and wait for, well, government at Yambe. We need to do something about it ourselves. So what we are thinking is that ABI trust component is our own small contribution to seeing how can then the farmers, if they don't have all the extension services, be supported, be grouped up, be organized to be made more palatable to you, or to be made more presentable to financial institutions. It also means that in some cases, the kind of funding that we give there will be more justified to be a lot more concessional or even grant. In case of setting up, say, a warehouse, these have been supported in northern Uganda in terms of setting up actually collection centers, not warehouses, that have also supported farmers then to have a stop where players in this very room have been able to go and tap in and give some financing. Then we look at the lower column, the green one. The middle part is showing the various segments of the value chain. But the middle one still points to, you may de-risk, you may support the conducive environment, but then you still find that there is illiquidity. And that is sometimes caused by timing, like we had from the last session. Sometimes we have the liquidity, but it's the matching of the assets and liabilities. So we have those small lines of credit that we then promote down there. We know we work in partnership with varied other entities like EIB. We really find them in your books also supporting these very causes. So I was surprised when one of the panelists before was wondering whether you borrow money. I know from your books that you actually do borrow money. And then, sorry about this may be a little too hard to take in, but basically it was about showing the varied products at the various segments of the value chain. What stands out in all of them is the short-term working capital. It will be required by a small producer, it will be required by a medium-sized producer, but it is also required by an exporter in varied forms. So there is a place for good commercial money where it falls and short-term, but there is also space for long-term. So what happens in some of these entities is we find that they are using short-term because it's what is being provided to manage the long-term, and that's also already a recipe for disaster. So part of the promotion is to try and work and partner with you. So if your challenge is the mismatch, can then the more longer tenured facility come in to match the facility that a processor requires for their entity? So this guide to VCF, or to value chain financing, I actually picked up from Agrifin, and it was put together by the World Bank, because they believe that there are some basic things that need to happen at a commercial bank level to guide you if you're to look at the value chain. First of all, you need to have focus. You all can't do the same thing. Fabian is not here, but Fabian's segments, Centenary Bank segments are good to note that they actually work across varied segments by virtue of their clientele. So they have a microfinance, but then they also have the SME space. Then you find that there is, for some institutions still in the room, that space may never be there because it's more corporate. So have your focus, and in that focus, have your target segment. But in that target segment, for sure, there will be some agriculture. So some of it is going to be a pull effect in terms of, say, a big processor, who I believe some of them are in this room and could speak today. Then you map that value chain. Sometimes in other lingo, it is called the value chain analysis. You identify, quantify the flows and relationships, because it's about that flow of relationships where we identify the gaps and what we need to plug in production or processing or marketing. Then you pick up the necessary collaborations. And in here I say, we are one of those collaborations. I'm aware of many others. Some are also in the room. I note very strongly that financial institutions need these partnerships. Why? It is that discussion about the enabling environment. If the environment is not well enabled, we have in place initiatives also, by the way, by the government of Uganda that can support you. The only challenge is sometimes you're too busy to seek out these collaborations. But if you have a long-term outlook, you need to engage in these collaborations. They are good for your book in the long term. They are not just for shaking off. Then you can tailor your existing products to the specific needs of that segment in that value chain. And of course, the risk management also can entail collaborations. And what are the kinds? What are we looking to see in, for instance, the insurance space? Is the 5 billion allotted as a pilot going to be good enough? I don't think so. We need a collaboration there. And then, of course, adapting structure, your own structure as a financial institution, adapting it and your operations to be able to target that particular segment. It is always wise to pilot. I was very glad to sit next to a person over lunch who was going through a pilot a year ago and is now ready to roll out big time. So I believe in some cases, some pilots fail. I've been a part of failing pilots, but then the loss is minimized. So you pick yourself up and move on. So innovative ways that we think are possible going forward is there is promise of a new generation. Lately we see in the papers, best farmer, you know, there is some vibes going out there of younger people in out there who are really looking at in investment clubs, for instance, because the investment options are few. They are looking more to who can guide us do more in agriculture. And I think these are the kinds of people that you as bankers are used to. I know DFCU is very strong on its investment clubs, and I'm aware that there's many investment clubs which are looking out for where are the next investment opportunities. Not everyone wants to simply invest in bonds. So we also think about the partnerships and collaborations. I'd already mentioned those. It's an innovative way. I know some of you feel belabored with some of these partnerships, because usually as funders or donors, we are very demanding on the information we need from you. But if you have a long-term view, we have also seen evaluations that have reported a lot of growth, especially in specific segments for institutions that have done collaborations. We explore use of emerging technology. This has already been presented before, so I'll skip it. I see a huge opportunity in agency banking, because it's going to reduce your cost, it's going to put you out there, and the reason for cost will be removed from you, so you can also bring the pricing down overall. So we pair immediate needs with long-term desires, bundle loan products to include farmer priority, but this assumes you've done the slide, the previous slide, the slide before well enough, that you've actually targeted a segment, you're aware about it, you know you can actually finance production, and you have a way and mechanism. Then you explore opportunities in insurance. Do I still have time? Okay, I have a minute, and I thought in that minute I could give an example, because all this is just out there. So I'll give an example of an institution. I'm afraid I cannot say the names because you bankers have this issue of confidentiality, and I didn't take the time to ask this particular financial institution to give me the permission. But basically, this is an institution which is really a big corporate. What it is doing is indirectly availing credit to its very distributors. And this particular then distributor finds that they cannot actually pick up enough produce to fulfill their contract with this big manufacturer. But when the manufacturer walks into the room of one of these banks, they can actually get some credit. They'll take their guarantee. When they say, I'm guaranteeing Josephine Limited and Sons to supply me, give them an overdraft of so much, they even actually rule on the rate. That particular rate in this instance was 17%. It's allowed because their guarantee is good, well backed. Then in all this scenario, the failure came, there was not enough grain. So we happen to be working with this particular distributor from the point of production. How many farmer organizations do you need? What is their capacity? What needs to be done? And they're receiving extension services. So you go through all these modalities that ordinarily maybe a government should provide. But in this instance, they are not there. So should they stop? Because now they had two running entities for WFP and for this manufacturer. But what happened is now to have the groundwork with them, which in that capacity was technical assistance and a grant. But at the same time, there was an element of need of supplier credit. Because on top of picking up the grain, which is the short-term working capital that the bank could give, they also needed to have the cleaning facility enlarged. So that one was no longer short-term working capital. That one required a facility from the supplier of the credit out there in Denmark. So what happened is the provision now of a guarantee. And that's the guarantee that an entity like ABI, for instance, can give you, or any other. Then that money flows. But the farmers that are impacted in that entire chain are many. And they are not just impacted for producing grain for this one processor, but they increase their capacity even for the market. What do we need to look out for as we go this way? There is a very big, the warning sign is around climate change. What are the clever things we can do? I believe we are going to discuss some of them. There is the population growth versus the GDP growth. because that really puts a strain on food security. It's a reality. There's the increasing fraud incidences and the hackers. This is around part of what we discussed before. As we go agency, as we go mobile, as we go all these things, we really need to take our caution here. And there is displacement issues. Right now, we really have an influx, say, of people from Southern Sudan coming in. There is an implication on land. There's an implication on food. Thank you very much.
Thank you very much, Josephine, for a rushed but hopefully coherent and helpful presentation. Before we get into the questions, I just want you to indulge me for a second. I want to ask a very quick question to the audience. By a show of hands, how many of us consider ourselves, and this show of hands, I must say, is a friendly show of hands, unlike the one that we're asked to do before lunch for the bankers. How many of us consider ourselves to be farmers, by any definition? Show of hands, be brave. Okay, I am the Electoral Commission and everything, so I'm saying 60% of us have put our hands up. Thank you very much for that. So to the experts, I want to warn you that you're dealing with experts in this field and therefore tread carefully. We often moan about access to credit, especially when it comes to agriculture. And we like to moan about government's own allocation in the budget and so on and so forth. In actual fact, Josephine is telling us that credit to agriculture is growing. In fact, the numbers that I saw from the central bank show that it's growing much faster if you compare to the rates, the levels of lending in 2010 to 2017. Lending to agriculture has grown much faster than any other sector in the economy and the total sector growth. So in actual fact, we do see some improvements in terms of credit to agriculture. However, when we get into the meat of it, the performance is really dire for Uganda's agriculture sector in terms of, we were told this morning, as much as 48 or 50% of the arable land in East Africa is in Uganda. 35% of Uganda's land is arable, 10% for Kenya by comparison. However, when it comes to agricultural value added, we are really lagging behind as a country compared to, for example, our neighbors in Kenya and even Tanzania. And of course, enough for you, Mr. Kira, is really around reflecting on your experience with ADC in Kenya, but also your many hats and your vast expertise. Looking at some of the dire statistics in Uganda, the level of mechanization for Uganda, according to my sources, 4,700 tractors in Uganda compared to 12,800 in Kenya, compared to 30,000 in Nigeria. Fertilizer usage, 9,400 metric tons compared to 143,000 metric tons in Kenya, and a smaller number for Tanzania. Not surprising that we're struggling with productivity and yields, but based on your experience in Kenya, which is a good model for us, if I may say, what opportunities do you see for banks to really change the game from an agriculture financing standpoint, and so that we can begin to see, and it's important we talk about the entire value chain, so that we begin to see the sort of yields that are necessary for Uganda to really be punching within its weight category. Thank you.
Okay, thank you. First of all, the issue of farmers at the production level need to be addressed in terms of ensuring that they have the knowledge. One of the challenges that we face in the agricultural sector is the knowledge to be able to produce efficiently and to be able to produce at levels that are required internationally. What I would say is that in the challenge on the financial side is there's always been a focus on a specific point within the value chain. And when you look at the financing, you would see they would either be looking at the processors very easily and favorably at the expense of the actual production. And you cannot have a successful enterprise or a value chain of a specific commodity if you have not dealt with all the players within that chain. For farmers, for example, for farmers, for example, in the seed sector, I would give an example. The processors of the seed companies would only be successful if they can have enough producers or bulk seed suppliers, bulk farmers who can produce for them. But then these farmers require information. They require training. They require support. And the focus is, however much you may focus on the processor, without focusing on the production, there's a problem. So there is really need to begin to look at the value chain approach in terms of commodities financing and in terms of production within the farmer chains. I would also say there is also a challenge in terms of ensuring the banking sector or the financial sector avail the resources. Okay, there need to be a dual playership between the development finance institutions, those that can train and equip the farmers, because information is lacking at that level, and therefore the farmers do not have the knowledge or available information to be able to produce. There is need to ensure that this information is available to them. But my focus is really the way we evaluate the financing of these enterprises. There is need for a new way, a new toolkit of evaluating, so that instead of focusing at a specific chain, a specific point like farmers, you look at the whole chain. If you can finance the farming, the producers through the processors, or if you can finance the processors through the uptakers of their product, and then to the market, there is need to look at that, and therefore have a different way. It's not the normal way we know in banking of Campari or 5Cs. There has got to be a different model of looking and financing agriculture.
Thank you very much. And saying that reminds me of Josephine's presentation about what ABI does, helping to matchmake and to support the FIs. But I think it also sounds like financial institutions themselves must be thinking about cross-partnering with one another, because some of you will be interested in the processors, others will be interested in the farmers. And is that something that can work, in actual fact, whether between commercial banks or between commercial banks and other non-bank financial institutions? I'd like to move on to something which, again, we bemoan a lot. Government has done a lot in agriculture. We are aware now, we're talking about the breach, stepping into the gap and saying where there is no government, where government can't be everywhere, clearly. And in this case, I want to recognize that government spending on agriculture in this country actually compares very favorably compared to our neighbors. So we need to give recognition to government in that regard. And in asking this question, we do not wish to point any fingers at anybody, but really just saying, what can we do as the private sector? Our government has recognized that execution efficiency is a major weakness. It's an area where we have underperformed, particularly in agriculture. Project execution is slow. There's been a disaster with seed distribution, with a huge amount of wastage of seeds distributed in the last financial year, according to the budget speech. In addition to other challenges, post-harvest handling has not been sorted out, and so on and so forth. We're looking to the private sector to learn some lessons here, and I want to turn my attention to James Bowmaker here. With your experience at Nile Breweries, with a fairly successful story there that you could give us a very small sort of snippet to get an understanding of what it is, but what do you see as some of the lessons that we should be drawing, and what does the Nile Breweries story really, how does it relate? I mean, what lessons do you have for the bankers in this room as a way in which we can step into the gap on the one hand, and on the other hand create an ecosystem that allows manufacturers such as yourselves to actually meet an action need successfully and economically?
Thanks. Firstly, I don't think it happens overnight. If you look at how we've done it, it's been going on for 12 years. So you can't expect something to happen overnight. It's something that is long-term, and you work and learn along the whole process. So we've got about 15,000 sorghum farmers. We've got about 4,000 barley farmers that we contract through aggregators, okay? And we have in the region of about 17 extension officers who support those farmers. There's not enough of them for the number of farmers, but it's all we can afford. The big thing that we've learned, unfortunately, is that a contract means nothing to a farmer. And the value chain between the farmer and ultimately to us is too long. So you go from a farmer to an agent, to potentially a transporter, to an aggregator, to a storage person, and then finally to us, and we make our product which gets to the consumer. And that's far too long. So we need, from my point of view, for the government to be able to bring in better laws around cooperatives so that the groupings of people to farm those better would enhance economies of scale. So I would like to see, from the government's point of view, a better look at how cooperatives are legalized, what type of people get elected to head those cooperatives, how they are governed, because from that point of view, I think if that is improved, you'll see a significant increase in yields because you can use far more better mechanization. The other thing is that it will be easier to finance, and the volumes will be sufficient so you can go straight from the farm to the storage and bypass a lot of value chain, which is actually taking away the profit from the farmer. And because the farmer's not getting the profit, none of you guys are willing to finance them. So if you look at a farmer's margins, his margins are nowhere near the 25% that you guys want to charge them. They're way less. So he can't afford the interest. So the only way to get around that is through the improvements, as you said, around the yields. And I think the best way to do that would be a far better way of aggregating the farmers and not necessarily aggregating the collection. Okay, so from that point of view, I'd like to see some better statute around that. The second thing is that we've learnt is that we've written off extremely large amounts of money over the last 10 years. Because contracts, because people disappear, and hopefully now with the new ID system that will be less. But that has been part of our development and part of our commitment to government, because I know you complained about the 3.8%, but you've got to understand that the government has also given a lot of other benefits for the use of Ugandan products. So we would not be able to produce some of our products as if they were used as imported products. The yield that we get out of the products in our process of manufacture are far lower than the imported products. But by them giving different excise rates, they've obviously lost money in the excise collection through giving a lower excise rate so that we can now buy 90% of our raw materials in the country, which is in the region of about 23,000 tons of various cereals and goods. So I think you've got to be careful about saying 3.8% is too little. You've got to also look at the other places where they've helped. The other thing is around debt recovery. And I'm probably talking to the converted, but the judicial system and the laws to recovering debt definitely favor the defaulter. When we have defaulting farmers, aggregators, agencies, it's incredibly difficult to recover any type of debt. So I would like to see some where the government could step in and assist in that sphere. And then the last thing, which I think maybe the guys here failed, is a couple of years ago when we had the low interest loan which was basically for producers. I don't think it was subscribed quick enough and done and actually implemented quick enough. And possibly government got upset with that and therefore are not going to go further in that. And I think that was an opportunity for a lot of us to grab and do quickly. But yeah, so firstly it's a slow process. You have a lot of learnings, and you've got to learn the people that you can trust.
Yeah. Thank you very much. Thank you very much. So that's a very interesting 12-year lesson, and I think anybody serious about agriculture financing ought to have a long conversation with yourselves. Mr. Bemba, turning to you now. James has talked a lot about bits and pieces that perhaps government is doing quite well, and other bits and pieces that need another look. Some of us look at agriculture, the government policy, and think it's perhaps been far too skewed towards the poorest of farmers who have simply no ability to invest, and in fact it's often said when they're given seeds, they must choose whether to plant the seeds or have them for lunch. You are a development worker with many years' experience as well as a seasoned marketeer, but I'd like to know from you, based on your experience, what do you see as the necessary sort of policy tweaks to really spur and from an output standpoint? And I'm asking this question bearing in mind that government made some very optimistic projections about the increase in coffee to be produced, and cotton and tea and so on and so forth. Talk about tripling and quadrupling in a few years' time. How do you see that balance working? And then what sort of advice would you be giving to this community of bankers in terms of what role can they play to see that we can move towards that journey positively?
Thank you very much. I think as an institution, we work along the whole value chain. And what we have noticed is the role of the private sector in driving our agriculture. And you will notice that once it is private sector led, you are more likely to see farmers coming along to provide whatever output that the private sector may be demanding. And in this particular case, we have seen success stories, just like he has talked of the breweries example. We have also seen it with the Mukwano. So if I were to advise the government, I would want to see a situation where government increasingly looks at working with the private sector to drive the agriculture sector, as opposed to working with pockets of farmers in their individual capacity. And that's why it is very obvious that some farmers will receive inputs and then probably choose to eat them or to grow them, because probably government has provided the seed, but they are not sure of the market. Nobody has talked about that. They have received the inputs, but they are not sure of what happens next after they have produced. Now, as an institution that has worked with along the whole value chain, you notice that when you work with the private sector, farmers' confidence goes up. Because what you see along this whole value chain is there has been a lot of mistrust between the different actors. Banks not trusting farmers, farmers not trusting the banks, farmers not trusting the traders, traders not trusting the farmers. And sometimes you are caught in between and wondering, where should I start this? So as we work and move forward, there is need to work more towards public-private partnerships that will enhance and improve relationships along the whole value chain.
Okay. Yeah. Thank you very much. That's very helpful. So Paul, you've heard from various stakeholders, and you happen to represent industry on this particular panel. And I think it's fair to say that if you look at the credit, and I'm really reading into the statistics because they don't break them down to that level, to suggest that the bulk of the growth in agriculture credit has gone to large farmers, not necessarily to the smaller farmers. We simply don't yet have the mechanisms to get that level of credit out there. And clearly we wouldn't have this topic if we didn't want to see a fundamental change. And there's been a lot of talk from this morning about how we can leverage technology, how we need to use agency banking and other modes of reaching customers to really get down to the really productive, to producers, and really create some growth there. What do you see? What excites you as a person that is looking very keenly at agribusiness? What is it that excites you about the future for banking around agri-finance, bearing in mind the opportunities afforded by technology, by agency banking, mobile money, and so on and so forth? Switch on.
Thank you very much, Utman. And also thank you very much to the rest of the panel, because a lot has already been said. What we should do as an industry to improve access to financial service for farmers. Well, what excites me is a couple of things. First of all, I think all the banks recognize the importance of the agricultural sector in Uganda. I mean, you opened your session by asking how many people in this audience are farmers, and I think it's easily 80%. Now, the question you raise is how do you reach out to that lower end of the market? And as I always say, there are no unprofitable segments, there are unprofitable distribution methods. And what excites me is what has already been discussed this morning, that there is a lot going on in the sector when it comes to digitalization, agency banking, mobile banking. So I think it will be easier for banks to reach out the mass market among farmers. So you see exciting developments there. But still, even then, it would require the enabling factors that also have been mentioned here, because financing a sector that is not financeable, that will only create bigger problems in the future, that will create defaults. So we still need to ensure that both parties understand each other. Farmers understand banks, banks understand farmers, and a lot is done in that aspect in this market. So I see a lot of good developments. I see banks going into the processing sector, among them ourselves. I see the new channels. I see partnerships with fintechs. I see partnership with mobile network operators. I see partnerships with parties like Abitrust. So I think what excites me is that we are getting there, but the enabling factors need to be in place. A contract needs to be a contract, because if we want to finance the value chain, which is in the interest of all banks, we need to ensure that it's a reliable value chain. And as was mentioned, a contract is not always a contract. So the culture, in that sense, also among the debtors need to improve. But there are exciting developments. There is digitalization, there is agency banking, there is a lot is invested in training and teaching farmers and bankers in getting to understand each other. Okay. So I think lots is done, and we're getting there.
Thank you very much. You mentioned the issue of contracting, and I think recalling James's submission around cooperatives and an aggregation and governance around farmers groups, and I think that's a massive, massive takeaway for the Bankers Association in terms of how do you engage government going forward on some of the must-dos and some of the things that need to be done differently. And how do you integrate with all the other bits and pieces going on, whether it's circles or investment groups and so on and so forth. Miriam, final question for you. We're really pleased to have you here because it's not just a recognition that lending to agriculture more than any other sector is really about risk. Yes. And on that risk is, there's a lot more beyond the control of the farmers in as far as risk is concerned, over and above absconding and delinquency. We've also talked about climate change and talk about drought and so on and so forth. But at the same time, we're looking at the entire value chain. And we're talking about an insurance industry with very low penetration rates, few opportunities for growth, a lot of competition for the same business within the established corporate world. What do you see as the position of Uganda Insurance Association around the opportunities for agriculture and the appetite to really make a difference and to support the lenders coming into this sector to ensure that you can all grow together and change the game?
Thank you very much, Uthman. Good afternoon, ladies and gentlemen.
Good afternoon.
Let me try this again. Good afternoon, ladies and gentlemen.
Good afternoon.
Okay. Thank you very much, Uthman. I was hoping that we won't go back to penetration, but I can never escape from the question. I'll first ask a question. How many of the farmers here have insurance? Thank you very much, Governor. How many of the farmers here have insurance? And that is where we are today. What Uganda Insurance Association is looking at is basically consumer education. I definitely agree with the governor. The aspect of financial inclusion is very important, and we are looking at consumer education. Now, as the association currently, we are managing the National Agriculture Insurance Scheme, where government is actually subsidizing insurance premiums. So the bankers here, who are farmers, whether small scale or large scale, yes, government is paying part of the premium for you. So we do have some banks on board. Now, as insurance companies and the association, how can we support the banking industry? At the insurance level, we're looking at what we call insurance bundling. So we basically offer value propositions. The small-scale farmer, all our risks are centered around weather, climate, and for the bankers, it's really the risk of default. So my first question to the bankers is, can we factor the cost of insurance into the cost of credit? That means you'll have to slightly lower the interest rates. But what that does, and I agree, it drives volume and economies of scale because we reduce the cost for the farmer. So if we factor the price of insurance into the price of credit, then you definitely have farmers finding credit a lot more affordable, and then you grow investment in agriculture. We can also support them from the perspective of course, the other challenge that small-scale farmers have is counterfeit inputs. So we are working with the seed providers to make sure that they can factor in the cost of insurance into the cost of the seed without necessarily increasing the cost to the farmer. So if the seeds fail, then definitely the insurance company can support both the seed providers as well as the farmers in terms of providing, compensating them in terms of the loss of seed. Then somebody else mentioned, because we're looking at de-risking across the insurance value chain. Now, farmers also need access to information, and the insurance companies can definitely support this. The insurance policy would also come with access to technical information, especially in terms of the agronomy space. Somebody mentioned contracts. We're also looking at, and we're already working with some farmers, and that is where the point of cooperatives is very important, because it's easier to grow the sector from an organized perspective. And the cooperatives can definitely support this. And I definitely agree, the governance issues, the legal issues are very, very important. But cooperatives also help in terms of access to markets. And from that perspective, the banks are happy, the insurance companies are happy, as well as the farmers.
Thank you very much. Ladies and gentlemen, time is a massive, massive constraint. And I would like to hear more from the panel, but I think we'll now be as democratic as you are in your farming and turn over the microphone to yourselves. Because of the time constraints, we're going to take 4 questions, and they're going to be only questions, like I said at the beginning. No long introductions, no points of view. Please state your question so that we can try and catch up with the program. There's somebody in the corner there. Another gentleman this side. Any other people like to ask questions? Okay, fantastic. We'll take those 3 questions. Thank you.
Thank you. My name is Julius Mukunda from the Civil Society Budget Advocacy Group. One question, and it goes to the insurance part. You kept on saying it should be factored into the cost of credit. Everything should be factored into the cost of credit, and yet here we know that the interest rates are already so high. Are we really solving the problem, or we are actually making sure that the credit is going to be so costly to the farmers? I think, in my perspective, is we need to work to see how government can deal with those bottlenecks, like fake inputs. How can government ensure that only those who supply inputs are registered and are known, not the Chikubo business? Thank you.
Thank you. There's a gentleman behind you, and then there's somebody else on the table in the corner.
Thank you. My question goes to the same person. The level of insurance penetration in this economy, I don't have the statistics at hand, but I want to think they're somewhere below even 5%. So what strategies are in place to ensure greater uptake of insurance? Because it's possible to make it all lucrative and not have anyone take it up.
Okay, thank you. Last question.
Thank you. I'm Wilbur Chivekayunga. I'm the proprietor of Action Enterprise and the manager of La Fontaine Limited. I would like to raise a question. For Kenya has Kenya Commercial Bank, and Cairo, that is, has, Egypt has Cairo International Bank. What does Uganda have? We had the Uganda Commercial Bank. Okay. Where is it?
Okay, keep the question brief.
And
thank you.
DFCU, the Development Finance Company of Uganda. Look at its shareholding. Who owns it? Okay. I think those are needle-piercing questions. However, for a government to manage its people, to govern its people, it has to first set an example.
Wilbert, I want you to ask questions only, and I think you've asked 2 questions already.
Okay.
Shall we take it at that?
Okay.
Thank you very much. Appreciate that. All right, Miriam.
Okay.
It's all about you, and then maybe I'll ask Josephine to just provide some sort of perspective to Wilbert's questions.
Okay. Thankfully, there are only 2 questions. I'll start with the last one. The penetration is less than 1%. And there are a number of factors that affected the penetration. But we are doing better right now. And as the association, we have a 10-year market development plan. And it's also on the basis of that plan that we're looking at agriculture. And it also informed, together with other actors, the establishment of the National Agriculture Insurance Scheme. And that has lent confidence because right now, the number of insured farmers has actually grown from 5,000 to 23,000 farmers. That's in 6 months. And I think that deserves a round of applause. Thank you. So we do have a 10-year market development strategy in terms of growing the sector. In terms of cost efficiency, if I may address Julius's question, we are hampered by time. But what I'm basically looking at is insurance banks and insurance companies are strategic partners. Josephine mentioned collaboration. So one of the issues that the small-scale farmers actually have following the past year is actually cost. And the cost is not only the cost of credit, but it's also insurance premiums. Now, what we've done under the National Agriculture Insurance Scheme is that, one, we've negotiated tax exemptions, and I'd like to thank the Member of Parliament, Henry Musasizi, who actually helped with that, the exemption of VAT on agriculture insurance policies. But the second thing is that we also have to look at, we have to deliver cost-efficient services. Now, growth in agriculture can only be driven by volumes and economies of scale. So if the banks and the insurance companies come together and actually look at this cost and have it lowered, that will actually work. As the Insurers Association and the insurance companies, the insurance premium rates have actually reduced from 12% and currently stand at 5%. And of that 5%, the farmer only meets 2.5%. So we've done our part.
Thank you. Josephine, just give us some overall closing remarks really to wrap up this session.
Okay, thank you, Uthman. Maybe before we do that, we don't totally leave out the question about what does Uganda have. In this room, Uganda has 25 financial institutions. I don't really believe that the name should matter so much, whether it's Kenya or, after all, we are trying to become the East African community. Yes. But what we need to see more is that the ones we have, how much more can they do in agriculture financing? I actually noted the presentations in our books that they've handed over. There's a lot of CSR that the banks are doing. Maybe it's good language if we tell you, banks, to try and make part of your CSR budget. Find a bundle of farmers, find a group, sponsor it, and make it your CSR. You're preparing the future clients for tomorrow. Maybe that may be easier language for you. I know it's not just about the financial institutions, but it is all, it is all of us players out here. And I would like to really commend the spirit with which the Uganda Insurance Association has brought to this. Usually financial institutions entail insurance companies, but they've been missing in the picture. As we bring them more into the fold, we are de-risking further, and maybe we are giving ourselves a chance. We are cognizant of the fact that development is not a single-day event, so we need to be patient but making steps forward rather than backwards. Thank you.
Okay. Thank you very much. Please join me in thanking our panel and the lead presenter. Thank you very much indeed.
Yeah, I'd like to join Uthman in thanking the panel for the most difficult session after good matoke and groundnuts. It's so easy to find your eyelids taking control. Our next session is on responsible and sustainable banking, so this must really keep you awake. We've got my good friend Caleb Owino. Caleb is the Managing Director of Fireworks, an advertising and PR agency, and Caleb is going to moderate this afternoon session, and he has assured me he's going to keep you smiling and awake. Caleb.
Thank you very much, Henry. Thank you, Uganda Bank Association. Indeed, it's a tough one coming after guys have had lunch, but we'll give it our best. The session we are going to have in the next 45 minutes is about responsible and sustainable banking. And as I was discussing with the panelists, one of the major issues that came up was how do you even agree on what's responsible and sustainable banking? So it's a tall order, but I trust that our panelists will do justice to it with your cooperation and support as we go along. Ladies and gentlemen, without further ado, I want to introduce the panelists. Because of time, I won't go into details of where they went to school, their jobs, and that kind of stuff. I'll be very brief, so please forgive me on not being up to point on protocol. Our first panelist, our presenter, let me start with our presenter, who is going to present for roughly 10 minutes, is Mr. Emmanuel Keith Kisame. Emmanuel, could you please come forward? As he does, I'll very briefly introduce the fact that Emmanuel is a research fellow at Accord, and he's very well equipped, being a Master of Arts in Economics Policy and Planning. So Emmanuel is going to be making this presentation for us, starting us off for roughly 10 minutes. Thereafter, we'll have the panelists, chipping in, making comments on specific areas. And on that note, allow me to invite our first panelist, Mr. Rakesh Kumar Jha. Mr. Rakesh Kumar Jha, who is the Managing Director of Barclays Bank, Uganda. He comes, with a master's degree, an MBA from Pune University, India. He has a bachelor degree in economics as well, has had 22 years banking experience. And I personally witnessed how he turned Barclays around, so please hold on to your high expectations. Next we have Mr. Julius Mukunda, the Executive Director of the Civil Society Budget Advocacy Group. He particularly wanted me to pronounce the acronym right. It's called CSBAG in short. And Julius, I've attempted to do justice to that. Julius has 15 years experience in managing economic governance, and I particularly noted that he is an expert in something called GB, gender budget. So on budget, gender issues, and it touches on budgets, this is our man. We also have in the panel Professor Bulunya, who is the principal of what we call MOOBS, Makerere University Business School. Welcome, sir. And I just want you to know that Professor has had 30 years in the field of teaching, has served in several boards, including Bank of Uganda, started this university with 1 degree program. Now they have several, 200 students. Now they have 17,000 students. So that's the man we have in the panel today. I'm not sure if I'm missing one very important panelist. I have, finally, okay. Actually, I have 2 more panelists, and please forgive me for that. The first one I'd like to call forward is Mr. David Sebuya, sorry. Man, please forgive me. I'll buy you coffee. Yeah, thank you. David is one gentleman who most journalists, I've worked with journalists in Uganda, most journalists look up to him. Having been a journalist his life, formerly, executive editor at Monitor, and also chief editor at New Vision. So the one thing you can trust a journalist to know are the underlying issues in society. So please expect a lot from David. And finally, we have Professor Nwagaba. Is Professor here? Sorry? Sorry. I need to get counsel. I'm well advised that Professor is not here. He had to excuse himself, so we'll leave it at that. I think that also allows a bit more time for the panelists to cover this topic. Now, without further ado, ladies and gentlemen, allow me to welcome to the podium Mr. Emmanuel. And Mr. Emmanuel, please do justice to this topic as we look forward. Thank you.
Thank you, Caleb. Good afternoon, esteemed ladies and gentlemen. I need to also try this again. Good afternoon, esteemed ladies and gentlemen.
Good afternoon.
Thank you. I see Professor Nwagaba is in the house. So as he takes his seat, I'll tell you a little bit about myself. My name is Emmanuel Keith Chisame, and I must make a disclaimer that I am not in any way related to Juma, in case you are wondering anyway. I am here from Accord. Accord is Advocates Coalition for Development and Environment. We are a public policy research and advocacy think tank, and I am hoping that in the next 9 or so minutes I'll do justice to what responsible and sustainable banking is. Very quickly, that's going to be the layout of our discussion this afternoon. I'll try and take you through what responsible and sustainable banking is from my research, and propose to you a few considerations in this area. I was asked to also talk about the role of civil society, seeing that that's where Accord falls. I must say that is a very gray area. So I will take you wherever I wish, because there is hardly anything to reference on. And then I'll end by giving you a few suggestions that I hope can guide this discussion further. By way of introduction, I think we all know that economies on this continent, the growth has slowed down. We've had, for the last 3 years, we've had most economies in Africa missing their growth targets. A few challenges that are well elaborated in other fora that are not the topic of discussion today. And we also note from research that financial institutions have a very, very major role to play in boosting growth. Now, this role can take on different shapes. It can be in terms of financing. It can be in terms of being players in the economy themselves as part of the private sector. It can also be an enabling role, which is where I want most of this discussion to be directed. This role, however, has to be undertaken in a very inclusive and sustainable way, hence our discussion this afternoon. Research has placed much emphasis on social, inclusive, and sustainable financial markets being essential to building shared prosperity and ending poverty, especially in Africa. Those are very, very big words for some of us, what inclusiveness is, what sustainable financial markets are. Those are things I hope we will paint some picture on today. There are several definitions of sustainable and responsible banking throughout literature. But the one that I thought was well laid out and one that I thought we all could identify with was the one by the International Finance Corporation that defined sustainable and responsible banking being about balancing financial, social, and environmental issues to ensure success of the company as well as the sustainable livelihoods of the communities around them. And at this point, I just want to take you back to where we started by looking at the trend of growth in the economies across the continent. And growth often leads to development, and not necessarily so, but we assume in economics that when you grow, eventually you develop. And the pathway to development is growth. Now, growth is about you meeting the needs of today without compromising the livelihoods of those that will come after you. So banks or financial institutions have a duty or a responsibility towards sustainable development because as later on I will emphasize, the process of credit creation, which is the bread and butter for the banks, is mutually reinforcing with sustainable development. As the economies around you develop, your clientele grows, but at the same time, as the clientele grows, the assumption is that the business also grows. There are a few things to consider here that responsible and sustainable banking are about. Integrating social and environmental criteria into lending decisions, ensuring good governance, building more inclusive lending, protecting the environment, being transparent, and acting with integrity. And we'll just go on to delve a little bit more into some of these. And I just want to say that sustainable and responsible and sustainable banking, much as the concept might be relatively new, is not an entirely new concept. Many of you are already doing this. The corporate and social responsibility activities that you have are a very big part of sustainable and responsible banking. However, these are usually ad hoc in nature. They are one-offs. The bank will have maybe a clinic, an eye clinic sponsored in a given community, maybe once a year or twice a year, and that's it, and a few other initiatives that you have. So the call for responsible and sustainable banking is to transcend this, is for it to put at the center of your transactions things like adhering to the financial inclusion ideas that the Bank of Uganda has put across. One of those, the key ones being financial consumer protection. And I'm very glad that the Deputy Governor, Bank of Uganda, is here. So maybe in the discussion there will be some more emphasis placed on the role that financial consumer protection can play in not only deepening financial inclusion in a country that is largely underbanked, but also in ensuring that we grow in a sustainable and in a responsible way. The concept of responsible and sustainable banking raises a few questions and that I hope the panel can eventually delve into. And the first one is one I have already touched on, which is asking whether the banks have a responsibility or a duty towards that exceeds credit creation. Because for you as a business, your goal is to create credit and profit from it. Is there something beyond that? And I want to say yes, there is. And the second one, which is also related to that, is whether responsible and sustainable banking and credit creation are mutually reinforcing, or are they mutually exclusive, if you put it the other way around. And very quickly, I want to put forward a few considerations. I think that in addition to some of the things that you've already done in your corporate social responsibility strategies, there are a few things that are very important for banks to be able to conduct their business in a responsible and sustainable way. And the first these are both internal and external. And the first one we'll look at is the external one, which is the state of the financial markets. You, as players in the financial markets, you have a big duty to ensure the sustainable existence of the financial markets in this country. The capitalization of these markets is very, very essential. And so some of the initiatives that you have in place, the transactions that you've conducted, have been crucial to the expansion of the financial markets in this country. But however, we must also acknowledge that despite being big players in the financial markets in the country and on the continent at large, the role that banks have played in development is really, really limited. And I must place an emphasis on that. So there's got to be a deliberate strategy on how, as a bank, you evolve to make sure that your contribution to this economy is beyond your credit creation roles. This has got to be, like I said earlier, it is very, very essential that the capital markets, which are a good sign of the well-being of social markets, of financial markets, have an input from the banks. Now, I took a quick look at the listing on our securities exchange. And that table there shows you the companies that are listed on the securities exchange. I won't delve into the reasons why many of you are not there, but I think it is very important that as the biggest players in the financial markets, you demonstrate this step of transparency and accountability by listing on the Securities Exchange. As our capital markets grow and as they become more developed, the sustainability options for us as an economy also increase. The second consideration is an inward-looking one, which is on reporting and transparency. And when I was preparing for this presentation, I was asked by the organizers to also give some reflections on the experiences elsewhere. Reporting and transparency is a concept that I don't have to overindulge because it's one that is common to us. But there are aspects that I identified in some of the countries which were very interesting. The Johannesburg Stock Exchange, for instance, has been praised for incorporating mandatory reporting requirements on environment, social and governance issues for all its listed companies. And I think Nigeria is also going down the same road. And there's a lot of literature which, and in the interest of time I won't go into, that shows how beneficial this has been. But I picked up a quote from the IFC which I felt was very important for us today, and that is that for banks, having more disclosure on potential social and environmental issues of the companies they lend to and do business with helps them to better manage risk. Now, in an economy like Uganda, where the risk portfolios of most of the people you're lending to are a big problem, I think this is a point to take home. I'll move very quickly in the interest of time to the access to credit, especially for the small and medium-sized enterprises. Now, it's staggering to consider that about 90% of the business transactions on this continent are done by SMEs. When I first saw the statistic, I found it hard to believe, but it is true. Unfortunately, for many of these, they are underbanked. So reaching out to some of these players in the markets that we are in is going to take a lot of innovativeness. Some of these do not have the collateral, they do not meet the criteria for people that can easily access credit from the banks. So there's a big, this is a big area of potential for banks to expand into. And I think if you can find a way of making these SMEs that are underbanked to increase their uptake of credit from the banks, there's a big step towards sustainable banking. Why is this? Because this is a huge volume of trade and transactions to tap into. There are some things that are additional in considerations which I've highlighted in red, and those are climate change and poverty. But we don't have the time to delve into this, and I think those are discussions that have been, that have had a good deal of attention on how banks can finance climate change mitigation and adaptation in Africa, but also in how banks can contribute in their products, can contribute towards poverty reduction. I think one of the key areas that I want to emphasize here is financing for development. And this has been the preserve of international financing corporations, not the IFC, but corporations that are dealing in finance, the investment banks. These are huge players on the global market. There is opportunity for even banks within these economies, especially like Uganda, to venture into strategies like blended financing. And blended financing is one that I looked at to place emphasis on, because not only is it a way for you to contribute to sustainable development, but it also comes with guarantees that ensure your profitability is not compromised. I wish I had time to delve more into what blended financing is, but in a very small example is how you can finance, say, infrastructure development. Take Entebbe Express Highway, for example. You come, put in money, and government or in its role gives you guarantees in case to cover or to manage for the risk that is associated. And you make back your money through the road tolls that are collected. That's a clear illustration of blended financing. Such projects I've seen, I think the European Investment Bank is one of the funders of the Bujagali hydropower dam project. Those are areas that banks in Uganda, given the amount of capitalization that you have, can consider to venture into. The role of the CSOs, as I draw towards my conclusion, as I started, I told you, is close to non-existent, because when I looked at what the interactions between us and the banks, it's purely limited to us banking with you or getting loans from you, of which even the loans are hard to get. They're on individual basis. People who are employed in the civil society world accessing funds from the banks. But and I also noticed on our part, there's a limited amount of research being done on the financial sector in this country. And I thought that is a critical area for us as civil society and research organizations at large to think about. Policy advocacy is another area. For this to happen, all these things we are talking about, there's got to be enabling policy frameworks and legal frameworks. And these are things that are worth advocating for. But one particular area of interest that I thought would be of interest to you, the banks as well, is impact evaluation, that we do a lot for social projects. While you're launching agency banking in its nascent stage as it is now, why not partner with the civil society organizations right from the onset, so that we have baseline conditions to benchmark on, to be able to assess this at some point and tell you how much it's beneficial to you. So there are areas of possible collaboration there. And as I end, there are a few suggestions here that will lead into our discussion this afternoon. And the first one is that credit creation and responsible and sustainable banking are mutually reinforcing concepts. And for this to happen, it's essential that we have good governance and regulation in place. I've already touched on the potential for more bank CSO collaborations beyond us banking with you. And if you're interested, there's some reading material there as well. That I've provided the IFC's guide to responsible and sustainable banking, a step-by-step guide. If you're interested, I know this presentation will be shared. Thank you very much.
Another round of applause, ladies and gentlemen. Mr. Emmanuel Kisame, thank you so much for that presentation. At some point, I saw a few people walk out, and I counted them. Then I realized they came back because I counted them again. So we are good. We are sustaining. I want to start by just clarifying a few things. I will give the panelists an opportunity to delve into these topics. Then I'll give the audience a chance to ask questions towards the end. So please be patient with me. The first panelist I'd like to comment on this, and specifically I noted, Mr. Rakesh Kumar, that last year the banking sector really invested on CSR to the tune of over 5 billion Uganda shillings. And so it could tell you that the banks in Uganda are, are thinking about not just today, but also tomorrow. They think about sustainability. The question I want to ask, though, what, in your assessment, has been the impact of the banking sector in Uganda in terms of engagement on CSR, on the issues of sustainability, given that investment?
Yeah, good afternoon.
Yeah.
No, I'm glad that we are discussing about CSR and we are discussing about things beyond credit creation, because often the discussion with banks get limited to credit creation only. And in my mind, the role of a bank and the sustainable banking is a very wide subject and covers several points. The question you raised is about the CSR, the bank's roles in CSR and the impact it has on the society and the country as such.
Indeed.
So if you look at the different areas that banks have been working with, the sole aim of all these exercises is to ensure that we strengthen every segment of the country. There are several segments in the country which are in different categories, and then we could maybe classify them as people who are not financially included, or people who are vulnerable, or people who are preparing themselves, or the youth who will become part of the productive workforce in the future. So most of the exercises you see is in terms of developing certain kinds of skills with these people, so that then they are more productively employed within the economy. So there would be certain banks who are working with the people who are in the HIV segment, and they are vulnerable. They can be exploited. And therefore, how do we create the skills in them so that they become more and more self-employed, and in the process then no longer remain vulnerable? There is investment in the people who are studying, who are students, who are now graduating, and they require to be equipped with skills which make them employable in the future. They need to understand what will make them successfully employed in the future, whether they want to work with a corporation or they would like to be self-employed. And both skills are very, very important. We all know that Uganda has been declared as the world's most entrepreneurial country. And therefore, it becomes very important that we create skills within the people who are self-employed, so that they create sustainable enterprises. And these enterprises do not die an untimely death, because there are skills missing for people to run these enterprises very, very successfully. And then the question of people who are financially excluded or who need financial inclusion. Again, that's a very, very big subject, and our keynote speaker spoke at length about that, and it's the right way of developing a country in terms of how do you ensure that in every successive period of time, more and more people are getting included in the entire productive workforce and within the mainstream banking also.
Yes. Now, what's your final take on this? Is the impact significant enough, or is this investment probably not getting a return? What's your view?
Yeah. So now the question really you have to ask is that banks have a certain role to play.
Yes.
But again, we cannot play this role in isolation. And that is where the partnership that we need has to come from various other stakeholders.
Like?
I mean, there are various stakeholders. For example, there are global developmental organizations that work within the country who are responsible in different sectors. For poverty alleviation, or for diseases prevention, or for skill creation. So those global development organizations become very, very important.
So in other words, you agree with what Mr. Kisame mentioned, the need to collaborate with the CSOs to be able to work together towards sustainability?
Of course, I don't think any one particular group of maybe sector or maybe banking group alone can do it all alone.
Yes.
There are ideas which will be emerging, but it requires the support of different stakeholders who have different skills to come together and create programs which are more sustainable.
Thank you so much, sir. I want to come back to, forgive me again, I didn't get your name right, but I've been practicing. David Sepuya, right? You've written a book on African industrialization and prosperity, which is very, very interesting. Could you please touch a bit about, your views on sustainability, responsible and sustainable banking in the context of Uganda. Just press it. Yeah. Press the button, the red button.
Okay. Thank you very much, Caleb. Yes, I've been looking at the need for Africa to industrialize. Now, I believe in reflecting on our subject this afternoon of sustainable banking. I believe it's in the interest of every one of us in this room for the economy to grow, both in size and sophistication. Now, how do you grow in both size and sophistication? Currently, our economy is a primary economy. Uganda's economy is a primary economy, and therefore, financial services like banking are operating in a fairly limited environment. We can grow that by industrializing. That's how economies grow in sophistication. And I believe banking has quite a lot to offer. Right now, we do not have a well spelled out industrialization strategy, and at the moment we look mainly at FDI, foreign direct investment, to spur our economy. I think FDI is quite limited. Not only in the amount of money, I think we get about 4.2 trillion per year in FDI. That is very little money. We have a lot in domestic savings. Mr. Byarugaba, NSSF, mentioned to us this morning that the portfolio of NSSF is 8 trillion. Now, there are other funds under management. They come up to about 2 trillion shillings. Then there are common, is it called common investment schemes? Also quite a lot of money. Now that money can be channeled into industrialization and then the economy grows. But for me, much more importantly for bankers, here is something I believe we can do as bankers. Well, I'm not a banker. What you guys, bankers, can do is to mobilize savings and channel those savings into finance industry.
David, I want to ask you how.
How? By giving better interest rates to savings. Yeah. Many countries have done it. I think that's how South Korea did it. That's how Singapore did it. They financed their industrialization from domestic savings. And I think our banks can do the same thing.
Rakesh, now that he's talked about interest rates and giving better interest rates, is this something you're thinking about as bankers?
We have to understand, again, the interest rate, how the mechanics work and how banks price their loans. And I think the governor in his address today spelled out many things that are in the direction where the interest rates that we're talking about will be reduced in a sustainable manner. And the direction that we have to talk about is how are we looking at our operating cost for the banks today? Because that constitutes a big cost and that contributes to the interest rate that we charge to the clients. So the way I see it is that we have to be looking at a very sustainable investment into technology, into digital capabilities, which will ultimately go a long way in reducing the operating cost of banks, creating financial inclusion, and thereby contributing to a very sustained reduction in the interest rates.
Thank you very much. So focusing on the cost structures first before you go into the pricing. Okay. In the topic of sustainability, one group of people that, according to some statistics I've seen, are often left behind are women, our sisters, our mothers. It's said that they participate significantly in the SME sector. But if you look at the proportion of them that access banking services, is still very low. I thought, Julius, Mr. Mukunda, maybe you could shed a little bit of light here in terms of the situation in the market today or in the region today vis-a-vis responsible, sustainable banking where women are concerned.
Thank you. I think I'm glad that you brought that one up, that women and majority of other vulnerable groups in our country definitely most of them are left behind when it comes to inclusive banking or when it comes to accessing these banking services. 2 points. I think we need to understand when we say pro-poor banking or sustainable banking, we don't mean that we should conduct poor banking business models. It is not right to tell my colleague from banking, say, please open a branch everywhere so that you can access the poor women and men in this country. Definitely, they're going to fail because businesses are likely not to be there. But also to come and say, please provide cheap credits. We want loans of 1%, 2%. I mean, he's telling us the operating costs are so high, and as such, it's going to close. And therefore, when you see a bank closing, definitely the small, medium enterprises actually get affected because their small money they survive on a daily basis. They are not likely going to get it. And this way, when we see Bank of Uganda trying so hard to look for the next buyer, not to close the bank, we applaud that because we know if you close the bank, definitely, okay, the billionaires are likely to have problems, but billionaires can even be having insurances. You never know. It is this small, medium enterprise, small, medium enterprise, small, medium enterprise that is likely to suffer most. And as such, what do we need in this area? One is, for example, that I think one of the things that has happened in this country is agency banking. I can tell you, we look forward for the governor to ensure that these regulations are out very quickly and agency banking starts. But also Parliament for passing agency banking because this thing is going to bring banking services to an ordinary person who has been fearing to enter any branch you will open in a remote area simply because it is very clean with glasses and a common person will still look at it and say, I'm not entering that place. But they are likely to trust an MTN or any other agent at the grassroots level to do that. Secondly, I think for me is the SCR. I think SCR should go beyond, or we've come and cleaned this hospital. The next month, the hospital is dirty again. How do we ensure that the SCR we are using is to mobilize, organize communities around this clinic, to show them the importance of having this clinic cleaned on a daily basis? I think for me that works. The second point.
That's the third one.
The second point is, I think when we say being rich, I think everyone wants to be rich, including the poor woman and man in this country. But I think we question our journey to getting this wealth. And Dr. Noga will tell you about the inequality in this country. What we usually question most is, when you give out this money, you are giving it to who? Remember, among the people, they are land grabbers. Among the people, they are con men and women. Among the people, they are fake input dealers. And you find you have no control about these particular areas. We therefore would wish our bankers to do more on KYC, know your customer. If somebody has come to supply input, do they have registered business? Are they certified by a competent government regulatory authority? These are some of the things that we want to see. And lastly for me is, if we want women, the poor men also, to be able to access these financial services and not to be affected by the way our private sector is conducting business, especially banks, is to learn from what the World Bank is doing. World Bank, what it does, if they give you the money and you are implementing a project in a particular country, there is a mechanism. If the communities are being affected by the project you are implementing, there is a mechanism for them to have to resolve that with the World Bank. And I think that can work for us very well.
Thank you so much, sir. Thank you. Because of time, I want to move on fairly quickly. And I want to revisit some quotes that I came across recently. They say the education beats at the heart of sustainability. Meaning, if you're going to achieve sustainability, it's not a matter of us just giving to the market, but also making sure that the market is full of educated consumers of banking services. Professor Mulunyo, I'd like you to, share perspective. What's the overlap between the education system, all right, and sustainable banking, if you see any?
Thank you. Thank you, Caleb. Good afternoon, ladies and gentlemen. Well, first of all, just look at the concept of responsible banking, that it carries two major aspects. One is sustainability, sustainable development, and the other is the CSR. These two are not necessarily the same, though they tend to be seen. I hope Mr. Kisame is able to look at this much further. CSR is the extension of what we used to call big people with the money dishing it out to the poor people. And of course, it's got a very nice name, CSR. We expect, banking institutions to be able to respond to the challenges society has. Sustainability, I think if you take the case of Norway, Norway is mining oil, and it has enough oil revenues to cater for its citizens 50 years ahead. Trump doesn't like climate change because he believes America should produce more at the cost of spoiling the environment. Now, when you bring this to education, take it to the Lake Victoria, for instance. People out there are going to fish with the small nets. They are pouring poison in the lakes to fish, and they are killing the future, their own future. And I don't know whether the banks are actually banking fisher people, there's another issue. So if people are not educated about their future, what lies out there for them in the future, they are likely to go into things like using small nets to fish. And after a few years, there will be no fish. So I think definitely there's a linkage between education, possibly the amount of education, the level of education that people get, and sustainable development.
Thank you very much. And finally, Professor, we didn't get an opportunity to introduce you at the beginning. Ladies and gentlemen, Professor Augustus Nwagaba. And I want you to tackle for me a very particular, issue that keeps coming up. We know mobile penetration in Uganda is upwards of 20-something million. The number of bank accounts in the country, around 5 million. We also know that the period of time the banking sector has been around is way longer than the period of time the telecom sector has been around. And next to that, one man, Bill Gates, once said that the world actually needs banking, but the world does not necessarily need banks. I want you to sort of give us context around that thinking. If we as banks are not able to pursue this sustainable banking concept, remember the world needs banking, not necessarily banks, how are other aspects or other institutions, other sectors, making contribution towards the sustainable banking concept, and what does this mean for the banks?
Hello, yeah, thank you very much, Caleb, and good afternoon. Ladies and gentlemen, my name is Nwagaba Augustus again. I told you I'm a teacher. I'm a businessman by accident. And I'm a farmer naturally as a Ugandan. Now, let me make some contextual statements so that you understand the discussion in which we are engaged in since morning. I have been doing research for financial sector deepening project. I'm the one who was a consultant for 213. I'm currently a consultant for East African community. I'm doing for all you guys, the 6 countries. I'm supposed to make sure that you are moving well in the next 5 years. Now, I have looked at 600 years ago. For the last, just listen to this. For the last 600 years, there is no country on earth which has ever taken a step called development without having a bank, without having a form of raising money, without having a form of raising seed capital for people who want to do business, so you call out economic activity. So the financial sector is the bulwark, it is the linchpin, it is the epicenter for not only economic activity, but for driving an economy. Ugandan economy, so let me put it in context, those who may not be knowing, is only 25 billion US dollars. You'll understand it better by knowing American economy GDP is 17.7 trillion US dollars. This is where you are operating. You are 25 of you, one person has already been off, and you are remaining now 24. But if you look at your market share, I also arranged all of you in that order, up to the last person, is that if you look at the first three, which I don't want to mention, is that, let me tell the Ugandans, is that you also lack something there. And what you are lacking is in economic theory, classical economic theory. It's a very, very old theory. Is what you are lacking is called development being initiated from within. It is a very, very old economic theory. There is no way, especially if you are a Ugandan and you are here and you are talking about transformation, that you are going to achieve it through that market share structure of commercial banking in Uganda. There are 24 commercial banks. It is not possible to have it. You must have strong indigenous bank, and then we compete with these guys.
Thank you, Professor.
So that's number two.
I need you to keep it brief because of time.
Yes, number two.
And if possible.
Yeah, let me come to
your.
I just wanted to create a context. We have been lacking a context since morning. Now, to be very specific on your point is that for us as teachers, Professor Ndug is here, we don't talk just like talking. We talk with the data. And I just want to borrow 2 minutes from you. I'll just give you simple data. 8.3% of the Ugandans are banked. They have accounts in a commercial bank. But 50.1% save money at home. They don't come to banks to save. What reason do they give for not coming to your bank? Is that 47% are saying they don't know the procedures and they are fearful of coming to these banks. Now, I want to congratulate commercial banks as I end. I want to congratulate you for one major point. You have been trying to do what we call financial deepening and penetration through, but now, unfortunately, through the supply side. You have been thinking, we used to have Barclays, we used to have Glinda's Bank. When I was in Kabale, I would see Glinda's Bank, and you have to put on a suit, and our clothes which we put on Sunday if you want to go to a bank. It was very, very unfriendly to go to a bank. You have to be very, very, as if somebody is really going to see how many people are putting on very well, how many people. So now I want to congratulate you because of lack of time. You have tried to come to us. For me, I represent a constituency which the Ugandans know. The foreigners you may not know. Me, I represent a constituency of the poor. 68% of the Ugandans do not bank with you. They are non-monetized, subsistence. 70% do not bank with you. 19.7% do not see anything called money, and they don't hope to do so. So these are poor people. But you guys, these people have money. They are willing to bank, but you are not going to them. And you continue crying that you don't have money. The financial debt, to be very technical, the financial debt in Uganda is very, very small. The professor, it's ours 0.23, Kenya is 0.61. We don't want to be very technical. But that means in the English language, you guys in the banks who don't have where to get money, you don't have where to get money. But you could have got that money even cheaply by as I was thinking in the morning, use the pecking order, list the bank on stock exchange, grant on these equities, and be able to get that money cheaply by telling my mother, myself, China, let me end with China. The Agricultural Bank of China is the fourth largest bank in the world. JP Morgan, HSBC third, the fourth bank in terms of financial assets is the Agricultural Bank of China. How did it raise this money? 27 billion now is by making sure that my grandmother bought a share there. So the financial deepening in China is not that you have brought Barclays Bank. I want to congratulate Barclays Bank, particularly you even find them in Chengela now in a certain garage somewhere the bank is there. But that doesn't mean that you have financially created financial depth. Financial depth is from the demand side. Where if I come in that Barclays Bank, thank God you have now come from heaven, you are now on earth with us, the poor in Chengela, and so on and so on, but they want to get interest rate and be able to use your products.
Thank you very much, Professor. Thank you, thank you, thank you. Ladies and gentlemen, we now open up the floor for questions. Because of time, I'll allow only 3 questions. Then we'll get responses from the panelists. I see 2 hands, 3 hands up. So just introduce yourself, then tell us, ask the question and make it brief. Let's start with the gentleman right in front of me. If you could pass the microphone, please. Your name, maybe the institution you represent, and then who you are directing the question to. Then the question.
My name is Philip Maikatamba. My question or my suggestion is that we've been lamenting too much since morning. As Uganda Bankers Association, we have heard that in the last year we had about 5 billion under corporate social responsibility. I was thinking aloud that we're talking about sustainability, agriculture sustainability, models. We don't have the sustainable quantities and quality of agriculture. What about thinking to put up a model project which will also cater for things like financial inclusion, safety nets about the environment, corporate governance? If the banks, the 5 billion shillings, they get 10% for each of them for several consecutive years, don't you think we can put up a project as Uganda Bankers Association and be a model which can be maybe later made a public company and people subscribe and mobilize resources so that you show what you expect the private sector or the nationals to see?
Thank you very much. Next, I saw a hand over there at the back. The lady in red. Quick introduction, then the question.
Okay, thank you very much, Mr. Presenter. I really appreciated Professor's contribution.
Your
was
name,
really
madam?
concerned about the common person.
Sorry, excuse me. Just introduce yourself.
Okay, I'm Fatuma Abbas, a national card and in the media fraternity.
Okay.
I was so impressed with the professor's concern about the common one who carries the biggest percentage in all the African nations, especially the East African community. Whereby I really ask of with what significance are the banks to the common one who weighs the biggest percentage in our nations?
Who would you like to answer this question?
I would like
Open
it
to all.
to all the whatever
Thank you.
officials.
And then I saw a hand over there.
Thank you so much. My name is Godfrey again, Joga Sevukulu from Craft Silicon Limited. It would be futile if we sat here for a day and then we don't come up with these key areas of action. And I just wanted to kind of make some statements that maybe will trigger discussion, fruitful discussion, especially in the digital age. Our main constraint as digital vendors, in as far as sustainable finance is concerned, are the bankers, the people themselves, in taking on new strategies. We think innovation is going to come more from third parties, but you need very versatile and accommodative business models, which are not existent at the moment. I want us to also advise the bankers that in the area of micro and nano finance, we look at loans as portfolio, take a portfolio point of view, as if you're an insurance company. We don't manage risk as if we're managing these big corporate loans. So make 100 loans, lose 10, move on. Tell government that it's not the duty of banks to account for its citizens, okay? It's the duty of a government to account for its people. So why these rigid KYC rules, okay? And then for small transactions, really, we must be given liberty to actually transact freely. Who supervises the exchange when people are spending small money on the streets?
Godfrey, forgive me, but I need you to cut it.
I was just closing.
Please close.
And for the industry, each bank is an individual bank. And when you come up with gang strategies, okay, like mob strategies, which I look at agent banking, shared platforms as ganging up everybody into. And I'm disappointed that we are sitting here discussing agent banking when we have gadgets in our hands. We should be discussing street banking. I thank you.
Thank you, Godfrey. Thank you very much for your comments. Ladies and gentlemen, we have, I think, Geoffrey, yours was a comment, more of a comment than a question. Because of time, again, I cannot go beyond 3. Please forgive me. I want to start by visiting the issue raised by Ms. Aktamba. And obviously, it goes to the banking sector. You know, if you could just shed light a little bit. He says that, look, we've spent $5 billion in CSR. How about we think of collecting all this money and setting up an institution that will address issues of sustainability for the long term, to a point where he even talked about maybe convert it at some point to a public company.
Yeah, and I think it's a very good suggestion, and we'll have to look at it in terms of how banks can come together and collaborate for such ideas, because again, there has to be a minimum convergence from institutions to then start such programs, and without the convergence, it's very difficult to sustain those kind of programs. But I also heard about a few other comments which spoke about, we have to look at it that sustainable banking it also includes, as I said, it's not about just credit creation, but how do you include things like very robust corporate governance in the banking? Because we have not spoken about that in a very big manner, because corporate governance leads to very, very efficient banks in the future.
Yeah.
Banks with weak corporate governance can lead to a very destabilized banking environment, and where trust can very easily be destroyed.
Yeah.
Risk management is again a very big area for sustainable banking in the future. And by risk management, I'm not talking about only credit risk. We often talk about what we should be, but we do not talk about what we could be, which is where the future is heading towards. And I heard about street banking. My thoughts are that, it could be banking anywhere. And that's where the banking is heading towards. And we have to embrace that, which will only help the country in terms of then proliferating the banking across the entire country and reaching every individual in the country.
All right.
Which is where we should be looking at.
All right. Thank you so much. I want to give this to Professor, Waiso Balunya. The question from Madame Abache, I don't know if I got the name right. She's concerned. I mean, we are talking about banking, and the common man is left out. The banking sector is not reaching out to the common man. Could you shed light on this in terms of opportunities, challenges, or if at all you agree with that notion?
Banks perform the role of financial intermediation. They enable those who have money to find those who want it. The common people today, of course, in this country, are performing certain financial transactions through mobile money. Very expensive for those very poor people. I think, to me, the first thing should, how do the banks get into that, that space to provide more cheaper, because it's an issue of technology, really. I believe that when I see money on my phone, when the bank creates my account, it should enable me also to pay somebody else on the same platform. And this is the innovation that somebody is talking about. Maybe we're not doing it.
Street banking as opposed to agency banking.
Yeah. So I think for the ordinary person, that is part of financial inclusion.
Yeah.
But again, the questions are not for the bankers, which are the issue of getting these people out of poverty. Not primarily for the bankers. Is somebody else, maybe Flinoga would have dealt with this. How do we increase production with the poor people? How do you, get them to produce more to be able to have money to bank? I think these are the issues. But again, also related to the issues of the level of education, the economy. But to me, the minimum thing that the banks could do is reduce the cost of mobile money. The banks have got this technology.
Thank you so much. As we close, ladies and gentlemen, I have one opportunity for a comment to Dr. Kasekende, just to shed light from the regulator's perspective.
Thank you. I thought I should make two clarifications. One relates to this panel and the other relates to the previous panel. One of the questions in the previous panel related to what does Uganda have? Yeah. And I thought it was a loaded one because I think he was looking for a government bank. We used to have UCB. Kenya has KCB. I just wanted to provide you with information that housing finance is actually government owned. And the MD is here. You can wave to the public. Housing finance is government owned. And in addition to housing finance, we have Post Bank, and we also have Pride Microfinance, 100% government owned. The second issue from this panel is someone was calling for the regulations to accelerate completion of the regulations. I would wish to inform you that the regulations were gazetted. Wow. We are ready to go. The central bank is ready to start licensing agents. So we are ready to go. Good. My third issue is, I have two other quick comments and following up on the presentation by Kisami on responsible and sustainable banking. For information, we have set up a complaints desk in the Bank of Uganda to receive complaints from the users of the financial, not the whole financial system, this component which is supervised by the central bank. We will receive these complaints, and we are setting up a system within the central bank to deal with those complaints. So consumer protection is something that is at our heart. Okay? Lastly is sustainable banking. I have to congratulate you, not even thank you, but congratulate you for introducing the subject. Development banks have made a lot of progress in sustainable banking. But just to warn, this has not been an easy walk in the forest for development banks. We have several examples of projects that have been delayed, constrained because of sustainable banking. You remember one time we had a project in Bujagali, the Bujagali power project. It was delayed because we had to shift the Budagali from one place. Okay? We have other road projects that have been delayed. In the US, the whole debate about cracking as a technology. Okay? And up to now, that debate is not resolved. So as we introduce sustainable development banking within the commercial banking segment, we should be ready for the tensions and the costs that will be associated with with mainstreaming safeguard standards in the credit decisions. Thank you.
Thank you so much. Thank you so much. Finally, we started with you, Mr. Kisame. Could you close this for us?
Thank you, Caleb. And I think I want to end it with where Dr. Kasekende ended. The concept of commercial banks delving into sustainable development. He has elaborated the risks. I think what I want to complement what he has said and add that there is a role for government to mitigate these risks by providing guarantees, by providing other forms of financing, co-financing arrangements that help mitigate some of the risk involved in dealing with things like this. For instance, when you have to move Budagali from a place he has been conducting business, then it involves government providing guarantees to the bank that regardless of what happens, the bank can make its money. So I think there is a very huge untapped potential for banks to go beyond credit creation and make money while developing this economy. Thank you.
Thank you. So that brings us to the end of the session. Our dear speaker, panelists, once again, I want to apologize. The time was not enough. I knew you had a lot to tell us, but there'll be another day. To our audience, you've been great. Thank you so much. Round of applause. Over to you, Henry.
We have come to the last panel, and once again I'd like to thank you very much. You have remained an awake and engaged audience. Our facilitator, moderator for this session is the head of news at NTV, Maurice Mugisha, and he's picking up on regulation and oversight and how the banks are coping with the pace. Thank you, and over to Maurice.
Thank you, sir. You took 2 of my minutes. I'll try and catch those much later. I really want to apologize, and I'm hoping you're all here because of the last session. I'm trying to be very careful. I'm excited, as I'm sure you can see on my face, to be the last panelist. But we are also pitching now to Wilbrod and requesting that we should be the first next year. So this really is the balance. Next year, make us first so we can enjoy the wider audience in the morning. Ladies and gentlemen, I don't want to waste a lot of your time. We have only 45 minutes, I have been told. And so I want to quickly invite our panelists. We are again, of course, very gender sensitive. So I'll begin with the lady on the panel. Ms. Jacqueline Musitwa, she's the Executive Director, Financial Sector Deepening Uganda. She's brand new in the job, a couple of weeks in the job. But she was on TV a couple of weeks ago and sounds like she knows Uganda, like she's been here for a couple of years. May I also invite the Chair of the Finance Committee in Parliament, the Honorable Henry Musasizi, who's also the Rwanda East Member of Parliament. Also allow me to invite from the Bank of Uganda, Sophie Chironde. She's from the Commercial Banking Department of the Bank of Uganda. Sophie will have a very short presentation, and Sophie, we agreed with Sophie that she'll keep it under 5 minutes. I'm hoping she'll do some mathematics in there. And then finally, David Mpanga, partner AF Mpanga Advocates. All right, so there is my panel. It's very unfortunate Professor Ezra Suruma couldn't be with us. He was summoned to travel to the US on short notice by his bosses, and he sends his apologies. So, ladies and gentlemen, we are looking at the regulatory oversight and reforms, how regulation and oversight supervision is coping with the fast-paced changes happening in the banking and financial sector. We've had from this morning a lot of conversation around digitization and how that can fast-track financial inclusion in this country and, of course, in the region. So before we delve into our discussion, allow me ask Sophie to come and make her presentation, and then we'll quickly move in. I also know that the Honorable Musasi has a bit of a 2-minute short presentation. I'm happy for you to do it where you will be seated immediately after Sophie. Yes, Sophie, please come.
Thank you, Maurice, and good evening, ladies and gentlemen. I must say this is not a very good time to be standing here to make a presentation, but I hope I'll be in a position to keep it in the way that you want it to be. I need some guidance here because the slides are not, yeah. Okay, this is what technology does, you know. Okay, our topic this evening is on regulatory oversight and reforms, specifically looking at how regulation and supervision is coping with fast-paced changes in the banking sector. By way of outline, I'll touch on some introduction. I'll then take you through very quickly the regulatory framework that we use to regulate the financial banking sector. And then I'll go very, very briefly through the supervisory framework, and then I'll touch on what we think are the changes that are happening in the banking sector from the Bank of Uganda perspective. The challenges those present. Okay, thank you. And what reforms the Bank of Uganda has undertaken. And I shall conclude. Of course, this banking sector is dynamic, as we have been hearing since morning, with complex transactions, increased reliance on technology. So what does that mean for the players? First, the banks, the financial institutions. It means you have to keep in pace, you have to keep dynamic, you have to innovate all the time. But that does not mean that as the regulators, we will just keep aside of the changes. No. What that means is that as the regulators, we need to retool our approaches in order to remain relevant and to ensure that we have an enabling legal framework. So, what governs? I think I touched the wrong button. I moved faster. But in terms of the regulatory framework, of course, we have the Financial Institutions Act 2004, as amended by the Financial Institutions Amendment Act 2016. But before that, I should say that the mandate to regulate the banking sector is enshrined in the Bank of Uganda Act 2000. Of course, in addition to the banks, Bank of Uganda also oversees microfinance deposit institutions. And we have a separate act, which is the Micro Deposit Taking Institutions Act 2003. Of course, the next act, which is very key today, is the Anti-Money Laundering Act. Yeah? As we will see and in the next few slides, AML, money laundering risk, is a key issue today. And I'm happy to note that as Uganda, we have an enabling legal framework to fight the vice. In addition to that, we have the Foreign Exchange Act 2004, and I must say that all those acts have implementing regulations. But one thing that is not on your slide, on the slide up there, which I want to state, is that in addition to the acts and the regulations, we also use guidelines. For example, we use the risk management guidelines, the consumer protection guidelines, and others. And over time, every time and again, whenever Bank of Uganda deems it fit, we issue directives and circulars. All that is what Bank of Uganda uses to ensure that we have an enabling legal, regulatory, and supervisory framework. Turning to supervision now, yes, we have the acts, but what about now enforcing the acts? How do we do it? Bank of Uganda follows a risk-based supervision approach, which is a proactive methodology. It enables us to focus only where we think the great risks to the institutions are. And to do that, we use both on-site and off-site methodology, where we receive reports, we analyze these reports, and we do engage with the institutions and issue corrective actions where deemed fit. So today, since morning, we are talking about the future of banking. What that means is that there's a lot of changes in the banking sector. And these changes are not only happening today, but what makes it more critical, more pertinent, is that these changes are taking place at a time when there is a lot of advancement in technology. Yeah? We had a session, our first session was on digital financial services. And you will believe me that digitalization in the financial services industry is real. It is here to stay. And sometimes you read about articles which refer to this digitalization as disruptors. But they are no longer simply disruptors, but they are part of the entire system. Yeah? So that it will inevitably pose some challenges and risks. So it's a change, it's a real change that you, the financial services providers, and us, the regulators, have to prepare for, to be ready such that these services are delivered in a responsible manner, in a sustainable manner, and at a cost that is affordable, yeah, for the consumers. Another change that we think is very pertinent today in the financial services industry is social and behavior change. Consumers demand for more every day. It is no longer a privilege for you, the bankers, to sit behind your big, in your big chairs and offices and think that customers will look for you. No, you have to do a lot more. They demand for more value and more service, more quality service. How easy is it for a customer to access a financial service, and at what price? I think that is very important. This morning, we talked about interest rate regimes. I think that's a critical issue that you, the financial services providers, must address if indeed we are to achieve an inclusive and all-inclusive financial system. So it's a real change that directly touches on your bottom lines, yeah? Because you have to address those needs of the customers, as well as create value for your shareholders. So another change which we think as Bank of Uganda that is critical is the competition from the non-traditional players. Yeah? We've been, since morning, another term that has been mentioned very often is the fintech firms. Yeah? They are moving faster in innovation. Usually the sector says regulators move with a lag effect. But I must tell you that today these fintech firms are giving you the run for your money. They are actually moving faster ahead of you. So it's a real challenge that you need to, it's a change that is presenting a challenge to you as the banks. Okay, having looked at the changes that we think, there are many, but we feel that those are really pertinent. Of course, they present challenges to you as a banking sector. Look at technology, IT. the more you rely on these IT systems, the more you're exposed. Yeah? It is one thing talking about a core banking system, but does it deliver what it's supposed to deliver? Yeah? Because if it doesn't, then definitely you're not going to create the value that you wish to create. So that is one of the things that the banks should pay attention to as one of the challenges. And even if, assuming you have one that is robust enough to deliver your strategy, how safe is it? You can imagine how fast it can be for somebody to press a button and they'll move a lot of money, a lot of billions from your vault. In fact, somebody does not need to break into your vault to carry away the physical cash, but they can actually collapse an institution. However adequately capitalized you might be, but if some of these IT risks are not well mitigated, it can be a real problem. Another one which I wanted to look at separately, although it is somehow a subset of the first, is the cyber threats. Whenever there are breaches, data breaches, the banks are your reputation is at risk. The customer wants assurance. The customer wants to be guaranteed that their information is safe. If you sell a product, an online product, an electronic product, you no longer just have to talk about the features, how that product is going to assist the customer. No, but you need to accompany that with a whole explanation of what safety measures, what IT security measures you have instituted. Of course, money laundering is another one, which I will not, I think, dwell into a lot. But all these challenges that are present today in the banking sector erode the comparative advantages of the banks. And what does that mean? You need to keep awake. You need to keep thinking all the time. Banks have business development departments. I must, from where I'm sitting, I really think these should be the busiest departments in your banks today. Yeah. Then look at the global trends. You all know what happened after the financial crisis. Because of the interconnectedness globally, you can no longer relax here in Uganda and say, I am safe. No, you're not, because of the global trends. And therefore, that means it's a challenge. Global trends pose challenges which must be addressed. Now, looking at the changes and the challenges, what does that mean for the future of the banking, of the financial services industry? That there is need for continuous innovation. For you to regain your sustained comparative advantage, you need to innovate all the time. You need to innovate to gain your comparative advantage, but also from a broader point of view for financial inclusion. So that will take me straight to what regulatory reforms that Bank of Uganda has undertaken, taking into account the need to create an enabling legal framework, one to ensure that the financial services are delivered in an effective manner and with good mitigants for the risks embedded in the operations. Here, I'm not going into the reforms that happened after the 1990s, the late 90s bank collapses in the country. But I'll just stick to the ones that happened recently. Because of the fact that innovation is part and parcel of the banking sector, and because Bank of Uganda is aware of these changes, the Financial Institutions Act 2004 was amended to pave way for agent banking, bank assurance, and Islamic banking. And you've heard from the Deputy Governor that the regulations for agent banking and bank assurance have been gazetted. I also am very sure that the Islamic banking regulations are currently under review by the ministry, and I'm sure we will soon get them approved. Another reform or a change was to make the Deposit Protection Fund an independent organ. Not to mean that until now we didn't have a Deposit Protection Fund. We had it, but it was managed by Bank of Uganda. But because of the realization that this is an issue, this is a matter that needs to be given a lot of focus, the Deposit Protection Fund was made an independent body, and I must say that it now has a fully fledged board and senior management. So it has started doing its work. Yeah. So for the consumers, you must now be very comfortable that your deposits, that you have another person, in addition to Bank of Uganda, you have a watchful eye over your deposits. So please, let us make use of these developments to access the financial services. In addition to those, of course, Bank of Uganda has made other changes in line with the international standards, specifically Basel III. And there are two main changes, one on capital and liquidity standards. I'll not go into the details, but I just want to highlight one area that in addition to the minimum, first of all, the minimum capital requirement in terms of tier 1 capital to risk-weighted assets was increased from 8 to 10%. But in addition to that, there are capital buffers that were introduced in the amended capital regulation. But there's one area I want to focus on there. That is over and above the capital buffers for each and every body. For those institutions that are deemed systemically important, they will have an obligation to keep another 2.5%. And all these are really geared towards ensuring firmer resilience of these institutions, for purposes, of course, of upholding for financial stability. So what else has happened in the regulatory sphere? There is now a new law called the Tier 4 Microfinance Institutions and Money Lenders Act 2016, and this mandates Bank of Uganda to regulate some of these Tier 4 institutions, which were providing financial services to the market, but were not under watch of Bank of Uganda. So we feel that this development is very, very important, because when these are brought on board, then of course it is a way to check on their internal controls, the market discipline issues, and of course to ensure that the depositors' funds are protected. We've talked about the digitalization of financial services, and specifically talking about the mobile money sector. Bank of Uganda issued mobile money guidelines, and this forms the basis upon which Bank of Uganda oversees the operations of these services. I want to just emphasize that the mobile network operators cannot deliver these services without partnering with a financial institution, because the financial institutions are under the mandate of Bank of Uganda. Yeah, so we believe that was an important reform, not to curtail the development in that space, but also to ensure that yes, let the innovations continue, but with checks and balances. What about us, the supervisors? We must say that, of course, learning is a continuous process, but now with all these new developments, it has even become more important, more mandatory for us to reskill in order to be able to ably supervise and oversee the risks that are posed by these new developments. I think I have 1 minute? Okay, Maurice says I have 1 minute. And those 2 points there, I just want to highlight that because of the relevance of IT and because of the sophistication of these core banking systems that drive the banking services, Bank of Uganda has now introduced a requirement. We always rely a lot on the external auditors. But I want to tell you here today that we now want to rely on these external auditors to give us assurance, independent assurance, on the robustness, the safety, IT, security, and a lot more on all your core banking systems. So we believe that with that intervention, we should be able to keep on top of the risks that these IT innovations present. Of course, you cannot underestimate the power of stakeholder engagements. We do have engagements with you, the financial sector, but also with the financial sector regulators. And we signed a memoranda of understanding to govern this engagement. There are 2 points which are supposed to be on that slide, but I don't know what happened. The first one is on the consumer protection. And you had a few minutes ago when the Deputy Governor ably explained some of the interventions that Bank of Uganda is doing in that area. I just want to add that in order to encourage more transparency under consumer protection, we publish the charges for all the financial institutions. And the second bullet point is on Credit Reference Bureau. We feel that this was a very good reform because now the banks can generate a report by a click of a button and they'll get all the credit repayment history on a borrower. We believe that these innovations should be factored into your pricing models because we believe that with such a platform, you should be in a better position to assess the risks of these customers. And maybe in the medium to long term, we should be able to see your interest rates go further down. And the last one is just an emphasis of what we, the regulators and the financial services providers, need to do to tackle these challenges so that we remain relevant to the sector. I thank you.
Surely we can do better than that. Another round of applause for Sophie. Henry, I have the microphone, so I'm not leaving the podium, so you please do share with us very quickly your presentation. I know you prepared with your team something based on the topic of discussion, and then I'll quickly open up this for our own discussion. Yes.
Thank you, Maurice, and I want to thank Sophie for highlighting most of the issues that do actually appear in our small or brief presentation. However, there are 2 things I would like to note. I think this is an opportunity for me for the first time to address the bankers. Yet most of the frameworks we do touch their business. I would like to state that when we are doing our laws, when we are processing our laws, we are open to the public, the bankers inclusive. And I would like to appreciate the Bankers Association and the Insurers Association for their continued cooperation we've had with them in the process of enacting the laws. Now, since Sophie has touched most of the areas I wanted to highlight, there is one important piece of legislation which we are currently considering, which she did not touch, the law that will regulate management of the pension funds. That we call it the Retirement Benefit Sector Liberalization Bill. And this is a bill which has a high public sector public interest. And from the audience, when we went for lunch, so many people were coming to me asking me how far we've gone on this bill. I want to say that we've gone 80%. In consultations, we are left with about 20%. Then we go on the floor of Parliament. There are three important things in this law which the bankers should interest themselves in. One is opening up the sector to competition, and two is widening the coverage, and three are the number of products that will come in the market once this law is in place. And I would like to state that the bankers have not been very active, but from now, since I have engaged with you, I can give you an opportunity to express your views to the Committee on Finance, which is handling the law. Then secondly, the gaps. Yes, it is true, looking at the changing environment, Parliament over and again has amended laws. For instance, she didn't mention the anti-money laundering law was first enacted in 2013 and later on amended in 2017. The anti-terrorism law, same thing. The insurance law was recently overhauled to provide for new dynamics in the operating environment. However, there is a gap. When we enact a law, it takes more than 2 to 3 years to come up with regulations. And that's a gap that needs to be addressed. For instance, the Financial Institutions Act, we amended it around 2014, 2015, and the regulations have just been gazetted, I hear. Parliament is not yet aware about this. We have not been informed. We've got the Tier 4 microfinance institutions and Money Lenders Act, which was enacted in 2016, and up to now, we don't have the regulations in place. So these are the areas we need to work together, engage, and see mechanisms on how we can improve. Thank you so much. I would like to thank the audience, and I encourage them. And I appeal to you to always get in touch with us so that we have good enabling laws that help your sector. Thank you so much.
Thanks, Honorable. All right. David, let me come to you. We've come a long way since 2008, and 1998 rather, and many lessons learned, fingers burnt, regulations put in place. But critics now would be saying we're back to square one. We're back where we were in 2008, and questions are being asked. Very hard questions are being asked. Where is the problem?
I think it's working.
Yeah.
Yes, thank you very much, Morris. And like the last speaker, I'll also first start off by thanking the UBA for inviting me here and observing, as I was sitting up here, that the Bank of Uganda is here with the bankers. It reminded me of the verse in the Bible where they talk about the lamb lying down with the lion in paradise. Woody Allen modified it and said the lamb won't get much sleep. But it looks like everybody's getting on very well. I think, Morris, turning to your question, the theme of the panel discussion and the theme of the presentation had the aspect of fast-paced change. And I think that's, from a practitioner's point of view, the legal practitioner's point of view, the first point that I'd like to put across, that you can't legislate for everything because things are changing very quickly. There are certain aspects of banking that have remained the same for centuries. Double entry accounting was invented in medieval times in Europe. Bills of exchange were invented in the 5th century or something like that. The Bills of Exchange Act, which governs checks and negotiable instruments, the act that we have here is a version of the Bills of Exchange Act 1882. So there are certain things that have remained very stable and predictable in the banking sector, for which a lot of regulation has come into place and has been tested, and there's judicial precedent the world over, Commonwealth and other places where we draw examples from. But there are also certain things that are changing very quickly. There's disruptive technology that is changing telecoms into banks, essentially. If you think about it, from what banks used to do back then, Sophie just talked about mobile money guidelines. Should we have a mobile money act? And just after you've done an act that deals with mobile money, another young man or woman will come up with a revolutionary technology that will move you from mobile money into something completely different. There are known knowns and unknown unknowns. So I think, to my mind, the first thing to do is to ask whether what we have already can deal with the risk matrix as it grows. Certainly, there's a lot of leeway to deal with the risk matrix that we have, and as we know it and as it grows, a lot of regulation is in place, but a lot of supervision is done with guidance and benchmarking and directives linked to the conditions of your license. I don't think that we'd ever come to a place where we can have legislation that covers everything or regulation that covers everything. And even when we do, we'd have to be thinking that innovation has come to a standstill, which it can't do, and two, that the people who would deliberately sidestep regulation will stop thinking and say we've now given up. When I read this act, all the things that I could think of to get around this act are done. Unfortunately, there are those lawyers with the white hats, and there are the lawyers with the black hats, if I may use something from hacking. So as soon as you have a new regulation out there, somebody sitting there thinking, what is the limit of this regulation? As soon as you have a regime to be enforced, there'll be somebody testing the practical reach of that regime to see how far they can test it and how far they can stretch it. And in all this discussion, we've talked about regulation, but then it doesn't exist in a vacuum also. Leaving aside Bank of Uganda in the primary regulatory aspects, I don't think we can leave behind the idea of the whole justice, law and order sector. So if you've got bigger cyber threats, issues of cyber crime that could even collapse a financial institution or cause leakages of people's personal data, is our police, our courts, our prosecutors well equipped to deal with these issues as and when they arise? So you might have a beautiful set of regulatory legislation all bound in leather and written on vellum. But if your courts can't deal with these things, if your police doesn't know how to start investigations, you have a problem. So I think that the issue is really the fast-paced change. We can't deal with everything. We have the tools to deal with what we're dealing with, what we see so far, but there's so many things. I haven't even touched the blockchain and all the cryptocurrencies and things that are coming.
I'm hoping when we find some time we will come there. We'll come to cryptocurrency. But Jacqueline, this is where I want you to come in. You've done some work in Rwanda. You've done some work, in several countries, here in Africa and the US. Let's look at, something he talked about, risk management. How much is being done? Because you can do so much oversight. The laws are there, and there is, as David says, people out there looking to how they can stretch the laws and get away with it. But where has it worked? Where do we see that, in this jurisdiction we've seen, organizations or countries that have actually taken, a step further and said, listen, this is what we are going to do because we see a threat, huge threat, a threat with the IT system, a threat with cybersecurity, a threat with the changing technologies. Where are we seeing this work, and what is it we can borrow and bring here?
Thank you, Morris. I'd also like to join the rest of the panelists in saying thank you to UBA, which is one of FSDU's partners. And I think to respond to your question, a trend that we are starting to see globally is the idea of regulatory sandboxes, which is how can a central bank have an operation on the side that really questions, tests, researches new laws and how it might operate in a particular environment. The best case we've seen is Singapore, but there are examples that are rolling out across the world. Most recently in Kenya, there was a regulatory sandbox with the Capital Markets Authority. And so that's something that we at FSDU are starting to research and see how can we as an FSD Uganda, but more holistically, how can we as an FSD network really start to engage with different regulators across the continent to see the viability here within the network that we operate in. Now, for countries, I think, once again, every country is different, and so I think it's a bit hard to put one country in another country's situation, but I will give the example of Zambia. And I give the example of Zambia simply because it's the one that I know best and the central bank whose board I sit on. Something that we've done there is, as we notice new trends coming in, different departments really do sit and try to figure out how does this work. And we do work with different development partners to figure out how imminent is the threat, so to say, be it of cybersecurity, be it of cryptocurrency, and how does it make sense for the Zambian system. For instance, for cryptocurrency, we decided that right now that is not something that is an imminent threat. Therefore, it's something that would be observed, but not something that would be legislated. And going back to David's point, not everything needs to be legislated. There does need to be enough space for innovators, creators, financial service providers to really test and try to understand what might make sense for that particular market. And going back to the work of FSDU, that is something that we are trying to do. We are working with different innovators in Uganda to really figure out what might make sense not only for the Ugandan financial system, but more importantly, how can we help create research that will help inform product development that will reach out to the masses of Uganda, but also how can we work with the regulators to make sure that some of the laws that might come in place really are well informed based on examples on the rest of the world, but also using examples here of the research we conduct and also understanding human-centered design to really make sure that the laws that do go forward make sense for the foreseeable future, and if and when they need to change, regulators are able to change them accordingly based on trends that happen in the future. So I do think there are some good examples, but I do think Bank of Uganda is definitely aware of those examples. I think something that we hope for is greater engagement to really see if there is a potential for a regulatory sandbox so that we can really start to test new laws and see what makes sense to be legislated or what makes sense to just wait and observe and see how the industry develops.
All right, thank you, Jacqueline. Again, I'm open to a contribution from the Deputy Governor or even the Executive Director, Supervision at the Bank of Uganda, just, as and when you want to jump into this conversation. David, let me come back to you. Let's come back closer home. Not so long ago, we had a good example of, a concern in the banking sector that was quickly nipped in the bud with Imperial Bank. And then, we saw a similar situation happen in Kenya that, the central bank, dealt with. What do we learn from experiences like that we're able to pick up, especially with internal dynamics within the banks and how the banks work, especially the executive directors or the owners or the managers of the bank? What are we quick to pick from that?
I think the themes that you can pick from banking failures the world over, the risks tend to turn on a number of thematic points. There's corporate governance, there's failure to analyze risk or assess risk properly, and a whole host of others. I think, if I may hark back to use local examples here, in the 90s, we had banks that collapsed because they were very large and their management was not up to scratch from a corporate governance point of view and from an executive management point of view, and how those two, the executive and the oversight, interfaced. There were problems with separation of ownership and management. There were problems of people understanding what they were dealing with in a fast-changing world. those themes can come up in various different ways. You'll see that I'm skating on very thin ice and I'm trying to avoid I won't even call it a big, I won't call it the elephant, but there's a mammal in the room which we shouldn't talk about.
We can all see the mammal, yes.
But if you look at it from a regulatory point of view, it's just like any from a legal regulatory point of view. The fact that there's been a big bank robbery is not for failure of having a section, not having a section in the penal code that says you will not go to a bank with guns and steal money. It's because, in spite of that section, somebody managed to get together with somebody else, put some guns together, go and rob a bank. Maybe bank didn't have security that would stop robbers coming in, or if they're in, stopping them leaving, etc., etc. You will find that these things, you can never legislate away certain situations, in my view. You can learn from them, and in terms of comparing notes across regulatory authorities, certainly I believe that there's a lot of note comparing, and there should be regionally and internationally. Comparing of notes to find out things that have happened, and then in the next round of audits and the next round of inspections, attention can be paid to certain things based on local knowledge, regional knowledge, and international knowledge. What certainly can't happen is a situation where you'd say, well, because we have section this of the penal code, there will be no bank robbery. No, somebody is thinking of exactly that section and how they're going to violate it. That's the unfortunate way in which human beings are made. And if I may touch very quickly on again, talking about the fast-paced change, to bring that theme into this question. As the last speaker, and I'm really sorry I didn't pick her name, the last speaker said, Jackie, Jackie said, some of these things you have to look at and determine whether you're going to legislate and start regulating them, and others you have to hang back. Hanging back gives you the ability to come up with informed legislation that covers the risks as they have emerged, because again, as things are designed, they're often not used in that way. If you think about the mobile phone, again, the person that thought about the mobile phone becoming a financial tool was sitting in, I'd imagine, in a server room and thinking, if I made this talk to that, I could make money move across. And lo and behold, but the guy that invented the mobile phone was thinking about how do I get somebody else to talk to the other? So a lot of how the risks emerge and the things that you need to legislate emerge come from, once the innovation is put in place, how it's actually used in the marketplace. So you could start with watching guidelines, comparing notes across borders or in other places where things have maybe rolled out and are a bit people who are ahead of the curve. But so with cryptocurrencies and such technologies, a lot of what has to happen now is quick learning and observing, and eventually legislating for things as you understand them and as they impact our market. Because otherwise a lot of it will be legislation that might be of no value, or we'll end up doing things like just banning things because we've not understood them, or we think they're bad when maybe they're not.
All right. As the former, central bank governor in Kenya was speaking, and he shared with us some statistics, Honorable Musasizi, and it was very clear, in some of the numbers he shared with us, if you have 5 in 10 who were probably banked, and another 3 in 10 who were banked in the informal sector, and another 2 in 10 who are totally unbanked, and you can't find them in the system. We are talking about financial inclusion and trying to bring on board more people into the banking sector. For me, I see a greater risk, because the more people you bring in, the larger the risk. As a parliament, do you feel, you need to be playing a much greater role, playing an oversight role, and we probably are putting too much pressure on the central bank, and yet you guys sit at parliament, you should be enacting the laws that protect my money, your money, and the institution.
Yes, I think the professor emphasized the need for financial inclusion. And in Uganda, we are talking about the need to facilitate financial inclusion to reach the rural areas. I am sure at the Ministry of Finance we have a project called Profila, which is program for financial inclusion in rural areas. And when you look at our setup, we are encouraging people to form circles where banks cannot reach. Before agency banking was in place, among others, we thought of an idea of having circles reach all over. And one of the objects of bringing the Tier 4 microfinance institutions bill and later on the act was to include all these categories to bring them under regulation. And I'm sure once the regulations that operationalize this act are in place, we will have everyone on board being regulated, and I'm sure this will provide the necessary safeguards.
Do you have stakeholder engagement? Do you have continuous engagement with the central bank, continuous engagement with the players in the financial sector? There's several CEOs here. I don't know how much time you've had to talk to them today on some of the challenges they're actually facing that probably could do with legislation.
Yes, actually, for the information of the audience, our committee does oversight on all these institutions, including Bank of Uganda. So we do stakeholder engagements with them to see how our laws are working, and those which are not working, we ask them for proposals to amend them.
All right. Yes, Jacqueline.
A quick point. There is currently a draft national financial inclusion strategy, and so it should hopefully come out within the next couple of months, and that will really help guide us for the next couple of years. And part of the strategy is a stakeholder engagement strategy, which really makes sure that the onus is put on different institutions, both public and private, to deliver on national financial inclusion goals. And so I do think that there is a lot that is in place, and that a lot of players are working there. And I think what we are doing now is really trying to make sure we're all working together and that there is no duplication of efforts. So things are in motion. The ministry and BOU have been leading that effort. And so I'm very hopeful that moving forward, once the strategy is out, we will all have greater direction on how we as players can help support greater financial inclusion numbers, and more than a financial inclusion on its own, really promote financial health. It's not simply about people having money in mobile wallets. It's getting to the point where people can save, people can borrow, people have access to insurance products, people have access to pension, and overall, reducing their vulnerability.
All right. All right. So the floor is open, and I'm very gender sensitive. I'll make sure. Oh, yes. I was hoping I would get Justin to say something. I need a microphone in 2 seconds. Here, we need to hear from Justin. I see a hand there, so if somebody is near him, don't give him the microphone yet. Just, I've seen you. A lady, is there a lady? No, I need a lady. Another lady, anywhere? Okay, I'll come back. Yes, Justin.
Thank you, Maurice. I just wanted to add a few points on Sophie's presentation, just for clarification. We talked about the the law, the Tier 4 law. And the thing that I wanted to add is that the creation of microfinance regulatory authority is in place, and on that part, Bank of Uganda will only be responsible for Tier 4 institutions that have member savings in excess of 1.5 billion. And capital of a registered society should be above 500 million. Now, we have looked at the statistics. Those are about now like 17 to 18 circles or other money lenders. What I want to add to the honorable MP is that we need a board in place for the Microfinance Regulatory Authority. That's the starting point, and then the regulations will come into play. However, I want to take your time and add one little thing, that regulation can talk about regulation. They're just intended to create the rules of the game, banking operations, but regulations will never stop a bank failure. So we shouldn't leave here thinking that, once we put strong regulation in place, banks will not fail. I like my friend David Israel reminds me that You don't need to steal from another bank. If you want to be a thief, open your own bank and rob from it. And of course, regulators will not know how you're stealing from yourself. Thank you.
What a way to close it off. All right. That's interesting. I want to, to just add one small comment. If you're asking a comment, please stay away from a matter before court. That's what I'm going to say. If you're asking a question, stay away from a matter before court. I will not allow the question. Okay. We had a gentleman there. Yes?
Thank you. My name is Gabriel, and it seems that we are conceding that innovations move faster than regulations. Now, the gap between developing a regulatory instrument and operationalizing it will move slower, will be longer than the time the innovation actually comes and penetrates the market. The question is, what protective measures is BOU putting in place that the vulnerable people out there are not victims of unregulated innovations?
Thank you. If you keep it short, I could take even more questions. Okay, Gabriel, Sophie, that's your question. But you're also protected. You could throw it to the Deputy Governor. Yes, here I had another gentleman on that side. There's a gentleman here. Whoever has a closer microphone, I will take first. There's a gentleman at the end there.
Thank you. My name is Ernest Wasake, and I'm with WMC Africa. Last week, I had the opportunity of speaking with the Bank of Tanzania, and we had a really nice discussion with them about different developments in the payment sector. And as a little side note, they had a full department called Department of National Payments, huge flow. Not that I'm insinuating anything at this central bank, and I agree with Jacqueline that, of course, every different market develops at its own pace. My question is simple, that is the Central Bank of Uganda going to consider a sort of forward-looking approach, perhaps to the ever-changing dynamics in the payment sector? And I kind of find myself leaning towards the Honorable Member of Parliament saying, if the regulations took indeed 2 years to come into force, is that sort of a wait for the market to develop by itself, or is there a need for some sort of new energy from the central bank and other stakeholders to say how much faster can we push this development because it's good for the industry?
Thanks, Ernest. Thank you. Okay. Yes. Your name quickly and a question.
Thank you, Maurice. I'm Daniel Babonerirwe. I'm the CEO, Bana Credit Systems. It's a debt consulting firm and in interventions of sector-wide credit solutions. We have learned this morning that 90% of African economy is in the hands of SMEs. And banks have taken a lot of bashing. As a retired banker, and one who was always on the receiving end of Bank of Uganda regarding the Financial Institutions Act. If you look at the average SME in Uganda, it cannot qualify for credit in a commercial bank under the FIA. My question to Bank of Uganda, how can we legislate to cater for that growth of that vital sector? Same also to do with agriculture. Most of it is too risky for a financial institution, under Financial Institutions Act. Then the other part of concluding that same question, we have done this one into a commercial bankers conference. UDB, luckily I think, has been also put under the UBA. And it has been conveniently too quiet. I believe it should be taking the biggest of the bashing the commercial banks are receiving. One, it should be the one receiving all those risky people who are, Uganda is known as a country of entrepreneurs, but unluckily, they don't access financing, and when they do access it, they die with it.
Thanks, Daniel.
So,
yes.
I'm actually would like to hear a voice from UDB, how they are going to grow their own market share and actually compete financing with the commercial banks.
All right, Daniel, I'm hoping, if time allows, that we will do that. And my final question is here. We had a microphone somewhere here in the middle. Please, let's give him the microphone. Here. Yes.
Thank you. Mike Milan, CompuScan, Credit Reference Bureau. My question is directed to Bank of Uganda, but it may even pick up with a question related from the speaker around SME. And it regards the amendments to the Financial Institutions Act that you alluded to in terms of Islamic banking, bank assurance, and agent banking. Great news about the gazetted regulations that have come in. But the one thing which wasn't covered, and I think it's perhaps maybe more of a comment and of interest to people in the audience, is the changes that are happening regarding the Credit Reference Bureau, which have been amended in the same legislation. And that's that traditionally, and the start of the Credit Bureau in Uganda has always been, dare I use the word, exclusive to the banking sector. And only banks or regulated institutions have been able to participate in the Credit Bureau. And to a large degree, that has hampered growth of people outside of the financial sector who can't access this, what has now become quite critical information on the Bureau to understand how people pay or honor their debt obligations. And the changes that have happened, the reforms that you were talking about, also include a reform that allows, through an application to Bank of Uganda, participation by industry, by commerce, by Tier 4, by SACCO institutions, perhaps even one day in the future by a landlord who wants to look at a tenant to see how they're repaying debt on the Credit Bureau and to participate in that. And I just thought is that from a conclusion from a CompuScan as part of the contributors today, that's important because the banks who are lending to their customers may in turn want their customers, they may put requirements on their customers to turn around and say, if you're a Makwana or if you're a Uganda Clays and you want to apply with us for a facility as a bank, we want to put a condition on that loan that you in turn have to put the right governance controls from a credit granting point of view with your own customers in place.
All right. Thank you. Thank you very much. Okay. I guess, Justine, you want to come in? I will give you some time because these questions are to the central bank, and I'm happy we have more than one representative of the central bank. But before, as I guess that is being put together, yes, Henry, okay. Let me begin with you, David. Your final remarks, because here we are closing. We are looking, and as you pick, the theme is the future of banking. Clearly, as I think Gabriel said, technology is moving faster than legislation, and we need to be wary of that. How do we go forward?
No, I suppose my thesis or my theme was that it has to be faster. We just have to think.
Is that possible? That we can move a little faster than technology?
Innovation will always move faster than the regulation. It has to. We have to think about the risks that come with the innovations. And there was a very good question from Gabriel about how to protect, if the regulation is too slow, how do you protect the people who are using unregulated innovations? The answer might be by use of contract or by use of guidelines where supervisory powers enable you to issue guidelines before Parliament jumping in to actually legislate. But in my view, if we understand and create a risk matrix, as it were, a framework in which we analyze anything, it becomes like a compass. If you've got your compass, you don't have to have a map. To everywhere you hold out your compass, and it will point you to north, south, west, and east. And then depending on what it is that you're looking for, if you're looking for sunrise, you will know where to look. If you're looking for whatever it is that is southward, then you have a general idea of where to head. If there is a risk matrix and a risk assessment matrix and comparison of notes with different jurisdictions, building of capacity, there was in Sophie's presentation, the fact that audit firms are being asked to step up and do certain aspects in looking at digital platforms and banking platforms. That kind of thing can help mitigate the risk, but we live in a jungle and there'll always be risk.
All right.
And we just have to learn how to mitigate it.
All right. Honorable, yes.
Maybe as a concluding remark, and this is food for thought, we need to think about the extent to which standards, since we are talking about the...
Can you get the microphone closer to you? I'm not so sure everyone
Since we are talking about the regulatory framework, we need to put into context the extent to which standards influence legislation. Because in some cases we have had a challenge whereby the standard setters require us to just incorporate their standards into our laws without any debate. So as I'm sure some of you are standard setters, as you set your standards, think about the operating environment where they apply and the extent to which we should incorporate them in our laws. And I'm glad the Minister of Finance is here. We have had a very big challenge with the standards, especially the standards which come from FATF. How to incorporate them within our legislative framework has been a very, very big challenge.
Right.
I thought I would throw this to the audience.
Thank you very much. And as you mentioned, I thought it was also important that we notice we note the arrival of the Honorable Minister of Finance, the Honorable Matia Kaseja, who joined us a very short while ago. He had promised UBA he would be here, and we're very glad he has finally come. Jacqueline, yes.
I think, in conclusion, I think it's an exciting time for regulators as much as it's an exciting time for innovators. And I think that rather than kind of constantly pointing fingers at regulators, I think that this is the time to engage and make sure that the regulators do keep up to speed with some of the developments that are happening in innovation. And so from that perspective, there's a whole industry of RegTech that is developing across the world. And I do think that there is a great opportunity for regulators to see what's happened in other jurisdictions, but also for innovators to come up with solutions within the space to help financial services providers really comply with the laws that exist. I think from an SME perspective, I wanted to address that. I think that yes, there definitely is a challenge, but there are parts of society, like us at FSDU, that are working on making sure that SMEs do have greater access to finance, not only from a cost perspective, but also from understanding kind of obligations and how it can really help them grow their businesses. And so there are initiatives in place. And one of the things that FSDU is working on in reference to the Credit Reference Bureau is an alternative credit scoring mechanism, and really just trying to understand how things can be done differently and not necessarily rely on only the Credit Reference Bureau, but how we can think outside the box to make sure that more people do eventually have access to credit.
Thank you. All right. Sophie, you had about 4 questions. I don't know if you want to. Feel free to throw them to anybody.
Thanks, Maurice.
You're protected. I will help. I will help explain tomorrow in the bank.
I'm very aware of the protection I have, and but I think I just want to comment on the question from the gentleman regarding the speed at which regulation moves in response to innovation. I think it is important for us to recognize that because most of these innovations are market-driven, it will be impossible for anyone to think that it will be the regulators to sit down, think about a possible legislation before an innovation. In that way, I really think it's not even something that is doable. But I think the most important thing is to be able to be on the lookout and monitor the trends. And I think the example of the mobile money financial transfer services is a very good example. Yes, we don't have an act today, but it doesn't mean that we don't know what is happening there. I just mentioned in my presentation that we issued the mobile money guidelines. For now, that's what we have. I think it's a good starting point. So I think it is a reality that we all know. We cannot shy away from it. To say that innovation is always, it moves at a much faster pace than regulation. But I think the most important thing is that as a regulator, when you realize there's a risk, what do you do? And I just want to note that in the Supervision Directorate, there is a fully fledged division in charge of market intelligence, research, and policies. So I think maybe the way we work in that division is you can talk of improvement, through benchmarking and borrowing from other jurisdictions that are more developed in that area. But I want to say that in terms of the structures, the Bank of Uganda, we do have the relevant structures. It is now an issue of reinforcing what is already in existence. Thank you.
All right. Justin, you wanted to say something about the payments sector? A question from Ernest, and also finally, a question on SME exclusion. I know Jacqueline said one or two things. If you want, but I guess it's an open discussion, and I honestly think this discussion continues. We have a cocktail, so we don't want to keep you guys away from your cocktail, right? And then you can actually meet the people you want to ask the question and ask the question. The only difference is we will not have had the answer. So I guess,
Maurice,
yes.
my boss has to conclude
perfect.
on policy.
Perfect. He has remarks he's going to make. Do we keep it for that?
Just for information again, we do have a national payments department in the Bank of Uganda that deals with all issues associated with payments. And recently, we have even assigned issues of licensing and regulation of payment system. They also have actually a division, just similar to the one that she has talked about, of research in that particular department. And two is that I think from the discussions since morning, it is extremely difficult to have regulations well ahead of innovation. And I think it was very clear in the presentation by even the former governor that even in the case of Kenya, they allowed some innovation and then regulation catches up. That is the situation we are in. And it's not an exciting time for regulators. I know you have said this is an exciting time for regulators, but it isn't. It is a very exciting time for users. And someone gave numbers that 72% of the population is below the age of 35.
Yes.
Okay? They love using technology. And we have to serve them. But it is not an exciting time because they will be trying out different things, and there will be times when we shall just be doing a catch-up. Thank you.
Thank you. Thank you very much. All right, ladies and gentlemen, a round of applause for our panel. David, Henry, Jacqueline, and Sophie, please do take your seats. We want to thank you all for being part of this discussion. That wraps up the panel discussions. I must say, whatever happens after this, this is the gentleman responsible. We have done our part. Thank you very much. I'd like to add my voice in welcoming the Honourable Minister to the closing ceremony. Could I ask Wilbrod to come and make the closing remarks? But once again, ladies and gentlemen, thank you very much for your full involvement here today.
Thank you very much, Henry. The Honourable Minister of Finance, Honourable Matia Kasaija, we want to welcome